Good morning. Welcome everybody to the November 7th meeting of the Nevada Economic Forum. We're going to start off with a roll call.
Mr. Crone,
Present.
Mr. Gordon,
Here.
Mr. Levitt,
Here.
Ms. Lewis,
Here.
Chair Rosenthal.
Present. Thank you. For opening remarks, I'd like to start by saying good morning. For the record, my name is Linda Rosenthal, and I am the chair of the Nevada Economic Forum. I would like to welcome my fellow forum members, presenters, staff, and any public participants to the November 7th meeting of the Economic Forum. I would also like to thank the Legislative Council Bureau's staff for their assistance with today's meeting and ask Mr. Nakamoto, as staff to the forum, to assist me as needed in conducting today's agenda. The Economic Forum is required to provide a forecast of unrestricted general fund revenue for the current fiscal year, FY25, and for FY26 and FY27 on or before December 3rd. In compliance with that mandate, we will be meeting on Monday, December 2nd to finalize unrestricted general fund revenue forecast. Today's meeting will include a presentation by Emily Mandel from Moody's Analytics on their current economic outlook and their forecasts for the sales and gaming taxes, as well as presentations of preliminary forecast of the state's major general fund revenue sources and minor general fund revenue sources, which were approved by the Technical Advisory Committee at their November 4th meeting. The Economic Forum will not be formally approving any forecasts at today's meeting. This meeting is intended to allow the forecasters to present their preliminary forecast and the assumptions or outlook used in generating those forecasts. On December 2nd, the forum will meet to finalize the general fund forecasts, which will be used by the governor in developing the executive budget and subsequently be submitted to the legislature for the 2025 session. Given the length of today's meeting, it is my intention to take a short break around noon. With that, I will now ask if any of the other Economic Forum members have opening remarks they would like to make. Okay. If not, I will proceed with public comment under Agenda Item 3. Is there anybody here in the Carson City location who would like to provide public comment? Seeing nobody, I will turn to Las Vegas. Is there anybody down in Las Vegas who would like to give public comment? Okay. Then I will turn to BPS staff to see if there's anybody who's called in that would like to give public comment.
Thank you, Chair. The public line is open and working, but we have no callers at this time.
Thank you very much. The next agenda item number 4, is the approval of the minutes of the June 6, 2024 Economic Forum meeting. Any discussion or motion to approve?
Make a motion for approval.
Approve the minutes.
A second.
Okay, all in favor?
Aye.
All opposed? The motion carries. Now we'll have the presentation on the national, regional, and state economic outlook from Emily Mandel, Associate Director, Senior Economist with Moody's Analytics. Welcome.
I'll redo that. For the record, my name is Emily Mandel. I'm a senior economist at Moody's Analytics. Madam Chair, members of the forum, thank you for having me back here in Carson City. It's always good to talk about the economic outlook. And I think this one is definitely coming at an interesting time. I think these, given the election results, we'll likely be making some changes to our forecast here. They'll be incorporated into our December baseline. Unfortunately, that will be after this next one, so I'll try to make some adjustments before that to make sure that we're incorporating some of the revisions to the outlook that we might expect given the election results here, and I'll talk about that more a little later about what those might look like. There's still uncertainty, of course, as to the actual policies and legislations that'll come about here, but the full party control does clear the way for some more significant changes. than anticipated in our previous baseline here. So it'll be one factor that will underline the preliminary nature of these initial forecasts here that we're provided. So over the past year or two, the talk has shifted a lot from first, are we in a recession, to then recession risks are elevated, but we're still doing okay, to have we reached that soft landing? And there's a lot of discussion about what a soft landing actually means. Is it that the interest rates are coming down once we have full employment, once we have inflation back to target, or is it that interest rates are back to their neutral rate, which we're definitely not at the moment. But either way, we're definitely on that path towards that soft landing from what we're seeing in the economic data currently. The Federal Reserve has a dual mandate, right, to promote maximum employment as well as stable prices. And those are the two lines on this chart here, right? In the blue, we have the unemployment rate hovering right around 4%, which is in line with our expectations for a full employment economy. And then we also have the personal consumption expenditure deflator. That's the Federal Reserve's preferred metric of inflation, similar to the CPI with some differences there. And you can see that that's very close to 2%. That's very close to what we would hope for in a well-functioning economy. The unemployment rate has increased a little bit recently, but that's by design. We were operating in this situation of a of a very tight labor market, and that was fueling some of these price increases that we are seeing, some of these strong wage gains, but also going into higher prices that I think are still one of the major difficulties that households are facing in this economy. Now, we also have some other areas of fairly strong performance in the economy that I think are worth mentioning. We've had very strong business formations. Those have really taken off since the pandemic. So just seeing that kind of entrepreneurship, that vitality in the economy, it bodes well, and it's one reason that we've been seeing fairly strong growth in productivity in the economy, which is another thing that we really do like to see. We've got real GDP growing at a solid 3% a year. And so by and large, a lot of these metrics, they're all moving in the direction that we would like to see here. We are in, I would say, a stronger position from these metrics than we were when we were talking a year and a half ago here. The last portion of this, to make sure that we, remain in a fairly strong position, are these further easing in interest rates. I have a few different interest rates shown on this chart here. The federal funds rate, which is the rate that the Federal Reserve directly targets, as well as the 10-year Treasury and the 30-year fixed mortgage. And so you can see that these have started to come down. We had our first rate cut, and we do expect to see additional cuts. This is one area that could potentially be impacted. The Federal Reserve might move a little bit more slowly based on these election results. But either way, we're in the process of bringing these rates lower, bringing them a little further out of this restrictive territory that we've been in. Our baseline, the numbers that are underlying these forecasts, anticipate an additional quarter-point cut in 2024, and then another quarter-point cut each quarter until the policy rate levels off in mid-2026 into the kind of that equilibrium level that we're looking at here. Now, I think it's important not to overstate the speed with which this decline in interest rates will support the economy. We're in a fairly rate-insensitive economy right now. People have locked in a lot of these lower rates, especially if you think about something like housing. We still have a lot of people that have these lower mortgage rates from the start of the pandemic or pre-pandemic when they were quite a bit lower. Even corporations that are refinancing debt, that's on a shorter timeline, but if they've had this debt issued 3 to 5 years ago, those were still in periods when the interest rate was a little lower. So even then, this refinancing will likely be at a higher rate than those earlier debts. So it's just going to take time to kind of filter through and have these impacts really be seen here. But it is progress, and it is a movement in the right direction. It takes some of that risk off of the economy here. Now, I think a lot of what's been driving the economy, and a lot of course, what drives Nevada in particular, is consumer spending, right? How have consumers been faring in this economy? How do we expect consumers to fare? And there's a lot going on here, but I think it provides a pretty interesting look into how different segments of households based on income have been dealing with this period of higher rates, dealing with this period of higher prices. So this is the personal savings rate by income group. So it's a measure of how much of households' income is being saved versus being spent. If that turns negative, like we saw with a lot of these income groups, that means that they're spending more than their income, essentially. And so whether that's burning through savings or whether that's through borrowing money, that's a sign of some financial difficulty, right? Now, that has begun to improve. We're starting to see that, level off, still lower than pre-pandemic, but at least getting on the positive side of that again. The big contrast here is that 80th and up income tiers, those households have done quite well in this economy. And that makes sense. If you're a homeowner, if you've got wealth in the stock market, you're probably doing pretty well. You haven't been impacted as highly. And a lot of the price pressures that we've seen have been things that are very important for everyday life, things like groceries, things like housing. But those are potentially a smaller share of incomes for these higher income groups. And so they haven't necessarily needed to borrow at these higher rates. And that's one thing that's kept propelling this economy forward because that spending has still remained quite strong. And we've seen strong growth in consumer spending overall. And that's something that we do expect to continue, and we expect to even not necessarily improve, but kind of broaden this base of where we're seeing that spending as we have some of these lower income households faring a bit better as we've got wage growth more than keeping pace with price increases. Now, that's not everyone. Some people have definitely come under stress as we looked at the previous one, and you can see this reflected in some other metrics here. This is the borrowing on credit cards, basically. You can see the interest rate that's being charged on those cards in the blue, and that has really increased, as well as the delinquency rate on this type of debt. And so as households rapidly used up some of these excess savings and then borrowed on these credit cards, maybe they were able to keep up with that until these interest rates started to increase, because that happened a little bit later than this period of this high inflation that we saw a little bit earlier. And so that has become difficult to manage for many, and we've seen those loan delinquency rates increase. Now, this isn't anywhere near Great Recession levels. That was closer to maybe 7% as opposed to the more 4% that we're seeing right here. So it's not a crisis level. It's not a major fault line in the economy, but it's something that we need to start to see stabilize. And it's something that we've started to see stabilize in recent months. Those credit card borrowing rates are going to be some of the fastest rates to start to respond to these lower prices, lower interest rates. Still high rates, but starting to improve some there. So we expect that this will continue to stabilize here. One of the major reasons that this is set for improvement is that we're still seeing a good relationship between wage growth and price growth. Wage growth is softening. You can see those top lines there all starting to come in, but it hasn't softened as much. It hasn't, as inflation has slowed. And so as we are having those real incomes rise, it's giving more people breathing room, and it's helping them pay down that debt. It's helping them pay for their consumption And like I said, that's important because consumers are the main engine of the economy here. Consumer spending creates demand for businesses. It's increasingly a major factor powering even the global economy right now, as the US economy has performed more strongly than a lot of the counterparts. And so as consumers continue spending, businesses continue seeing that income, they continue investing, and it's this virtuous cycle here. Recessions, they're ultimately a crisis of confidence, right? You start to see a pullback in spending, you start to see a pullback in investment, and it feeds on itself until you end up with actual contractions in economic activity. And so as long as we have these real incomes continuing to rise, this consumer confidence starting to improve, which is something that we still need to see some of, we're in fairly good shape for keeping this economic expansion going. Maybe at a slower rate. We are expecting this will continue to slow a little bit as we are at this full employment economy right now. So not seeing as strong gains as we were before in employment and incomes and things, but still growing, still moving in the direction that we need to see here. Okay. So this is our baseline forecast. And this is still going to be broadly the forecast as we look to any changes that we might make. But there is a lot of uncertainty that's added by this election. These are estimates. I don't want to overstate the finality in any sense of what these numbers are showing here. We ran some simulations looking at different policies the candidates were proposing back in August of this year. Our baseline here, and what this baseline is built upon, was a Harris administration with a divided government. And so that situation would have been more of a status quo, right? Not seeing big changes in policy. And that was under the baseline. We do now have the potential to have larger changes being made here. And the potential economic impact of some of these policy, at least proposals that he's made, are reflected here. You've seen there's some potential positives here for GDP growth coming from changes to the tax code. Primarily a lower corporate rate is one proposal here. However, we would expect some offsetting impacts from tariffs and their impact on inflation, potentially driving a slower reduction in interest rates as a result of that, as well as a reduction in immigration, which would reduce the labor force. And of course, the labor force is one major factor in a full employment economy that allows you to keep adding jobs, right? So these are not finalized, but these are broadly the directional impacts we'd expect from some of these policies. Now, even come December, we're not going to know what's actually going to happen here, right? We can listen to what these candidates are saying. We can attempt to factor that into the forecast, but you know, it's politics. There's always going to be a huge amount of uncertainty as to what actually ends up becoming law. So we'll try to make some adjustments, try to account for these the best we can, but it will still be an estimate until, you know, until that final signature is signed on any legislation here. So I just wanted to address that. I'm going to shift over to the Nevada outlook here, but if there are any questions on the US portion, I'd also be happy to take those now.
Thank you. Linda Rosenthal for the record. I just have one quick question, and it might be premature because I know you've got work to do following the outcome of the election. So you had made a comment that you thought the Fed might move a little more slowly, but your current expectation was a quarter basis point reduction in Q4 and then quarterly.
Yes.
Do you think that's going to change? What's making you think that the Fed action pace might slow?
Yes, they're in a difficult position, I think primarily because of the inflationary impacts of tariffs and potentially immigration, right? So as you have, you know, prices increase that businesses are paying for the goods that come into the country through tariffs, that then gets passed on to consumers to some extent. And so that's inflationary, right? And so the Federal Reserve, they're going to probably, and this is all speculation, have some caution there. They don't want to be cutting and then immediately start increasing interest rates again, So it seems like their only play would potentially be to move potentially a little more slowly as they wait to see how these filter out to avoid having some of this whiplash effect. It's difficult to say, but those would be the factors potentially underlying this slower decline. And yes, that would change the pace of those quarter point cuts, maybe delaying them, pushing them out a little bit further.
Thank you very much.
Right.
Yes.
As you know, we have to make a forecast for 2.5 years essentially in the future. If you were to compare the way you see it right now, the risk factor looking forward to these 2.5 years to the risk factor that we faced for the 2.5 years in our prior estimate, how would you say that compares?
That's a really interesting question, actually. I think that the shape of where these risks are coming from has changed. A lot of the pressures over the previous couple of years have been around, coming out of the pandemic, these supply chain dislocations, trying to make sure that consumer inflation expectations didn't become unanchored, that we still expected to get down to where we needed to be. Now, I think that the risks moving forward into the next couple of years, they're more centered around policy and some of these policy changes we could see. There are also, I think, some of these geopolitical risks have intensified, potentially with impacts on oil prices. I could see being one impact there. So I think that I'm trying to think through how I would actually put a number to these, right? Because we're economists, we're supposed to put a number to things. But they're just such different risks that it's really hard to say. I'll get back to you in December with some recession probabilities there.
Thank you.
Brian Gordon for the record. Thanks, Ms. Mandel, for this information. On the slide you were just sort of walking through, I realize these are very preliminary, and the title said "Election Adds Uncertainty." So what I would like to know is if you can just help orient us to the graphs themselves, the sort of change from baseline. The baseline is where how the economy is performing at present, and this is the delta that you're preliminarily suggesting would exist on a go-forward basis. Am I sort of reading the line correctly here in terms of the slowing of the economy, I think is what you said, but not turning negative necessarily? Is that how I should interpret at least the chart on the left?
Yes, yes, that's correct broadly. So this is going to be a comparison to the percentage point difference in a new forecast versus our baseline forecast. And this is also related to our August baseline. So this isn't exactly precisely even the same baseline, but it's essentially to say, okay, we had this line, and maybe it's not a straight line, it's not exactly where we are today, but it's where we expect things will go. And now maybe we expect it to be a little more like this. And so it's that gap, right, in terms of looking out over the next few years of how those will look like. When we ran these initial assumptions, and there are some changes that I think we're already planning to make here as far as how quickly some of these policies phase in, which will also change things. I think this, just from a pure modeling perspective, did result in a mild contraction of economic activity beginning, I believe it was mid-2025 to mid-2026 there. So some actual declines there, but it's, as I keep repeating here, it's preliminary here. But that's how to think about it, is how much lower it could potentially be under these policies versus the kind of status quo baseline we were looking at.
Great, thank you.
Okay. So shifting over to Nevada then. Nevada is, I talk to a lot of states, and it's always kind of nice to talk to Nevada because you guys do so well. It's such a quickly growing economy, and it's a good place to be in, and it's a much happier story to be talking about here. The title of this chart is a little bit less positive, but I think it's still important to keep in mind the broader trends that we see in the state's economy. There's a lot going on here, but basically on the horizontal axis, it's how employment has changed over the past year. And on the vertical axis, it's how it's changed over the past 3 months. And it's essentially a way to look at this kind of broader trend versus more recent movements, and then seeing how that stacks up against other states in the region. And so you can see that on a year-ago basis, Nevada's still ahead of the US. It's still near the front of that Western states or Mountain West states pack. But the last few months have been a little bit weaker. We are still seeing year to year those strong gains in goods producers, construction, mining, manufacturing, government, logistics, healthcare. It's healthcare. It's quite a bit of different industries here. But more recently, there have been some losses in leisure hospitality and some pullback in those same goods producers. Leisure hospitality specifically, it's highly seasonal, so there can be larger revisions in the series. So don't want to put too much emphasis on it, but I think it is important to keep in mind some of this slower economic growth, especially when we put it into perspective of some of this weaker performance we've seen in sales tax collections recently. Just a couple data points here that show a little bit of a pullback in the economy after what was a very strong summer here. So the other factor to think about when we're looking at these employment numbers is that it does seem likely that we'll see some downward revisions to data from the past, maybe not the past year, but from the past couple of quarters, last quarter of 2024, last quarter of 2023 calendar year, first quarter of calendar year 2024. These are mainly the manufacturing, retail, mining. Even accounting for that, Nevada is still ahead of the US. We are expecting downward revisions nationally, so Nevada is not alone in this. And it doesn't necessarily mean that where we are today is any different, but it means that the path to getting there has been a little bit weaker here. So just something to be prepared for as we look ahead. These will show up in the employment data in March of next year, so it's still a while until these actually manifest in the actual final numbers here, although we will start to get some more. This lagged line here, this data from the quarterly census of employment and wages, that'll start to push out a little further. We'll get some more information, but we won't actually see these changes until March. Now, one thing that has kept Nevada growing is this expanding labor force, and it's been come back fairly risen over the past year. Now, the unemployment rate, this has also edged up over the past year, and it is currently the highest in the country outside of the District of Columbia. That's not unusual for Nevada, but it's also a situation where we wouldn't want to see this rising further. Our baseline does expect some improvement here as we start to see slower labor force growth combined with ongoing job gains. Our forecast has it dropping to the mid-4s by 2027. So that's a decent amount of improvement here that we're expecting from this outlook here. If we see this move higher, potentially a cause for concern, but the fact that it's been rising as the labor force has also been expanding, that's more what we like to see, right? That relationship is a stronger one there. And there are still plenty of positives here. There are lots of job openings in the state. We've seen those come in somewhat over the past couple of years, as we've seen nationally, likewise by design here, trying to take some pressure off the labor market. But there's still a lot of job openings. There's still a lot of businesses out there that are looking to hire. And most importantly, layoffs are still low. This is something that we've been looking at quite closely, both nationally and at the state level, because it's those layoffs that are going to trigger some of that crisis of consumer confidence here. When people start losing their jobs, of course, that's a very real sign that we're in a bit of trouble, that businesses are struggling if they're laying off those workers. And that's not something we've seen. And unemployment claims, likewise, are still low. And so I'm focusing on some of the negatives here because they're things to watch, but I don't want this to take away from these other metrics that we're seeing at the same time that aren't really flashing red. We're seeing maybe some flashing orange in some of these, some flashing green in others, so I don't know how you'd combine those two colors, but it's it's still a decent picture overall. Now, challenges have been affordability, right? Challenges have been prices. That's something that we saw earlier with the US, starting to see some of these default rates increase. And this is also a challenge in Nevada. Affordability has really been a struggle here. Even prior to the pandemic, it was declining very significantly, and it's declined even further since then. On the left here, this is our housing affordability index. So it's essentially how much of the income that a household with a median income, so like your average household, would have to buy your median priced home, your average home, to afford the mortgage on that. And so this does take into account mortgage rates, and then it takes into account housing prices and income. So it's a fairly broad metric bringing those all together about how affordable this current housing market is. Answer there, not very affordable, right? We've seen Nevada as well as most of the West, right? And this isn't a new story here. It's a struggle. It's a challenge here. We do have a couple factors that are going to improve. Most of this challenge here has been from an undersupply of housing, right? And it feels strange to say this after maybe the post-Great Recession period when Nevada had just too much housing, arguably. But given how strong population growth has been, given the relative lack of new buildings since then, we're once again into this position where there isn't necessarily enough housing, keeping pressure on prices. We expect more construction in the forecast, and so that will improve it some. I actually have a chart later on this, so I'll jump over to that in a second. But also lower mortgage rates will be a significant thing in making mortgages more affordable here. Now, I've been talking about population growth being pretty strong in Nevada, and that's definitely true. These affordability pressures, less of pressures for people from California, and I just think it's interesting to see these are some of the top destinations for where people are coming from here, and it's pretty much across the board, California or other fairly expensive cities here. So Nevada's still maintaining some advantage relative to some places, but for your average resident here, we definitely need to keep seeing some of those affordability start to improve some here so that people have the resources to keep spending on other areas of their lives, things that we need to see for just the broader economy moving ahead and for these tax revenues that we'll talk through in a minute. And despite these price pressures that we're seeing, net migration has actually, if anything, accelerated a little bit recently. So people are still seeing the benefits, right? This cost-benefit analysis, they're still seeing Nevada as a place that's worth moving into, even at these higher prices here. So I mentioned this a little bit earlier. We do expect some improvement here. We expect some improvement in affordability as we have home prices begin to level off, even contract a little bit through this outlook here. And that's largely coming from increased construction. As we get more building, more single-family housing starts, more completions then coming out of that, it's going to take some pressure off of prices, and we'll get some leveling off after this huge run-up that we've seen through 2021, 2022. You can see that year-over-year price increase in Case-Shiller, the house price index, that was almost 25% over a year. That's just a huge amount. And so a little bit of declines here in the housing market, in housing prices. It's not really going to take away from the wealth that households have accumulated, but it's going to give incomes some more time to start catching up to those higher level of house prices that we're in currently. So I think I focused on some of the negatives here. I focused on some of the things that are showing a little bit more shakiness in the economy. But I think it's important to keep this positioned within the broader outlook of Nevada remaining an outperformer here. As long as Nevada's population is growing faster, as long as the state continues to add jobs, we have Nevada staying a fairly significant step ahead of the US. Here I have forecasts for two different series, population, right, as well as personal income. And you can see that personal income staying around that 5.5 level here. And that's quite strong. As we transition over to talk a little bit about these revenue series, I think thinking about these two kind of metrics as a base level of what a normal economy would necessarily feed into these series is a good kind of basis point here, a good benchmark for thinking about how sales tax revenues and to a lesser extent this gaming percentage fee revenues could increase relative to this. So slowing, definitely slower than we were, especially around the income side of things. This is partially just because there's less tightness in the labor market, there's less inflation that businesses are then going to have to help their employees be able to afford. We're just on a lower price level type situation right now, which is good. So some slower growth there in incomes, but still remaining substantially ahead of the US. Okay. So I'm going to transition now to talk a little bit about the sales and use tax outlook as well as the gaming percentage fee. And sales and use tax especially ties in very closely to these earlier indicators here, because people's income largely determines what they can spend. I mean, it makes sense. As interest rates start to decline a little bit, that's also going to make borrowing more affordable, whether that's borrowing for a new vehicle, right? Loan rates are quite high currently, so as that start to come down, that's going to make it easier to purchase vehicles, or just large debt-financed purchases here. So there are a few factors that we put behind into our model for the sales and use tax. We look at personal income, which I've talked about. We look at unemployment, which we've also talked about some. Nevada is a more cyclical economy than a lot of other states, and so this is a bigger factor here than we would necessarily think about for other areas. And then we also look at the personal consumption expenditures on durable goods. So these are not things like food, but things more like your washing machine, your computer, things that last a few years here. This is an area that we saw a very large increase in spending during the pandemic, and largely as people were buying goods for their home, trying to make their home office a better situation. You can't really spend on services, so you spend on goods. And I think a lot of this came ahead of needs, and so we've seen some slower growth in that goods spending since then. As we start to get further out from that, we'll be able to start seeing some more increases in this spending on these durable goods coming out of this as people, have the resources and have the desire to keep spending in these areas. And especially as we start to see some more housing construction. Home building, as well as the purchases that then go to fill up this new home, are a very significant driver of this spending. And so this earlier chart where we looked at this rising home building starts, that's also going to help improve this outlook for this spending. Finally, I've also included in the model national recreation spending to try to give a measure of the spending that visitors also do when they come to Nevada, whether they're eating out, doing these activities, retail shopping, all of these things that do contribute to sales tax revenues in Nevada outside of spending by actual local residents here. So as we look out from this, the forecast tracks fairly closely to that income series that we looked at a little bit previously. We're still seeing growth here, not necessarily the growth that we had back in fiscal 2023 before that, but growth that aligns with the resources that Nevada residents have to spend as we start to see some of these positives from lower interest rates, increased home building, and those beginning to be weighed, I'd say, against some of the negative impacts here from prices just not increasing as quickly. prices are double-edged, right? Higher prices, it cuts into real incomes, it cuts into those real resources people have to spend. But as you're spending money at these higher prices, of course, sales tax revenues, they're nominal, right? So that is a positive here. So some slower prices, negative from that nominal sense here, but obviously a positive for the economy as a whole. I'll keep moving ahead then. Thinking about the visitor economy, the tourism economy in Nevada, there's a lot about this that is surprisingly right on track with what we would expect it to be absent the pandemic. I was looking at some different metrics around just recreation spending, gaming, percentage fee revenues, these different visitor counts, and it's all kind of where we would expect if we drew a line starting from where we were before and where we are now. And I think this underlines this story of normalization, right? Getting back to those economic fundamentals here. This chart here, just to show one of these metrics here, are the visitor volume to Las Vegas. Obviously, this is one of the major drivers here of the tourism in the state, one major indicator here. And this is just about where we were before the pandemic. There's still some areas that we would like to see some continued improvement on. International visitation, not quite back where we'd like it to be. Even some smaller areas like conventions, not necessarily where they were before. So there have been some more persistent changes here, maybe areas that we could see some further improvement. But by and large, we're basically back where we were here by this metric and a lot of these other ones. Now, the negative here is consumer confidence. You need to be fairly confident in the economy if you want to pay for that big vacation. You need to be confident or at least enjoy risk to want to go out and, gamble in the state. And so this is a factor that's going to be especially important as we look forward over the next couple of years to see how this changes. I think the interesting part here about consumer confidence is it hasn't really aligned with some of these other metrics we've talked about. Consumer confidence is not especially low depending on what you look at, but it's kind of middling, and it's not really a level that you would expect to be consistent with an unemployment rate nationally of around 4%. People don't feel that great about the economy right now, about their own current prospects right now. And a lot of that comes back to these price pressures. Economists, we focus a lot on inflation, on how those are changing, but even if prices are rising more slowly, that doesn't bring them down. And as economists, we don't really want prices to go down. Deflation, not necessarily good from an economic perspective. But that means that people are still seeing these much higher prices than they saw before the pandemic, and people are not particularly happy about that. And I think that's the major factor here behind this not so great consumer confidence. And so it'll be interesting to see how these metrics start to change after the election. It could be to take a positive look on that. People see change, a turning of the slate. Maybe now they're looking at a new perspective of how their economic situation goes. You could see some improvement there. Or you could see some deterioration depending, once we move into next year, on the economic impact of some of these policies. But this is going to be a fairly major one for looking at how gaming percentage fee revenues change. We've got consumer confidence fairly middling, and we've got gaming percentage fees fairly about where they were, a little bit stronger here. So this is our outlook. These have been incredibly volatile lately with these huge changes during the pandemic, after the pandemic, followed by fairly slow growth in fiscal 2023 and a stronger gain in fiscal 2024 here. We expect that things will be slower in fiscal 2025. A lot of this is just coming off of this very strong growth that we've seen over the last couple of years. The industry has shifted some to look a lot more at different types of recreation activities here, and Las Vegas especially has had a lot of these very high-profile events, especially last year, thinking about Super Bowl, for example, things that brought people to the area and things that even as they keep a fairly stacked calendar, which I'm sure you'll hear about a little later, it won't necessarily be a repeat of just how strong this past year was. You'll see a very negative number here for the Q1 value here. That's purely a fiscal 2025. That's purely a timing effect. So that's shifting some of that revenue into the second quarter. And so I don't think this signals any real weakening here, but we don't expect that visitors will necessarily top the previous year's values by much. If we look further out, you can see that this returns to growth, looking more at areas of just these rising incomes, these rising ability to spend, maybe seeing some improvement internationally, being able to bring some more visitors back there over the longer term. So getting back into this stronger growth path towards the end of the forecast horizon here. Okay. So this is everything I wanted to talk about here, but I'm happy to take any questions.
Thank you very much. Questions?
Thank you. Brian Gordon for the record. This has been very helpful. Thinking about the gaming percentage fee outlook, I'm just curious, I think I understand the thought process behind fiscal 25 and then sort of returning to growth. Is that more, in terms of how you all look at your models, is that more of a volume impact or more of a value impact? My sense is you sort of referred to the stability of the tourism economy in terms of visitor volume. It's more of a value-related growth that folks that are coming in from out of market would simply be spending a bit more than they were before. Is that the idea on the gaming front?
Yes, so we actually look at both sides of that, right? We look at the, I didn't mention this, but the two kind of factors that we put into this model here are we look at disposable income, right? So that's that kind of value, I guess, what people have available to spend. And we also look at forecast out visitor volume, and we base that on national recreation spending. So that's kind of more of your volume metric. So we try to combine both of these in looking at this. I think more of this growth is coming from that value, from the resources perspective, but we do expect some continuous improvement in those volumes as well here.
Okay, great. Thank you.
Yeah.
Couple of questions for you. On the gaming piece, you mentioned it briefly, but there's the shift from in 2025 from Q1 to Q2. But you said, overall, we're making it up. But I expected to see a decline in Q1 given, the activity that we had. But why do you feel like Q2 makes up for that? What's that factor?
Yes, so we started to, it's August, to be specific, August ended on a Saturday. And so some of this revenue was recognized then the following month, and there's also a 1-month delay in some of these. And so we've already seen some monthly data that happened after I finished this for the following month, the first month of Q2. I believe we had something like a 25% decline followed by a 27% decline year over year. So it does look like that's been shifted through some, and that kind of just, my positivity here is more from a arithmetic perspective. So expecting to see some of that shifted into the second quarter. Absent some of that shifted income, things would look a little bit weaker in that second quarter, and that's coming off of some of this growth that we saw, stronger growth the same quarter of the year previous as well. So looking at some of those base effects there.
Thank you. And then going back to the consumer confidence piece that you talked about. So you mentioned that, we expect, things are better. The unemployment rate is lower and, and wages, but what do you think is going to result in a bounce back, I guess, of the consumer confidence piece? You mentioned pricing, prices are going to stay stable. You're not assuming in your model, I think the prices are going to go down. They're just going to stay stable. So wages are eventually going to catch up. Is that, and then eventually just more psychologically, people are just going to be comfortable with pricing being higher? Like, I want to understand a little bit more what your assumptions are there.
Yeah, this is a little bit of me putting in my psychologist hat here, but I think if we look at a lot of the metrics as they are today from the economic side of things, they look all right. And so I think some of this is just, it takes time to move past some of the stressors that there have been over the past couple of years. And so I think it's going to be this combination of rising incomes combined with slowly rising prices that are then going to make those goods that, yes, they're at a higher level, but it's going to start to feel more affordable. You're going to start to feel a little more comfortable with the fact that, you know, those goods that have maybe come up, gosh, I think it's like 20-25%, some of these very significant increases in a lot of goods. Yes, those are up, but maybe over the past year, they're only up 2%. Maybe that's more acceptable to you, and it'll start to settle in after a while as incomes keep rising. So psychological, but expecting some improvement.
Okay, great. I got one more. Then my last question, going way back when you were talking about the unemployment rate, and you're saying you expect it to improve or generally higher than the rest of the economy, but where are you seeing the improvement? I guess it's sector-wise. Where are you seeing that? Because we're going to continue to get migration here, so where are you thinking those jobs are going to come from?
Yes, I think part of it is on the labor force side. Labor force growth, we expect that'll start to slow a little bit, still rising, but slower. Nationally, a lot of this was from immigration over the past couple of years. That has already started to pull back some, and so some slower there. Nevada isn't especially reliant on international immigration, but it's a component there. And then, so some slower labor force growth. As far as job gains, where we think they'll be coming from, I believe healthcare has a fairly strong outlook as far as jobs coming from healthcare. Expecting some improvement in the manufacturing industry as well there. There are a few projects that are still ongoing. I would say those are the main areas. I don't think we're expecting any significant increases in like leisure hospitality industry.
Yep.
Yeah.
Okay, great. Thank you.
The visitor volume is, well, as you mentioned, is very good, coming back anyway from where it has been. And we've seen over several months the gaming has not really done that well. And I wonder, we talked about this a little bit at our last meeting, are we seeing over time a change in the mix of what people spend on when they come here? Say, for instance, our two biggest revenue sources, of course, are the gross gaming and the sales tax. And the gross gaming has done pretty well up until just fairly recently. But I wonder if are we seeing visitors spend on something? We've seen real growth in some of our areas that relate to visitors coming, like on shows and that type thing, more so than we have seen more of the traditional gaming things. Are we seeing, do you think that we're entering a period where our two principal taxes are not going to grow as much as some of these auxiliary things? Say, for instance, if the room rates go up, and they obviously pay a room tax, but that's not one of our main taxes that we get here. If they spend more money on rooms and less on gaming, then that has an effect on our revenues. I just wonder what your feeling is on that.
I think that is true. I do agree with that. I think there's been a lot of focus on sports and events and athletics and things that are, supposed to keep drawing people to Las Vegas. And there is more people coming to the state. That's going to be good. You'll get some spillover effects, still some gaming, but I think the focus of this visitation has changed some. We've also just seen a lot more availability of gaming outside of Nevada, right? This just keeps expanding. We're seeing new casinos. We're seeing sports betting, for example, just areas that people can get some of this in their lives outside of, a trip to Las Vegas. And so I think it's a positive that there's been so much diversification, because I think otherwise it would probably just be a loss to some of these visitors. But I do think, especially for the gaming percentage fee side of things, there's definitely some downside there from this shift. I'm a little bit more bullish, I'd say, on sales taxes, just because you do have a lot of that strong, just kind of internal demand here just from Nevada residents, and I think prospects there are fairly good. But the gaming industry does have some challenges.
Thank you.
Linda Rosenthal, for the record, I mean, I guess if I could just comment on that, it's interesting because there have been major events come to Vegas, right, that's driving that visitation back. Super Bowl, F1, all these great events that seem to draw a higher income participant, right? I mean, these are expensive outings. The question is, are those people gamblers, right? So yes, they're coming, they're spending on the hotel rooms, which are very expensive, they're spending on the food and the entertainment. And I guess the other component is, but are they gamers or not? And I don't know what degree of magnitude you would need to have to really see a result in the taxes that come from that, but it's just an interesting, thing to ponder when you look at visitation up, great, we're back to pre-COVID, but what's the makeup of that visitor? And it could be the opposite. They've got lots of money to spend, they're wealthy people, they're gonna enjoy the experience of gaming as well as watching a car race or a football game, so interesting to see.
That's a great point.
I just have one question procedurally. So for our December 2nd meeting, you'll be revising your forecast, so we'll have updated forecasts. I know that some of the data, the analytics that Moody's provides is also used as base information in some of the other modeling that the forecasters do. So just making sure in terms of timing, is that all aligned where you'll be able to get your forecast to the other economists in time for them to properly update their forecasts as well?
I think the answer is probably no. We just published our November forecast, and so that didn't give time to implement things. Our December forecast will likely come out, at least at the national level, the first week of December, and then it takes another week for the state to be produced. And so we'll have some thought pieces and things published before then that I'd be happy to share with the state economists putting these together. But it's not going to be baked into the actual forecast numbers yet because those were kind of in the process of election numbers.
Okay, so just to be clear, so they won't be the data won't be provided to the state economists because of timing, but in your forecast it will be, so a little bit of an apple and an orange?
I'm going to try to see how I can incorporate these in my forecast, but they also won't be based on like finalized forecasts from our side because we publish those externally as soon as we have them internally.
Okay.
So it'll be a little bit more of a estimation, thumb on the scale, trying to figure things out, what these impacts will be as we start discussing them more.
Yeah, understood. I understand the timing challenges. I just want to make sure we knew what we were working with. And then I guess maybe more this cycle than other cycles, the May forecast, the chance we get in May to relook at the forecast might be something that's got a bit more variability than it's had in the past, just because there is so much new impactful policy change that could come from the election results that could change the numbers.
Yeah, exactly. And I think we'll know a lot more by May also, just in terms of, at this point, even in December, it's all speculation. We might have concrete legislation and executive actions and things to account for in May.
All right, thank you very much.
Thank you.
Okay, next is agenda item 6, a presentation of historical taxable sales and gaming market statistics. Mr. Nakamoto.
Thank you, Madam Chair. Members of the Economic Forum, for the record, my name is Michael Nakamoto. I serve as Chief Principal Deputy Fiscal Analyst with the Fiscal Analysis Division of the Legislative Counsel Bureau. And so for this agenda item, historically what we do is based on requests from previous Economic Forum members in previous cycles, we have put together a series of tables and charts relating to taxable sales and gaming. We don't print them out. We can print them out for the members of the committee at their request or anybody in the public who wants to contact us. They are, however, available on the Legislative Council Bureau's website for this meeting in Nellis. And so basically what we've done for this meeting is for the taxable sales and gaming information. We updated the tables at the last meeting through the first month of FY25 for sales tax for the taxable sales, and it was through the third month for the gaming percentage fee, as well as the FY24 statistics or commerce tax statistics through FY24. So we don't have any more information for commerce tax, which is why it's not included in the list here, but the rest of those sales and gaming charts have been updated to incorporate the most recent month. So it's through August for sales tax, and then the fourth month of FY25, which is through September for the gaming percentage fees. So those are available for you. You can review them at your leisure, and if you ever have any questions, you can feel free to contact us. And again, if anybody, any of you or anybody in the public would like printed copies of all of that, they can reach out to our office and get those. So thank you. That's all I really had on this agenda item, Madam Chair.
Thank you. So now we'll move into agenda item 7, where we get the presentations on the preliminary forecast for the major general fund revenues. If each of the presenters at the beginning of your presentation, if you could just give us a general overview of the broad assumptions or underlying outlook that's included in your forecast, that would be helpful. It doesn't have to be for every revenue source, but just at the outset, kind of what is the key assumption underlying your forecast? I mean, something in terms of trends in the economy or views on recession, whatever it might be, that's kind of an overarching, having an overarching impact on your forecast. That would be helpful. So with that, we will dig in with the gaming percentage fee tax.
If I can, Madam Chair, before we start with gaming percentage fee and have Mr. Lawton and Mr. Solorio and Ms. Powers come up for that, I just wanted to go through and give an overview of the tables that are in the Economic Forum packet under the tab for Agenda Item 7, just so that all of you, as well, all of you have a refresher on the information that's being provided, as well as for the members of the public who may be watching the meeting on Nellis, and I believe there may actually be people watching the meeting. But starting on page 57 of the Economic Forum packet is the first of 5 different tables that we include for this agenda item. And the first one is Table 1, again on page 57. And this gives the actual collections for each piece of the State General Fund, everything that is under consideration by either the Economic Forum or the Technical Advisory Committee, which we'll go through in the next agenda item, for FY22, FY23, and FY24, as well as the year-to-date collections through October 31st for both FY24 and FY25. So this is, in terms of actual revenue, this is the latest information that we have. We will, for the December 2nd meeting, even though it's kind of tight in terms of getting the information prepared, we will have an updated table, one with the revenue, actual revenues through November 30th of FY24 and FY25. The members and the public may not see that, though, until the day before the meeting or the day of the meeting, because we actually have to wait until the beginning of the month to get that information and put it into the table, so that it will be available to you. It just may not be available to you as quickly as we might like to, and that has nothing to do with anything other than just the calendar is the way that it is. So then turning to page 67, this is Table 3, and Table 3 gives the forecasts for each of the revenue sources, and this is both the major and the non-major revenue sources by fiscal year and then by forecaster. And so you can see on page 67, for each fiscal year, there's an individual column for the agency, for fiscal, and for budget. And so the agency is the relevant agency who collects or administers this revenue source. Fiscal is the Fiscal Analysis Division, our office, and then budget is the budget division over at GFO, and that's Mr. Solorio and his forecasts. And then turning to page 77, this is a more summary table, Table 4, which gives information about the major general fund revenues that are under consideration today or that will be presented today. And so this is rounded to the nearest millions with some decimal points trailing behind that. So this gives information on the FY24 actuals as well as the forecasts for FY25, 26, and 27 from each of the forecasters, and this includes Moody's for the gaming percentage fee and the sales tax. And there is a column or a row there listed for Economic Forum for each of these revenue sources. This is the Economic Forum's approved forecast at the May 1st, 2023 meeting for FY25 only, and that's just there to provide reference as to how are the forecasts changing compared to what this body considered and approved at the last meeting during the last legislative session. The next table in the packet on page 81 is Table 8. And this is the table that we've started putting together that we actually have both inside the packet as well as outside the packet on the green paper that you can see here, and all of you have a copy. And so for anybody who may be looking at the packet online or in Nellis, or for that matter, any of you, the version of Table 8 that is in the packet has a typo that we ended up having to fix. The corrected version of it is on the green paper, so if you want to refer to this one that has all of the forecasts listed again by forecaster by fiscal year, this has the correct version. There was a formula error relating to a percentage change on the old version. But this is the one that we refer to, or that we will keep referring to. It's set up so that when we get to the December meeting, we'll just simply add everybody's forecast to it, so you can see not only the changes in each fiscal year, but you can see the changes in the forecast as well for each of the forecasters. And then in the May meeting, we'll do the same thing, and you'll have all of the forecasts for all of the major revenues that you're considering on this. And so this actually includes everything that is on the agenda today, including interest income. We have added that. So this is available for you as kind of the easy reference. And again, I would suggest that you follow along using the version on the green paper, but it is still in the packet. And then lastly, page 89 has Table 9. And this is not normally a table that we have for the November meeting. We usually wait till the December meeting for this. But what Table 9 does is show, based on the year-to-date actual collections for each major revenue source for which we have information available, compared to the growth or the collections in the same periods from the previous 2 fiscal years. What was the average growth in the tax during the remainder of the year, last fiscal year, and then what is the growth that is needed for each of the forecasters to achieve their forecasts during the current fiscal year? So normally we don't put this together until December, because we'll have the quarterly information for the MBT, the insurance premium tax, the real property transfer tax. But this time I thought it was probably beneficial to the members that you could see the information for the monthly tax revenues that we have information for. So the 2 months of sales and use tax, the 2 months of the non-gaming portion of the live entertainment tax, the 3 months of the gaming portion of the live entertainment tax, and then the 4 months of the gaming percentage fee, just so you can see, based on what the actual collections are, the forecasts that are being presented today, what is the average growth in each month or till the end of the year that needs to be achieved to reach that forecast. So that information is there for you as well, just kind of as a reference, so you can kind of gauge what really needs to, when the forecasts are being presented, at least for FY25, what does it actually mean going forward between now and the end of FY25 to achieve those forecasts. So with that, Madam Chair, I think we can have Mr. Lawton, Mr. Solorio come up, and then when we get to fiscal, I'm going to give that brief overview that you requested, and then I'll turn it over to Ms. Powers to do the forecast for fiscal for the gaming percentage fee. Thank you.
Good morning, Chairwoman Rosenthal and members of the Economic Forum. For the record, my name is Mike Lawton. I'm the Senior Economic Analyst for the Nevada Gaming Control Board. It's my pleasure to be here today. During my discussion, I'll be referring to a set of charts of which you guys have already received a copy. Real quick, in terms of forecast methodology, when we forecast percentage fee collections, we first forecast gaming win with for the applicable fiscal years, and then we convert that gaming win into taxable gaming win. And then lastly, we convert it into percentage fees. We project growth rates for each of the state's 16 individual major markets, such as downtown, the Strip, Las Vegas locals, Elko, Reno, et cetera. In these forecasts, we incorporate any new property openings, property expansions, and known or anticipated closings into our model. This is done through a review of historical data and trends, and most importantly, through interviewing some of the individual properties in the various markets. We also get input from several Wall Street analysts and from the research department of the Las Vegas Convention and Visitors Authority. The sum of these individual market forecasts produces an estimate of total statewide gaming win, and within these markets, we also forecast slot win and games win separately. To your question, Chairwoman Rosenthal, I would say the outlook through discussions with several operators in markets across the state is stable. I would say with the caveat of my forecast has moderate growth in 26 and 27. And we're going to get to the meat and potatoes of this forecast here shortly, but a definite reset in FY25 compared to FY24. And I'll explain why here very shortly. Before I get into actual gaming win forecasts, I wanted to discuss with you some recent trends related to Baccarat. I feel it is important for the forum members to see, due to the considerable amount of attention there has been recently, relating to difficult comparisons linked to Baccarat win amounts being driven by hold percentage. So this first chart here displays Baccarat volumes, and during FY24, Baccarat volumes totaled $9.1 billion. It was a steady increase of 9.7% or $803.9 million over last fiscal year. As you can see, Baccarat volumes have been steadily increasing post-pandemic. However, they remain quite below the peak level that we established in FY14. They are down about 23.7% or $2.8 billion from FY14. Currently, Baccarat volume is down 1.3% or $37.6 million. That's not a concern. We could flip that in a positive direction in a weekend. So not too concerning there. So the next chart, a little bit of an eye-opener. This displays Baccarat win totals. And as you can see in FY24, there was a large spike in the win amounts, which set a new all-time record of $1.65 billion, which was 42.9% or $494.5 million over FY23. The win amount was even higher than the peak level that we recorded in FY14 of $1.6 billion. It beat that number by 2.2% or $36 million. So the $494.5 million increase that Baccarat recorded in FY24 was 84% of the $587.5 million increase that total gaming recorded in FY24. So almost all your growth came from one game. Fiscal year to date, where we are at now with Baccarat, we're down $175.8 million or 31.5%. We're not going to make that up in a weekend. The next chart is going to explain how did this all happen. And you're going to see the hold percentage in FY24 was 18%. This established the highest hold percentage recorded by Baccarat in the last 20 years. Not including FY24, the average hold in Baccarat for the past 10 years is around 13%. Fiscal year to date, where are we? 13.65%, kind of where you'd expect it to be. Last year at this time, we were at 19.66 through December. I've presented to several of you members over the years, and it's like a dead horse. You guys understand that this game is volatile. Large swings can occur due to the large amounts wagered by a limited number of customers. However, based on my research in FY24, which included discussions with multiple industry representatives, the hold percentage recorded in FY24 is not sustainable. Simply put, Baccarat ran extremely lucky for the house in FY24. Now, there have been some structural changes to the game. There's additional side wagers that are offered, and customers are being allowed to make much larger maximum bets than when I was a baccarat dealer in the 90s. These two factors will increase volatility. However, there's not enough structural change in that game that would support a 30.4% increase in hold between FY23 and FY24. So, big picture, in addition to the gaming win totals that we benefited in, the state's percentage fees also benefited from the spike in hold. So if you were to apply a normalized hold percentage to baccarat volume totals in FY24, you'd estimate percentage fees increased to the tune of about $25 million, which accounts for the majority of the $29.8 million increase recorded in percentage fees in FY24. So the point I want to make is although what we saw in FY24 in baccarat could be considered what was described to me as a loan that we might be having to pay back this fiscal year, I want all the forum members to understand, the baccarat houses that I talk to, the game's healthy, the business is healthy. However, it remains very concentrated and it remains extremely volatile. So that's not going to change. I thought it was important for you guys to hear this, and moving forward now, I'll get into our gaming forecasts. And the next chart outlines the total gaming win forecast for the state. We also are providing one for the Strip and the balance of Clark County. So for FY25, gross gaming win is forecasted to total $15.6 billion, which is a decrease of about 1% or $156.9 million versus the all-time record of $15.72 billion established last year. As you can see, the state has recorded all-time records in gaming win in 3 consecutive years going back to FY22. Fiscal year to date, the state is down 1.2% or $59.6 million. And for the remaining 8 months of FY25, we're facing a growth rate of about 5%. The comp for baccarat over the last 8 months of the fiscal year is a volume increase of 14.1% or $778.6 million, and an increase in win of 53.5% or $379.1 million on a hold percentage of 17.3%. So very difficult comp. And I also want you to understand the next 2 quarters represent the highest gaming win totals in state history. So fourth quarter FY23 was the highest gaming win total in state history. First quarter FY24 was the second. So that's what we're up against. In FY26, excuse me, I wanted to make another point. The decreases noted for the first 4 months of the fiscal year are obviously related to baccarat. I've already discussed that. What I want you also to understand is if we exclude baccarat from the total, which I do constantly to let everyone breathe, if you exclude baccarat from the gaming win totals, we're up 2.5% or $116.2 million. I consider that healthy. Who wouldn't take 2.5% growth off of all-time records? So that's healthy. So the factors that go into this forecast that we're showing this decrease include a potentially slightly weaker second Formula One race, and it's related to hold. I think the credit lines are there. I think the players will be there. I just don't know if we're going to hold baccarat at 18.9% in November. A February 25 that doesn't include the Super Bowl. Everyone knows that. That has to be baked into the forecast. We're not going to replicate that event. We lost the Mirage. The benefit of the Durango and Fontainebleau Las Vegas, that gets annualized in December of this year. So that growth that we're getting from them, that all of a sudden becomes difficult to drive moving into December. And then, of course, the baccarat comps that I have discussed with you already. So those are kind of the factors in why we're seeing a slide in FY25. In FY26, you come back, and gaming win, we're expecting it to grow, $15.68 billion. That's an increase of 0.7% or $113.2 million. And then in FY27, we're looking at gaming win totals to come in at $15.86 billion, which is an increase of 1.1% or $179.1 million from FY26. We're not anticipating any major new property openings during the forecast period. I believe the Hard Rock, everyone is looking at the Hard Rock. If it opens, I'm penciling in that in for the very beginning of FY28. Over the forecast period, growth is being driven by gradual increases to slot win and a stabilization of game and table win after the hold-driven record set in FY24. The next slide is our forecast for the Strip, which is interesting because the Strip is showing a larger decrease than the state, but we'll get into why that in a second. Forecasted gross gaming win for the Strip in FY25 is $8.77 billion. That's a decrease of 2.8% or $249.2 million compared to the all-time record set last year of $9 billion. Similar to the state, the Strip has set 3 consecutive record gaming wins going back to FY22. Fiscal year to date, the Strip is currently down 4.4% or $131 million. An unusual statistic to point out is that through the first 4 months of the fiscal year, if you take the statewide gaming win and you remove the Strip, the state is actually up 3.3% or $71.4 million. Not surprising to the overall theme of this discussion today, baccarat is responsible for the decreases being recorded on the Strip. For example, fiscal year to date on the Strip, slot win is up 1.8% or $27.5 million. Games win is obviously down 11.3% or $158.6 million, but that's because of baccarat. So if you strip baccarat away, table game win excluding baccarat is up 3.3% or $28.5 million on volumes, which are up 1.2%. So all those metrics are very healthy. And total gaming win on the Strip, excluding baccarat, is up 2.3% or $56 million. For the remaining 8 months of FY25, the Strip is facing a growth rate of 6.5%. So then we get into FY26, and again, we're forecasting growth. The Strip's gaming win will total $8.9 billion, which is an increase of 1.4% or $126.2 million. And FY27 growth again is forecasted with a $9 billion gaming win, and that's an increase of 1.3% or $113.4 million over FY26. The next chart is the balance of Clark County. I usually do not present this chart to the forum. It's a very important market, don't get me wrong. It's the state's second largest market outside of the Strip. I think it's important for you to see this just because what is currently driving gaming increases in the state is coming from this market, or the majority of it is. So I just wanted to point that out to you. Fiscal year to date, the balance of Clark County is currently up 11.5% or $63.7 million compared to the all-time record that was established last year, which was $1.8 billion. As I had mentioned earlier, statewide gaming win excluding the Strip is up 3.3% or $71.4 million. The balance of Clark County is responsible for close to 90% of that growth, about 89% of that growth. The balance of Clark County, why is it doing so well? It's benefited from the opening of the Durango station, bottom line, and they opened in December of 2023. Additionally, the balance of Clark County benefits from record levels of employment like the rest of the state. It also benefits from continued population growth and then an improved mix of higher income earners that are moving into the area. So as a result of all this, fiscal year 25 is forecasted to come in at $1.92 billion. That's an increase of 5.7% or $104 million over FY24. For the remaining 8 months of the year, the balance of Clark County is facing a growth rate of 9.5%. So you'll notice in FY26, our growth trajectory is expected to moderate to 1% or $1.94 billion in gaming win, which is a $19.7 million increase. Not super impressive, but this moderation in growth is the result of a full year of annualization of the Durango station. Then in FY27, gaming win is forecasted to total $1.96 billion, an increase of 1.4% or $27.4 million over FY26. So the next slide is our slot win forecast. Slot win has been steadily increasing post-pandemic and has continued to set all-time records going back to FY22. Look, difficult comparisons, record levels of inflation, rising interest rates, these have not impacted slot win totals. And we're not being given any indication that there's any imminent softness on the horizon as customer behavior has remained stable. As a result, we are forecasting continued moderate growth for the forecast period. Currently, fiscal year to date, slot win is up 1.8% or $61.4 million on volumes which are up 1.3% or $633.9 million. The comparison over the remaining 8 months of the year is an increase of 2%. FY25, we're looking at slot win to come in at $10.48 billion, which is an increase of 1.2% or $124 million over last year's all-time record of $10.35 billion. In FY26, slot win is forecasted to total $10.55 billion, which is an increase of 0.7% or $70.1 million. And then 27, we're coming in at $10.67 billion. That's an increase of 1.1% or $120.5 million. Next, you'll take a look at our game and table win forecast. Similar to the slot win, game and table win has recorded all-time records in 3 consecutive fiscal years as well, going back to FY22. These game win totals, in my opinion, have been very impressive over this period when you consider a key component of Baccarat win, a key component of table game win, which is Baccarat, has not reached record levels until last fiscal year. For FY25, we're forecasting game and table win to total $5.1 billion. That's a decrease of 5.2% or $280.9 million compared to FY24. Fiscal year to date, game and table win is down 6.9% or $121 million, and volumes are up 1.3% or $141.6 million. The comparison growth for Baccarat over the last 8 months is pretty difficult. We're looking at an increase of 11.4%. Baccarat's comp is 53.5% growth, and then non-Baccarat game and table win is basically flat, a decrease of 0.4%. Moving into 26, we're again forecasting growth. Games win of $5.13 billion, which is an increase of 0.9% or $43.2 million over FY25. And then in 27, games win is forecasted to total $5.2 billion. That's an increase of 1.1% or $58.6 million over FY26. I would say similar to slot win, the business activity the state is experiencing games and table wins remain solid. Excluding Baccarat, that's a whole other story. And there's several contributing factors which we believe will cause games win to record a decrease in FY25 before these totals can stabilize and we begin to see growth again. And obviously, I've discussed these factors, and they all kind of fall into table game play, right? We have very difficult Baccarat comparisons on the strip. That's table games. The slightly weaker Formula One race in November related to hold, that's on a table games kind of comparison. And then the Super Bowl in FY25 that we don't have. Mike, I wish we could have that every year. That'd be fantastic. I think that's going to be more skewed to tables than it is for slots, just the kind of business that was brought in for that game. So those are the reasons why you're seeing this softness in 25. I wouldn't call it softness. Maybe a reset in 25, and then I think we can grow off that. But I think we're definitely going to have to see some resetting in FY25, especially on the table game side. So next, you'll get into the taxable gaming win forecast. As I stated, we can convert this gaming win to a taxable gaming revenue. This chart obviously follows a similar trajectory as our total gaming win forecast. We're looking at revenue to come in, taxable gaming revenue to come in at $14.88 billion. That's a 1% increase or $154.4 million compared to FY24's all-time record of $15.03 billion. Fiscal year to date, obviously taxable gaming revenue is down 1.5% or $72 million, similar to gaming win. The comparison over the remaining 8 months of the year for TGR is an increase of 4.1%. The one thing this chart doesn't display, and this kind of drives the whole taxable gaming revenue, is the ratio between gaming win and taxable gaming revenue. And that's currently sitting at 95.6%, which is down slightly from where it was last year at 95.91%. We're forecasting that ratio to come in at 95.57 versus 95.60 that it came in last year, so a slight decrease. And then we have it continuing to decrease in FY26 before we have it coming in for a slight increase in FY27. Now, this key ratio has been decreasing post-pandemic due to sustained increases in the total amount of credit issued each fiscal year coming out of the pandemic. In FY26, we're forecasting an increase of taxable gaming revenue of 0.7% or $99.4 million with $14.98 billion in TGR. In FY27, continued growth of 1.4% or $206.1 million with $15.18 billion in taxable gaming revenue. So take a breath. With all that being said, the brass tacks here and percentage fee collections for the biennium. In FY25, obviously not a surprise, we're forecasting $972.1 million in collections. That's a decrease of 2.8% or $27.9 million from FY24's all-time record of, let's just call it $1 billion, $999.9 million. Currently, fiscal year to date, with 4 months reported, total percentage fee collections are sitting at $320.2 million. We're down 3% or $10 million. The comparison over the last 8 months of the fiscal year is an increase of 3.9%. So as you know, there's 2 components that make up percentage fee collections. We have percentage fee collections on taxable gaming revenue, and then we have the estimated fee adjustment. Fiscal year to date, percentage fee collections on TGR are at $317.4 million. Those are down 1.9% or $6 million. For the forecast, we're looking at a total of $970.2 million, and that's a decrease of 1.1% or $11 million. The estimated fee adjustment fiscal year to date is sitting at $2.8 million. That's down 58.3% or $4 million. The EFA is forecasted to come in at $1.9 million and decrease $16.9 million or 90% compared to last year's $18.7 million in EFA collections. So if you're scratching your head, which I think everyone does when you start talking about the EFA is the difference between the amount of tax due on taxable gross gaming revenue for the current month, less the amount of tax paid on taxable gross gaming revenue from 3 months prior. As gaming revenue growth begins to slow or slightly decrease, as we have forecasted, EFA totals are expected to moderate as well. In FY26, the board is forecasting percentage fee collections of $980.8 million. That's an increase of 0.9% or $8.7 million. In FY27, the board is forecasting percentage fee collections to total $992.9 million. That's an increase of 1.2% or $12.1 million. And that concludes my discussion, and I'll be happy to answer any questions that you might have.
Thank you. Brian Gordon for the record. Take a sip of water and take
Yes.
a breath, Mr. Lawton. Thanks for walking us through all of that. Obviously, you have your finger on the pulse of what's happening in terms of the gaming market. And it sounds like you have a lot of conversations with folks in the industry, and you're getting feedback in real time from, I'll call it, operators and others within the industry, is my sense. The conversation about Baccarat is super helpful and insightful and gives us something to definitely think about. When you are, obviously the hold adjustment that is required because of this anomaly that happened last year, I think that makes sense, and your commentary is helpful there. How should we think about, or how do you think about this international versus domestic play that takes place on the table game side? And I don't need a specific number, but we have yet to see the international consumers come back at the level that they once were at.
Yeah.
I think we're seeing more visitation source to domestic travelers. That international component, I think, historically has been a pretty big contributor to what happens on the high-end table game segment. How should we think about, or how do you think about the impact of that going forward? We'll continue to see some of those international travelers continue to come back, but that's going to be partially offset from these record-setting hold percentages that we've seen. Is there a dynamic there that is sort of just factored into the back of your mind as you put together your forecasts?
I don't take it into consideration in building my forecast, but those are great observations. And I've been scratching my head about Baccarat play coming out of the pandemic. Because to your point, where's all the play coming from? These people aren't coming from Asia. They can't even get here. There's been a significant shift in that Baccarat play to domestic Baccarat play. And there's even some kind of international domestic play, if you will, that's playing the game. And there's also other parts of the world that are traveling to Vegas quite well, Latin America, Europe, and those players are kind of, offsetting this hole that's Asia that hasn't been filled. And I don't know that it's going to be. Quite honestly, conversations you have with executives on the Strip, money transfers out of Asia, that might not ever come back. So if you're thinking that, that play is all of a sudden going to appear poof, I don't get the impression that it is from the operators. They've moved on. and know your customer and money transfers out of Asia. That's not easy. It's not like when we looked at those record levels of baccarat volume in FY14. That was kind of back in the good old days when that relationship, that symbiotic relationship between the Asian operators and the resorts in Las Vegas, and it was much easier to move money around. It's kind of changed.
Okay. No, that perspective's very insightful. One other question related to the balance of Clark County submarket that you walked through. The conversation about the opening of Durango, we're now coming up on the 1-year anniversary, so we're likely not to see as much growth in that particular area. That is the data you walked through is specifically for the balance of Clark. It doesn't include the other sort of local segments. Fair enough. I realize on their own they're smaller, but in aggregate the Las Vegas.
Yeah, it doesn't, and I think when you look at the Las Vegas locals, and I want to get this point out there, certain markets lean more to mid-level, low-level grind, and if you're a market, and this is not coming from me, this is from discussions with operators, when they're more in line with that mid-level, lower level, growth is going to be challenging. If there's any and we all know this, obviously, if there's any market segment in any business that's hurting or pulling back, we know where it's coming from. They're stretched to the max with inflation and all the other things that everyone's been dealing with. So I think those markets, North Las Vegas obviously leans a little more towards not as high as what you're seeing at Durango and Red Rock. I think Boulder Highway as well, and there's some other impacts in Boulder Highway with some remodels and road construction that I was made aware of that I didn't know that are going to impact some resorts there. So yeah, I think the growth is going to come more from the balance of Clark County. Durango's going to open up an expansion here pretty soon, I think in 26. I think some of the loss of business that Red Rock has experienced, that's going to get backfilled with. They're going to try to backfill some of that growth that they lost. They knew they were going to lose that business to their own property. But yeah, I kind of concentrated more on balance of Clark County than I did the other two markets.
Okay, no, that's great. And just the balance of the state, outside of the sub-markets that you focused on, I think obviously these are the big drivers, but just stability is the theme going forward?
I think some stability, but also to the point I made, for example, Carson Valley, where I live, I pick up the phone and I've got a good friend that runs the largest casinos in the valley. And, what's your outlook? And he's like, it's going to be tough because of, they cater to a mid-level, grind kind of customer, and those customers are stretched. I think some of the outlooks when I talk to operators in Elko and Reno, and, although they do have some high-end play that's kind of keeping them above water, they're concerned about that mid-grind level play too that's going to fall off, and they need that as well. So I think the outlook for the balance of the state is maybe a little bit softer than you'd see from the Strip. And not that the Strip was, telling me, hey, expect 5-10% growth. They weren't. They're saying, look, it's going to be tough. We're hoping to get 1% and 2% growth, and we're going to try to control margins. That's our goal. That's how we're going to remain profitable. So that's kind of. Look, the sky isn't falling. If you're asking me, did anyone tell me that? No, not one bit, which is good.
Yeah, no, stable is great.
Yeah.
Obviously, the forecast assumes the broader economy is humming along at some reasonable pace of growth. If something were to change at the national or global level, that would affect these forecasts.
Yeah, of course.
Yeah, of course. Great. Thank you.
Welcome.
It looks like we talk about risk in our forecast as to, what's a risk that you're not going to measure up, particularly on the, have revenue less than anticipate. I take it from your discussion that the risk almost entirely with baccarat, if you exclude everything else, that appears to be a very stable.
Yeah.
Very stable growth, and our risk is fairly low. So on this particular tax, we have one thing that's causing the risk. Is that an accurate statement?
Yeah, every month when these numbers come in, the first thing I look at is, what did baccarat do? Because that's going to determine, the fortunes of the state in terms of percentage fees. I think the risky thing would be for us to do is to assume Baccarat is going to hold 19% from here until eternity. I've asked this question 100 times. What's going on, guys? And, of course, they're surprised. And the bottom line is no one told me, yeah, the game's changed so much structurally that we're going to start holding 19% every year. I think it's going to tick up because of the structural changes that we've talked about with the side bets and some higher max bets that are being allowed to be made. But that could also swing the other way, right? So, we might be able to drive hold a little bit, but not the 18%. And if I'm wrong, I'm wrong. But I'm only as good as the information I'm gathering, and I'm not being told that. So the risk would be to assume that's going to continue. And this forecast did not assume that was going to continue to happen.
I know my own feeling is if we're going to say, we obviously don't know what it's going to be, that's clear. But I would prefer to forecast under what it's likely to be than to forecast over what it's likely to be.
Yeah.
Because the risk on the state, if we forecast way over, they incur and spend money that they don't eventually have.
Yeah.
The other way, of course, they build up the ending balance, but that's still nowhere near the risk that we take on the other side.
I'm gonna offer a Yogi Bear quote. Predicting is hard, especially when you have to predict the future, right? I've always, well, not always, I think over time I've learned the conservative nature of the Nevada Gaming Control Board is to forecast conservatively. I try to do that when I'm working with models and talking to operators. I try to take everything with a grain of salt and not necessarily come out guns a-blazing and, the sky is blue and this is going to last forever. But I think this is a good forecast. I really think the way someone described it to me, we got a little bit of a loan in FY24. FY24 was better than perhaps it should have been, and we might have to pay that back a little bit in FY25. And sure, that's going to be painful, but I'm pretty confident we can grow in 26 and 27. But I think there's got to be a reset in FY25, and I think you guys knew this coming in. Super Bowl, first F1, the events were just so strong. And then on top of that, the hold. You had 2 new properties, Fontainebleau, Durango. I mean, it's going to be tough to replicate that in FY25, in my opinion. And in the opinion of several of the operators.
I say myself personally, I was very happy to hear your presentation that the rest of the market, other than that one thing, is fairly stable. And that bodes well, I think, for the economy of the state.
I would agree. I feel very good about slot revenue. Non-table game revenue is healthy. Yes.
So Linda Rosenthal for the record. So we talked a lot about the hold, but can you explain or describe what your assumptions are for Baccarat volumes in the out periods? Your chart has the actuals, but for...
Yeah. I don't do a Baccarat forecast specifically for that game now that Matt Maddox is no longer the chairman of the forum, who actually required that from us. I would say in my outlook for volume for Baccarat, talking to operators, and I wanted to make that point to you, it's healthy, okay? It's healthy, it's concentrated, and it's volatile. So what that tells me is volumes are healthy. There's no reason to think that Baccarat volume is going to fall off. Maybe a little bit in FY25 because of the Super Bowl and F1, and maybe have a little bit of a fall off, but 2, 3, 4, 5%. I mean, and then grow from there. I don't think there's an outlook that I was told that we're going to have difficulty driving Baccarat volume. Resorts are deploying capital to attract these customers with new rooms, better amenities. So they are definitely in the business of attracting this play, and I can tell you they all want to get their share. So I wasn't given any indication that the volume is off or going to be off, if that helps.
But when you do the math to put together your forecast, is the assumption then the volumes are stable?
Yes.
Or? Okay.
Volumes are stable. Hold's not going to replicate FY24.
So to the extent, I understand your point about Asia, but to the extent you do get more of a return of the international player that tends to play more baccarat, there could be some conservatism in that assumption.
Could you repeat the question?
I was just saying, so your assumption is stable volumes in
Yes.
baccarat. To the extent the international player does return,
Mm-hmm.
China or outside of China, whatever it might be, but we get those increases in international visitor volumes, which tend to play baccarat, there could be some conservatism in your forecast, since you're not really forecasting for that. Is that correct?
Yes, I would agree that I didn't take in, I mean, to somewhat, but I don't know that it's enough to move the needle necessarily. I didn't get the feeling from Mr. Hill's presentation, that might come back right away. I felt like there was some sales efforts in the convention side, and they know that's weak and it needs to grow, but why hasn't it already started to grow? Why haven't those visitors already come back? The world's open, right?
Yeah, but again, I mean, is your convention visitor really your baccarat player?
No.
No, yeah.
No, but to your point, I think it's not just the convention side, that international baccarat player component, that hasn't returned either.
Right.
So,
That was my point. So if it were to start to return, and I
Yes.
understand it's largely driven by China, and I
Yeah.
completely get your points on China, but if it were to begin to return, then there's some conservatism in your
yes,
forecast. Yes. That's what I just
absolutely.
wanted to okay,
I'm always going to try to lean conservative on baccarat.
understood. Thank you. Mr. Crum?
Michael Crum for the record. So I'm going to jump on this baccarat thing again as well.
Great.
Well, and only because you spent the majority of the beginning talking about, the volatility in baccarat, which I totally get and I understand. So I was going to ask the question about your forecast on volume. Because it is such a large component, especially given our forecast coming up, I know you said Matt asked for it before. I think we need to see baccarat volume kind of teased out separate from the rest of it, so we can understand what the assumptions are for Bach, because it's not the win, because I understand that's very volatile, but
Yeah.
the actual volume piece, I just don't know how, because it's such a large component, how we can, look at the forecast and really, do our piece without seeing that baccarat tie out, because it is so volatile. Now, another point, I'll let you address that, is I do agree with your conservatism of moving the Bach, hold back to what it has been historically. And I think we all know as a committee that, it could actually swing the other way. And if we really wanted to be extremely conservative, we would go even below the historical hold, which I'm not recommending.
No.
But that risk exists as well, if you call it a loan, and if maybe the loan all comes due next year. But I doubt that happens. But again, going back to my original point, is I think we have to see this volume for baccarat in order to tease out this forecast. And again, that was the question I was going to ask. The chair
I'll be happy
as
to
well.
break out my mathematics baccarat forecast for you. I'll have to dust it off a little bit, but it's something I could definitely provide the group.
Yeah, and just the volume.
Not today, but
Yeah, not today. Maybe it's for the December meeting. I don't know, but
Yes,
it
I
would
will-
be the table in with and without Bach. I think would be with obviously tying back to your volume, which is driving your win piece.
Yes.
As well.
give me a project. Thank you.
Yeah, I knew that was when you said Matt asked for it before. I knew that was going to be that, but
Shouldn't have
really
said
not
that.
asking for it other
Yeah,
than I
you
think
got
it'll
it.
help inform
course.
our decision.
Thank you very much.
You're welcome.
Madam Chair, before we move on to Mr. Solorio, staff needs just a second to take care of an issue, so if we can pause for just a second.
Sure.
While we do that, and then I'll switch to Mr. Solorio's forecast.
Okay, we'll now turn to Mr. Solario for the forecast from the GBO.
Good morning, committee members. I'm Dr. Mauricio Solorio, and I'm the new executive branch economist for the Governor's Finance Office. Okay, I'm going to be presenting my forecast on gaming percentage fees. Let me just figure this out. Okay, so my approach was completely different from Mr. Lawson due to my lack of information and experience. So I went ahead and took a look at the historical revenue of the gaming percentage fees. And for what I found on my analysis on the historical data of the gaming percentage fees is that this gaming percentage fee has been very stable over the years. Now, here on the graph, you're going to see this red rectangle in most of my graphs, and this red rectangle shows the time where we had COVID restrictions put into place that begin around 2020, those restrictions that we all missed and loved with the face mask and being 6 feet apart and everything, okay? So it goes from March 2020 to around April 2021, okay? Now, as we can see, pre-pandemic monthly average revenues, let me see if I can, is it going? Oh, yes, the little animation. It's been around $58.5 million of monthly revenues from July 2005 to March 2020. Then after the pandemic, we saw an increase of the average monthly revenue to $82.2 million, okay? Now, one of the things I want to talk about my forecast and the main limitations that I was having with this is that my forecast is mainly based on the amount of visitors that we're getting on the state of Nevada and the population growth of the state, along with disposable income from the people who live in the state of Nevada and the disposable income nationwide, because I took into consideration that majority of the visitors that we're getting from the state are domestic visitors, so I'm taking into consideration the disposable income of the domestic market in the United States. Now, the main limitation that I had with this approach is that I do not have any information on how many of these people who visit the state of Nevada gamble, because that's a reality. Not everyone who comes to the state gambles, all right? There's people who come here to watch a soccer game and that's it, or go to a Taylor Swift concert and that's it. I did not have any information on how many they gamble and what was the average amount of money that these people put into the table. I just couldn't figure that out. So this forecast is mainly driven by visitor volume and disposable income, okay? So once I put my forecast into the historical trend from April 2021 to October 2024, my monthly revenue, my monthly average revenue increases to $82.2 million. This is an increase of $4.5 million on monthly average revenue, and the forecasted, monthly average revenue from November 2024 to June 2027, it's around $92.8 million. This translates to an estimate, a physical estimate for 2025 of $1.03 billion in gaming percentage fees, of $1.06 billion on revenue for fiscal year 2026, and 2027 is $1.08 billion. So I am forecasting some growth, but after seeing the Michael Lawton presentation, I think this is just not, probably not realistic. But that's the main limitations of my model, is that I'm basing it based on visitor volumes and disposable income. Thank you.
Thank you. I mean, in all fairness, I think historically the forum has tended to lean towards the agency's forecast because they have such rich information. Mm-hmm. But it's always good to have the different perspectives and see what the different economic models come up with using the different assumptions.
Yes. Thank you.
Any questions from anybody? Okay, great. So then we'll turn to the fiscal division's forecast. Ms. Powers?
Actually, Madam Chair, Michael Nakamoto with the Fiscal Analysis Division, for the record. Before I bring Ms. Powers up, I think you asked the question, or had the statement at the beginning, to just kind of give an overview of what the economic assumptions were. And so Ms. Powers, Mr. Tower, Ms. Owens, and I will get into more detail as we go through all of our individual revenues. But just kind of, I wanted to give some general comments for all of you regarding our forecast. So as those of you who have been on the forum for a while know, that we have our fiscal forecast packet, which is probably a little thicker than the Economic Forum packet at this point. But we go through and we have write-ups on all of our forecasts. We provide information, assumptions, and things like that. But the first about 24 pages of this, it's pages 2 through 25, are basically the main drivers of our forecast. There's different variables relating to wages, personal income, employment, and then some of the housing indicators, as well as visitor volume and the consumer price index that we use. And they're not an exhaustive list of the things that we look at, but it's information that we do provide to you just so we're laying out where exactly we're at in terms of the outlook. And so I'm not really intending on going through all of that, but just more of a summary statement is if you look at the back of page 3, you can see that our total forecast for the general fund before tax credits, there's a little bit of growth in FY25 compared to FY24. It's about 0.3%. And so, I mean, that doesn't necessarily hold consistent with all of the revenue sources. A lot of them we do have some growth in, or there are a few that have some growth in, but you can, we see, for example, Ms. Powers' forecast for the gaming percentage fee, as well as like Mr. Towers' forecast for the sales tax, they're actually fairly weak. And there are some reasons for this that don't necessarily have to do with the economy. So I think the best thing that I can say is that our forecast is calling for moderate and stable growth. And that's kind of the overarching thing. There are going to be instances where we do have a forecast that goes negative in FY25, such as our forecast for the gaming percentage fee, which is taking into account the Baccarat issue that Mr. Lawton accounted for, as well as the fact that we don't have special events such as the Super Bowl coming up. I mean, there is some mitigation because the Super Bowl and the Lunar New Year fell on the same weekend last year. And so in essence, the way we're treating it is you almost lost the Lunar New Year because the people who would normally come to Las Vegas couldn't because they were probably priced out. But now having it on a different weekend without the Super Bowl affecting that might mitigate some of it. And so that's one of the things that we're kind of taking into account as part of the forecast. But it's the other issues that we're seeing, collection issues, other tax and policy considerations that are affecting revenues, both in a positive and a negative light. But we're also looking at kind of the economy in general. So the forecasts that we're presenting are really agnostic to the election. We're not saying that, oh, we're assuming that the election's going to go one way or the other. We're just saying this is what we think is the most realistic scenario going forward. And obviously the election is going to change things, but there are other things that are going on. And Ms. Mandel talked about the interest rate question on when interest rates are going to be dropping. And right now the Federal Open Markets Committee is meeting right now, and they're supposed to at some point right around now announce what the next rate cut is going to be.
I think they announced they dropped it a quarter.
Okay.
Yeah.
So apparently the last time I checked, they hadn't made the announcement. So thank you for the information. We'll adjust accordingly for our forecasts. But it's things like that, and it's like, okay, we anticipate these things are going to happen, but it's like, how are consumers, how's the economy going to react to this? And more importantly, when is the economy going to react to this? So a lot of it is timing. So we anticipate that when we get out into FY26 and FY27, we're going to be in a pattern of moderate and stable growth in a lot of these revenue sources. It's just how long is it going to take us to get there? And I think maybe in comparison to some of the other forecasters, we think it might be a little later, that it might take until the beginning of next year for interest rates to start dropping on houses and vehicle loans and things like that, that will eventually spur a little more taxable activity. But we're also looking at the fact that people are perhaps saving a little more money, and that's something that Ms. Mandel noted in her presentation, but also the people who are spending money and they are consuming, they may be consuming on things that aren't necessarily subject to our taxes, and that's a point that Mr. Levitt brought up with the room tax, but they may be purchasing, spending a little bit more on groceries, which are exempt from the state sales tax. They may be purchasing more or having to pay more for their insurance, which is going to show up in my insurance premium tax forecast, but it's less disposable income that they have for live entertainment or for sales tax or for some other things. So it's kind of this overarching thing that we kind of maybe look a little soft, but I don't think it's a sign of anything more than we're kind of at a point where we had a really good FY24. We're trying to go up against that in FY25, and in some instances it doesn't work out so well because of other external factors such as the lack of a Super Bowl. But then we kind of grow from that again. So with that, Madam Chair, I will ask Ms. Powers to come up and she can provide our gaming forecast. Thank you.
Good morning, Madam Chair and the members of the Economic Forum. Give me just a minute to get my presentation up. All right, I believe I'm there. Let me just open this up. Looks different than I looked at it earlier. Do you mind helping me? Control. Susanna Powers, I myself earlier, Deputy with the Fiscal Division. I will be the one for gaming percentage tax forecast. Our forecast starts on page 27. Our forecast, which includes seems like we're having problems. Oh, I got him. It's a ghost. Let's try again. The fiscal division's gaming forecast starts on page 27 of our forecast packet. It includes a summary of how the tax functions and what variables drive the taxable gaming revenue. I will briefly describe our forecast methodology, and start with Table 2 on page 31. So it will be coming down a couple pages. The fiscal division starts the forecast with the coin-in estimate derived by forecasting the coin-in per slot machine. We get the slot win by estimating the win percentage. And the slot win percentage has been higher than usual. We expect that to come down a little bit. Fiscal year to date, the slot win percentage is averaging around 7.13%. The history and forecast for the slot coin in, slot win percent, and slot win are summarized in this table 2. We repeat the same steps for the game and table market. We start with the drop or the volume for games and tables by forecasting the drop per game. Then we get the games and tables win after we have locked in a win percentage we are comfortable with. As you heard earlier, fiscal 25 game and table win percent hit an all-time high. We are expecting that to settle. Fiscal year to date, games win is averaging about 14.8%. Again, you can see the history and forecast in table 2 for the game and table segment. The way we do forecast for the gaming percentage fees is that we separate the slots and we have the game segment separately. We separate Clark, Washoe, and balance of state, but Clark County is the main driver for our statewide forecast. Since we were talking about Baccarat, I will just briefly talk about that. Baccarat in our forecast is not separated. It is included in the game drop, and it can vary to the extent of what kind of share it makes of the game's drop. It is been hovering around 25%. Lately, it's been as low as 20, as high as 30 if you go all the way back to the Super Bowl months. So it varies quite a bit, but it is considered in our gaming volume when we are forecasting. Next, I will be turning to Table 1A. It is on page 28 of our forecast packet. So I just went over the brief overview how we forecast slot and gaming segments. So once we have gotten those two segments buttoned up, we just sum them up to get to the total win. And then we determine the taxable gaming revenue, or also known as TGR, by estimating the TGR to win ratio. The last step is to estimate the effective tax rate, and you can see our assumptions in Table 1A. And the estimated fee adjustment, also referred as EFA, is an automatic calculation that just falls out. Next, I will go to Table 2B, and it is on page 29 of our forecast packet. This table also has our gaming percentage fee forecast, just like the previous table. So you can see it for the fiscal years 25, 26, and 27. This table shows the percentage fee collections on taxable gross revenue in column named percent fee dash TGR. The EFA, the estimated fee adjustment, is in the column percent fee dash EFA. And then the collections, the total percentage fee collections are in column named percent fee dash total. Table 1B also has the current fiscal year-to-date statistics for the key variables driving our forecast. I'm not going to say anything different that you haven't heard already, but I have to explain our forecast. In fiscal year 2024, we had an extraordinary fiscal year for gaming, as we have discussed. We had Formula One, the Super Bowl, other events and concerts. Currently, slot win is up by 1.8%. We see the slot win pull back some because we have those difficult comparisons against the quarters a year ago that will be hard to repeat or beat. Our fiscal 25 slot win forecast is pretty much flat over the fiscal year. Most notably, the early indicators signal that the upcoming Formula One may not be in the same demand as the previous one. We have seen headlines about lower room rates and even ticket prices, so we have taken that as an indicator that perhaps there's a slight pullback there as well related to even gaming revenue. And then, of course, the Super Bowl will not be there, so we are trying to true up against that year. The games win is down by 6.9%. Our forecast actually assumes an improvement, but overall we have it falling by 3.2% by the end of the current fiscal year. As said before, fiscal year 25 is going to be a reset year for gaming revenue. Our comparisons are harder in the coming quarters than what they have been so far. Our fiscal year 26 and 27 forecasts for the growth in slot win are similar to the period seen before COVID. However, they are more conservative, I would say. And the table game side is a little trickier as it can be swung by a baccarat play significantly. So our forecast takes that into consideration, and we have a modest growth in games win hovering around 2%. Fiscal 25 year-to-date, gaming percentage fee collections are down by 3%. Our forecast estimates that collection will decline by 3.2% to $968.08 million in fiscal 25, then increase by 2% in fiscal year 2026 to $987.92 million, and increase by 1.9% in fiscal 2027 to $1.007 billion. This concludes my gaming percentage fee presentation, and I'm happy to answer any questions you may have.
Sure if my mic not. Thank you very much. I guess next we'll move to the next tax, which is the live entertainment tax. For this presentation, if you're presenting gaming, is anybody presenting gaming and non-gaming? Just these two? Yeah. When we get to you, if you could present both, that'd be great. So then we'll need the non-gaming, is that Ms. Owens? Yeah, as well. So maybe we'll do gaming by Mr. Lawton, non-gaming by Ms. Owens, then we'll turn to the fiscal and budget. Did I confuse you? Yes, you. It goes in and out. Yeah. But it like randomly could. Thank you.
Ready? Again, for the record, my name is Mike Lawton. I'm the Senior Economic Analyst with the Nevada Gaming Control Board. The casino live entertainment tax is based on a forecast of taxable casino entertainment activity. The forecast of taxable activity is based on an examination of historical growth patterns and, most importantly, through a review of entertainment offerings and discussions with industry representatives. The forecast also incorporates expected increases in taxable activity due to the opening of new properties or changes in entertainment venues at existing properties. I say this every time I'm in front of you. The live entertainment tax is one of the more difficult taxes that we have to forecast, as we don't receive any of the statistical detail that we do for our game-related taxes, and changes to entertainment offerings are, to say the least, challenging to predict. I feel like this particular forecast period, this is like forecasting Baccarat win with the swings we've seen in the last, 32% drop in March of last year, 26% increase in April of last year. This year, we're off to a 22% decrease the first month, 23% decrease in September. So it's just been extremely volatile and difficult to, I guess, as a forecaster, to establish a base. What's my base? Why is it moving, back and forth so much every month? So when you look at FY24, we did $127 million in gaming LET collections. Similar to, I guess you'd say, gaming, under the current law, which taxes admissions at 9%, admissions only at 9%, that's the highest amount we've ever recorded. So that's good, even with some of these swings we saw. So we're coming off an all-time record. Take that into consideration. And we're off to a slow start. Fiscal year to date collections are $28.9 million. We're down 17.7% or $6.2 million compared to last year through September. But the growth trajectory for the remaining 9 months is basically flat. It's a decrease of 0.8%. So not super challenging, I guess. But there's some factors I'm going to get into here that kind of tells a story. You can see in the chart that the gaming live entertainment tax collections, we're forecasting them to remain below the all-time record set last fiscal year. We're projecting FY25 to decrease 6.9% or $8.8 million with $118.2 million in collections. So what are the factors? What's driving this? First off, we lost the Mirage. And the Mirage, I can tell you, had a much stronger impact on LET collections than, let's say, gaming. They had a Cirque show, a magic show that ran in large auditoriums that was open, I believe 5 nights a week. So big contributor. Of course, some of that, I think Shin Lim's going to the Venetian. Some of the shows will go to, the attendance will go to other shows, right? But to what amount, remains to be seen. So far, that's definitely not helping us. I think another factor to consider, maybe more than the Mirage closure, is the fact that Adele and Garth Brooks, they headline at Caesar's Palace and the Coliseum. I don't know if anyone's seen them. I haven't. But they're ending their runs in FY25. And we have not been made aware of any replacements because they're not renewing. And I can tell you those 2 shows are significant to what we see every month. So that's going to be removed from the base. I think to bring up the point again, when we talk about this lag that we're seeing in convention attendance and international travel from pre-pandemic levels, those 2 market segments, they overlap, and they're significant drivers, as we know, to midweek hotel occupancy and showroom attendance and ticket prices. The shows don't just open on Friday, Saturday night, and Sunday night, folks. They're going, Tuesday, Wednesday, Thursday. They're all week. So we need that business to facilitate attendance and profitability. And this was the last point I'm going to make about this forecast model, and it's something that I've taken it into consideration years ago. I remember hearing this, and now I'm hearing it again. An industry contacts that we spoke to, and this is not a bad thing, there's certain non-gaming LET venues that are negatively impacting the gaming LET venues in terms of attendance to shows, particularly the MSG Sphere, which, for my gaming guys, that's bad because they don't own the MSG Sphere, but from a perspective of the state, it's still going to LET. So it's a positive, but it's impacting my forecast. So as I had stated, we're off to a slow start, right? We're down. I do anticipate gaming LET can make up some ground this fiscal year due to certain show rotations that will benefit collections. Adele's going to finish her run here in November, so I think we're going to see a pretty good spike there. However, I don't see a path for growth in FY25 similar to what we're forecasted in gaming. So that's the outlook for '25. In '26, look, we're projecting kind of flatlining the base. We're 113.7 million in gaming LET, which is a 3.8% decrease, or 4.5 million from FY25. Why? I'm looking at the base, and FY25 benefits from Garth and Adele for a large part of the fiscal year. 26 doesn't. Until I'm made aware, I'm not going to assume a show is going to come in and replace that, or a percentage of that. So I still have us down. And then in FY27, we're forecasting collections to total 114.8 million, which is an increase of 1%, or $1.1 million from FY26. Very, very modest growth. I do feel that some of these collections are going to stabilize due to improved midweek convention business. Like I said, that's a key driver for growth. It allows large production shows and headliners to reach maximum capacity and profitability. The more attendance, you drive up the price, right, Mike? That's how it works. So this assumption that I have is expected to offset some of the decreases we are anticipating to the base as a result of the shows ending in FY25. And then it's also going to offset this continued competition from non-gaming LET venues. That's not going away. I mean, the Sphere, they're offering some pretty incredible lineups. I haven't heard anything after the Eagles, but I'm sure it's going to be something big. Allegiant, some incredible concerts. T-Mobile, they have some incredible shows too. So I think that competition factor is going to be with us for a while in terms of the gaming side. I think there's an offset because it's going to go to the state's general fund on the non-gaming side, but it's something that I considered in my forecast, and I don't know if I'm going to be made aware of any show replacements between now and probably not December. In May, I might. But again, let's say Garth Brooks leaves, the next person isn't going to step right in. There's always a ramp up to develop the show how they want it, the showroom and this and that. So that's kind of my outlook. It's soft, but I think when I was looking at the non-gaming LET forecast, because we're kind of combining this into one, I didn't feel so bad. I felt like, well, hey, they're kind of seeing the same thing I am, right? I'm not as strong as I was, but that's because there's growth in the non-gaming side. So that's kind of my thesis. And with that, I'd be happy to answer any questions that you guys have.
For the record, Linda Rosenthal. Is that working? So a couple things. I actually don't see what you're seeing in the forecast for the non-gaming. I see it down versus 24. So I don't know that.
I think that might have to do with the Super Bowl, is why we're down.
But I thought your point was that we were making up for the decline in gaming LET with non-gaming LET.
I don't think we're going to do an FY25. I think moving out, and I'm sorry, 20.
It still doesn't match what we did in 24, except for the budget division's forecast. It's down significantly. So just a point. And then if I just want to make sure I understand. So you are removing the benefit of Adele and Garth completely from your base and not replacing it with anything, either due to timing or at a lower level, just there's nothing replacing that, right?
I think I don't know the exact numbers that those two shows do. I get a set number and I ask questions of what caused what. I think there's still some Coliseum in the base. I didn't remove it from the base completely, but those months that I saw huge spikes, I took that out of the base. I didn't include that in the average monthly estimate for gaming live entertainment tax collections, I guess is what I'm trying to say. They were just, they're extremely strong. And I don't know that, we're going to be able to replace those in 25 or 26 until we're made aware of a show. I'm sure something's going to come in, but to what magnitude? Hopefully Celine Dion makes an announcement in Resorts World, and that will change this entire forecast. But we haven't heard that. They're not going to probably tell me if I ask them that.
Yeah, it's just an interesting, I understand the dilemma, not knowing, and so how do you forecast for something that isn't known? But, I mean, you make the point with the Sphere. I mean, they've had great hit after great hit, and the assumption is that's going to continue. But in this case, they had a great hit in Adele and Garth, but you make the assumption it's not going to continue. So,
I see your point.
yeah,
Yeah,
a little bit. I just think it's a little bit conservative again, but I
It is
understand the
definitely-
reasons why.
It is definitely conservative. I will tell you that. I looked at LCB's forecast, and, you know, I yeah, maybe not to that level, but I can see where there could be growth. But again, the base is going to decrease in '26. To what level, I don't know. I'm assuming it's going to decrease, you know, slightly. FY25, although we're off to a slow start and I don't think we're going to match 2024. It does benefit from that Garth and Adele still being in there, but then it's gone. And I don't know that they're going to be able to turn around and have a new show and what magnitude in FY26, because I think he ends in March. And I mean, I know when these shows ramp up, it takes time. The headliner wants to come in, and, you know, there's a whole new setup, and it takes a while. And you know, Caesars didn't give me any indication that they have a replacements. I wasn't given that information.
Understood. Any other questions? Okay, great, thank you.
You're welcome.
And then can we move to the non-gaming LET from the agency, please?
Good morning, Madam Chair and members of the forum. For the record, I'm Erica Scott with the Department of Taxation. I'm the economist with taxation. And today I'm going to be presenting taxation's forecast for the major revenue sources for the general fund. To start off, I will go over the key assumptions that went into this forecast for the agency. First, we would like to assume that CPI remains coming into a normalized around 2 to 3% within the next biennium. And the other assumptions is that mortgage interest rates also continue to trend slightly downward into the next biennium, but maintain around a 5% range. Nevada's gross state product continues to increase at a steady 3.5% to 4%. Annualized nominal growth. And then jobs in Nevada also continue to increase. I'm going to clarify the wage growth is the 5% that I'm putting into this assumption here. And then the overall assumption is that Nevada as a whole continues to maintain a healthy stream of tourism while building economic diversification. So those are all the key assumptions going into this forecast. Similar to my colleagues here at the table, steady, stable growth, more stabilization within FY26 and 27 for some of these revenues, but I'll get to those. Beginning with live entertainment tax for the non-gaming portion. The assumption here, obviously, we're looking at healthy tourism and continued activity especially in Southern Nevada and Las Vegas with the large event centers that we have there. So we've substantially increased over the past 3 years in this revenue source, and we've seen the opening of new stadiums and concert arenas, as well as hosting national and international events. So this graphic here shows the back to fiscal years 22 through to 2025, the first 2 months of FY25. And it's color-coded to highlight the highest and lowest values. We can clearly see that February of 2024 was the highest month on record at $29.5 million, the same month that Las Vegas hosted the Super Bowl. So prior to the pandemic, the average monthly revenue for this tax type was around 2.1 million. So that was FY19's figures. So now, fast forward to FY25, the average monthly live entertainment non-gaming revenue tax is, well, excluding for February, it's over $9 million a month from this revenue source. That's an increase of 334% from FY19. So if we're doing a comparison of normalized revenue from fiscal year 19 prior to the pandemic to current, those event centers that we've shown are driving that increase of 334%. On this slide, we provide a time series view of the revenue stream with a very obvious peak during the February 2024. With non-gaming live entertainment tax, the tax is due when the admission is sold, so the revenue may or may not reflect during the month of the event. And this is depending on the timing of the taxpayer releasing tickets for sale, and also depending on the consumer behavior of ticket purchases. Typically for a high-priced large venue event, when they put tickets on sale months in advance, some of that revenue will show up in months leading up to the event, but that's not always the case. And on the next slide, we have the bar graph showing the non-gaming live entertainment tax revenues from fiscal year 2019 through fiscal year 2024 in the blue bars, and then the red bars representing the department's forecasts. Without a one-shot event in this biennium as popular as the Super Bowl, the forecast for live entertainment dips down in fiscal year 2025, but still high above the prior revenues of fiscal year 2023, and we forecast continued growth from this revenue source. So for fiscal year 2025, the department's forecast for non-gaming live entertainment tax is $108.3 million. This is a 16.3% decrease from the prior year, which is not to imply any weakening market for the live entertainment in the state, but rather the effect of a normalized tourism trend the year after hosting one of the biggest events. And then in fiscal year 26, we forecast $113.5 million, an increase of 4.8%, followed by $120.3 million, or a 6% increase in fiscal year 2027. So despite the decrease forecasted in FY25, the department's outlook for this tax type is overall very positive, with growth forecasted for fiscal year 26 and 27. And I can pause here for any questions that the forum has.
So just a quick question. Looking at your page, is that page 4, where F1 is a part of this one, right? A part of LAT non-gaming?
Yes.
So is that the lift that we see in December 24?
The department is held to confidentiality on taxpayer information. So
I just expect, because you said Super Bowl, that's why when we called that one out, I was just wondering where the F1 lift would be, but okay.
Speaking to specifics of months where revenue, I think that's why I went into the way this tax is collected is when tickets are sold. So they're not necessarily going to show up in 1 month of revenues. It depends on when they get sold and consumer demand.
Makes sense. Thanks.
Thank you.
Thank you very much.
Thank you.
Next, we'll have the presentation from the Budget Office, Mr. Solorio.
Dr. Solorio, for the record. I just want to say thank you for letting me present these two revenue items together, because it is extremely difficult to present one without the other, because both of them are negatively correlated to one another, and I'm gonna talk a little bit more about that correlation in my presentation. So let's take a look at the LET gaming historical data. So we've seen that this state revenue is also very stable revenue that we've seen over the years. So pre-pandemic, we've seen an average monthly revenue from the LET gaming of $8.42 million on average per month. After the pandemic, we saw an increase of $9.0 million. The average has increased to $9.0 million per month from April 21st to September 24th. So we saw that this extremely consistent source of revenue. Now, one of the things that I have taken into consideration in my model is the increasing competition from the LET non-gaming side of things. So this model itself is a competition-based model. So how well the competition is doing is going to affect the financials of my LET gaming. So what I'm forecasting is that the LET gaming percentage, or the average monthly fee that we get from the LET gaming, is going to go down as the competition from the non-gaming starts to increase. Okay, so that's going to put some pressure into the LET gaming, and that decrease I'm forecasting to be around $0.0 million. And the average monthly revenue that I'm forecasting from October 2024 to June is around $8.8 million on average, okay? One of the things that I want to mention here is the reason why I don't have this number going extremely down as the competition from the non-gaming institutions increases is because if we take a look at the graph of the historical, the pre-pandemic and post-pandemic revenue, the pre-pandemic time on the LET gaming was also a Allegiant Stadium time, a pre-Sphere time. So I don't see any reason why this revenue will go down historical records. It should probably stabilize pre-Allegiant Stadium and pre-Sphere. So that's why I have that built into the model, so it doesn't just completely eliminate the LET gaming, because casinos, they're still going to have their shows, they're still going to have their magic stuff, and people are still going to go, but they're not going to go at the same rates that they used to before Allegiant and the Sphere come into place, okay? So in translation terms, I'm forecasting a decline of the fiscal year revenues from 127 on 2024 to 110 in 2025 for fiscal year 2025, $106.7 million of revenue on fiscal year 2026, and then on 2027, I'm forecasting a revenue of $104.9 million. Now, I'm going to go jumping into the non-gaming so we can see exactly what's going on in here, and then after that, we can have questions of all of them together. Okay. Now, one of the things that is very interesting with the LET non-gaming, it's how incredible it's growing from its beginnings on the incorporation of the football stadium. We can see that post-pandemic, it was a very low number. The non-gaming tax revenue from the LET was on average $2.11 million, which is nothing. If you compare it to what the casinos were making, it's just nothing. 2 against 9 is just not comparable. But after the COVID pandemic, the restrictions went down, the stadium went up, these other non-gaming institutions came up, we can see that this revenue has been on the rise. Now, one of the things that I want to mention here in this graph is that this major outlier over here is on February 24. That's mainly the Super Bowl, which significantly increased the live entertainment of non-gaming on that year. For my forecast, I went ahead and took this outlier out because we're not going to have any Super Bowl in the next upcoming 5 years. So I went ahead and replaced this February month by the averages of the previous 5 Februaries, because I've noticed it's a very cyclical thing again, and the February is just a known month to be around $3 million to $5 million on revenue. So I went ahead and took the averages and put it on my forecast. And then even after I replaced it, we can see the growth, and then I went ahead and calculated what was the percentage growth of the LT non-gaming revenue, and even after controlling for the Super Bowl, we have increased this revenue on a monthly average of 66.2%, which is a very incredible growth. Now, adding my forecast into the mix, because I'm not foreseeing any incredible growth, because, you know, the new toy kind of effect is going to go down, all right? So the new toy effect is going to go down, that's for sure. However, we're going to have I'm still forecasting a growth of 39.6%. If we add that into our historical revenue, the actual growth from November 2024 to June 2027 in the LLT non-gaming is 4.7%. This is the actual monthly growth that I'm forecasting. And this translated into dollar amounts, you can see that it's still on an upward trending slope. Now, I'm well aware that my fiscal year forecasts are quite high when compared to my colleagues. And one of the reasons here that I actually was a little bit afraid of submitting these numbers is because if we take a look at fiscal year 2022, how much money we generated, it was around $40 million in revenue. If you take a look at 2023, that doubled. It went to $80.6 million in revenue, and we did not have any Super Bowls, any F1s in those 2 years, so just double. And then on 2024, after you control for the Super Bowl, you still land on $100 million revenue from the light entertainment tax, and that's still a $20 million increase. Now, by just taking a look at what's happening in 2025, fiscal year 2025, we just have a record-breaking UFC fight that happened in September. That UFC fight, if you pay close attention at the roster, it was not a big fight roster. It was just an average roster. If you would put that same fight in another stadium, it just wouldn't generate the record-breaking views and the record-breaking sales. So that means that that revenue was mainly driven by the venue and not the event itself. So what I'm forecasting here is that other industries, for example, the boxing industry, might want to mimic the success of the UFC fight, and I would not be surprised if we have a big Cinco de Mayo fight in that entertainment building. So that's why I went ahead and trusted my gut, and I left the numbers there because I do believe we're going to have hit after hit after hit, especially now that artists are realizing how much money they can generate from one single concert at that state-of-the-art venue. I believe that it's going to bring more and more big names into the state. So that's why I went ahead and left my predictions there. And for fiscal year 2025, I'm predicting 139.78 million. For fiscal year 2026, I'm predicting $167.7 million. And for 2027, I'm forecasting $184.11 million in revenue from the live entertainment non-gaming tax. Thank you.
Thank you. It is amazing how Vegas always seems to find something, right? Always seems to recreate itself.
Yes.
Any questions from anybody?
Just want to make sure I'm clear. So you're saying for the normalized, I'll call it 2024, was about $100 million because of the Super Bowl impact. So you're saying that you think it'll increase another $20 million in 2025, just because of the growth that you've seen mostly historically. That's the major driver.
Yes, that's a major driver, and the kind of hit shows that we haven't seen. And for December 2nd, I don't know if we're going to have the data of how much money the UFC fight generated on taxes, but if we have it there, we can put it into the model and see whether or not we're on track. But yes, that's mainly the assumption.
Great.
Thank you very much. Next, we'll have the fiscals forecast presentation by Mr. Tower.
Thank you, Chair Rosenthal. For the record, my name is Christian Tower with the Fiscal Analysis Division of the Legislative Council Bureau. Economic Forum members will find Fiscal's live entertainment tax forecast numbers in the Fiscal Analysis Division forecast information packet from page 45 onwards. I will begin with the gaming live entertainment tax, also called the casino live entertainment tax. It is levied on ticket sales for live entertainment taking place under gaming license. As Mr. Lawton has mentioned, of note is that fiscal year 2025 actual revenues generated by the casino live entertainment tax for the first 3 months are down approximately 17.7% when compared with fiscal year 2024 actuals for the same time period. The question is, of course, how much should we read into these numbers, also given the volatility of the tax revenues in general, and given that these are only 3 numbers, the 3 months we're looking at. So we don't want to read too much in these numbers, but we do still think there are 3 structural issues we would like to mention in the context of which we look at these numbers. Generally, when we consider fiscal year 2025, we do so in comparison with the fiscal year 2024, that was a strong year for the casino live entertainment tax. So in a way, the lower numbers we see today is simply the normal way the tax would move, we believe. Also, there are other reasons for why the first 3 months in fiscal year 2025 may have come in relatively weak so far. As mentioned also by Mr. Lawton, the Mirage has closed down, and that directly, of course, affects ticket sales on a weekly basis. We also agree that we may see cannibalization, so we may have reached a point in Las Vegas where live entertainment taking place outside of the casinos competes and takes business away from live entertainment taking place inside the casinos. So cases in point were mentioned, the Sphere, and also, of course, the big stadium events that are now regularly offering big ticket concerts in Las Vegas. So all in all, that tells us that fiscal year 2025 revenue levels will be lower than in fiscal year 2024. However, we're less pessimistic on how negative or how much lower the revenues will be, and that is simply because we don't see any sign of a crisis of casino live entertainment in Las Vegas taking place. Adele's residency is scheduled through the end of this calendar year. Garth Brooks is, I believe, scheduled to play until March 2025. The Formula One will race again in Las Vegas. Maybe that will be a little lighter than the first time around, but it's going to take place. And the lineup for calendar year 2025 on the Strip also includes artists such as Bruno Mars, Janet Jackson, Mariah Carey, Blake Shelton, Keith Urban, the Black Eyed Peas, Maroon 5, Rod Stewart, Carrie Underwood, the New Kids on the Block, and the Scorpions from Hanover, Germany. It's one of these bands that are more popular in the United States than in Germany. So while we believe that revenue levels in fiscal year 2025 will be lower than in fiscal year 2024, to us, casino live entertainment appears in good shape and strong. So in view of these considerations, we project the gaming part of the live entertainment tax to decrease in fiscal year 2025 when compared with fiscal year 2024 by 4.7% to $121,055,000. From fiscal year 2026 on, we project the gaming live entertainment tax to moderately grow by 2.1% to $123,551,000. And for fiscal year 2027, we forecast continued moderate growth of 2.5%, resulting in $126,602,000 in tax revenues. So after the CET, the Casino Live Entertainment Tax, falls down a little bit in fiscal year 2025, we believe it will continue to grow moderately in fiscal year 2026 and 27. If okay, I would move on now to the non-gaming part of the live entertainment tax. Now, as mentioned by the other speakers and presenters, the tax on entry fees for live entertainment outside casinos has in recent years become, maybe only matched by interest income revenues, the most dynamic general fund revenue source in the state of Nevada. Chart 1 on page 49 on the fiscal package illustrates that well. The graph that lingers close to the bottom of the chart between fiscal year 2005 and 2021 represents non-gaming live entertainment tax revenues. After fiscal year 2021, revenues dramatically increase and even surpass the revenues generated by the gaming live entertainment tax in fiscal year 2024. Now, for any forecaster, the difficult question after such a development is, where is this going from now? And I think the first question that needs to be addressed is whether the tax will continue its dramatic steep growth in collections during the 2025 to 27 biennium. Three considerations and information points inform the fiscal division's answer to that question. First, unlike during the 2023 to 25 biennium, during which the Sphere was added to the live entertainment market in Nevada, there are, to our knowledge, no additional large venues, such as the Sphere or the T-Mobile Arena or the Legion Stadium, planned to be added to the market during the 2025 to 27 biennium. The planned new stadium for the Oakland A's will take time to be constructed, and in our view will only enter the market after the biennium. Second, unlike during the 2023 to 25 biennium, during which the Super Bowl and the first time Formula One race was held in Las Vegas, we do not know of any similarly big one-off events that are planned to be added to the live entertainment mix in Las Vegas during the 2025 to 27 biennium. Third, we believe that visitors will continue to come to Las Vegas, but that visitor volume growth will be slow. For reasons I think Mr. Hill has presented in the previous meeting of the Economic Forum. All that, so no additional big venues being added to the market, no additional one-off events being added to the market, and stagnating visitor growth means for us that tax revenues will not continue their staggering growth path in the upcoming biennium. Now, the next question is, on which level will tax collection stabilize? And with respect to that question, we know that the Super Bowl in February of 2024 was a very important event for the non-gaming live entertainment tax in fiscal year 2024, which will not repeat itself. We also think that the Formula One race in November of 2023, when the Formula One was taking place the first time in Las Vegas, was an exceptional event, and that it will probably be lighter as concerns attention, crowds, and ticket prices the second and third times around. We furthermore know that in particular festivals taking place in Nevada, generating non-gaming LAT, have seen declining revenues, and believe that this trend will continue following a national trend in that respect, which sees declining revenues for festivals. So in view of these considerations, we project the non-gaming part of the live entertainment tax to decrease by 17.7% in fiscal year 2025 to $106,396,000. As mentioned, this projection takes into account that in comparison to fiscal year 2024, fiscal year 2025 will not have a Super Bowl and will see lighter revenues generated by the Formula One race and the festivals. In fiscal year 2026, we believe that non-gaming live entertainment tax revenues will moderately grow off of that lower level set in fiscal year 2025 and increase by 1.2% to $107,697,000. For fiscal year 2027, we see a similar growth pattern. However, we also take into account that the contract between the Formula One and the Las Vegas Convention and Visitor Authority schedules annual Formula One races until the end of the end of calendar year 2025 only. In other words, it is yet to be decided whether a Formula One race will really take place in Las Vegas in fiscal year 2027, or more precisely November of 2026, which is part of fiscal year 2027. So we decide to factor in this uncertainty relating to the Formula One race taking place in Las Vegas in fiscal year 2027 by cutting the anticipated revenue generated by a Formula One race in half. So in order to basically hedge against the upside and downside risks. So with that in mind, we project declining tax revenues for fiscal year 2027 by 6.1%, resulting in non-gaming live entertainment tax revenues of $101,080,000. But of course, and needless to say, any additional information removing the uncertainty regarding the Formula One race in fiscal year 2027 would of course lead us to revise our forecast. And before I finish, if I may make another comment just to clarify for information concerning the mentioning of UFC fights in the sphere. So they fall under the regulation of the Athletic Commission, and the live entertainment tax would not be levied on tickets sold for UFC fights. But instead, the Athletic Commission has for these fights a fee similar to the live entertainment tax that is differently collected. So, but UFC fights we wouldn't see in the non-gaming part of the live entertainment tax appearing, just as background for information. Thank you.
Thank you.
Make a comment. I think it's interesting that if you look at the LET gaming, the three of you, you are higher than anybody else. But if we look at the LET non-gaming, you are lower than anybody else. But if we combine the two, you and agency are pretty close on all three of them with budget because of the higher on LET non-gaming are substantially greater, but it's interesting that you're quite different on the two, but you're very close on the total.
And just to be sure, the 9% tax is the same on both, right? Whether it's gaming or non-gaming, is that correct, the rate?
That is correct, yes.
Thank you. Brian Gordon for the record. I'll just make a quick, more of a comment. Thank you to all of you that presented on this particular topic. Appreciate it. I think what we've generally seen is that folks that are coming to Las Vegas are focused a bit more on these experiences as opposed to some of these other areas I think we've already talked through from a forecasting standpoint. So I think my general sense is that venue operators and casino operators and folks that make investments in the state of Nevada will continue to try and make investments that target that segment of the market. And so there may be some opportunities there for additional demand within this particular segment of overall consumer spending. Obviously, there's some anomalies and one-offs and things you can't predict, but certainly this seems like we've seen a pretty seismic shift in terms of the consumer, and I think we'll probably continue to see the development of more venues and events that center around these types of experiential offerings.
So I'll make the comment too that the volatility of the events is sort of an interesting one. I track sort of what's going on at Allegiant Stadium just for work purposes. And so it's interesting to see, like, you know, I've been fascinated by the mayhem, I guess, of like the Taylor Swifts and the BTSs. And so I've been trying to think through my head who else is touring that generates that much revenue, that much excitement. And so that's been kind of an interesting question. The other one I've kind of pondered too is just sort of tagging onto what Brian is saying is, you know, what other new venues might be coming. And I don't know that I understand like what the Hard Rock will bring when they reopen, I think in 2027. I think that's a spring opening. If they're going to have a venue, is that venue going to be as cool as like a Cirque show, or what exactly that'll look like? You know, and I've wondered too, even if you open a new Cirque show, I think by now everyone's seen all the other Cirque shows, just if they've been around a long time, so I've wondered about that. And then I've wondered too, just more out of curiosity, is like Northern Nevada doesn't even really rank in this, and I know there's an event center going, I guess, up at Grand Sierra, but then if it's all local based teams, if that's even going to make a difference for either of our revenues. So it's just kind of some things I've been thinking about, but I don't know that there's an answer to any of that.
Maybe brief comment, Christian Tower for the record, LCB Fiscal. So local teams, if you're referring to sports teams, they're of course exempt if they're local teams from the live entertainment tax. And we do of course see revenue also from Northern Nevada, for example, Burning Man is a world-renowned festival takes place here, and that is a live entertainment tax payer, of course. And there are discussions about at the GSR building a bigger arena, but that would also be beyond the biennium when that goes on the market. But that could transform the Reno area into a major contributor, or one of the major contributors of the live entertainment tax, I guess.
Great, thank you all very much. I think at this point, we'll look to recess, take a quick maybe 30-minute break. So, I mean, it's kind of an odd time, but if we could try to all be back, we'll plan to come out of recess about 5 to 1. Okay, with that, we'll go into recess. Hello again. So we're going to reconvene the November 7th meeting of the Economic Forum. We are on agenda item 7, which is the review and discussion of preliminary forecasts, and we are on item C, the state 2% sales tax. So we will start with the agency forecast. Ms. Scott, when you're ready.
Good afternoon. Erica Scott with the Department of Taxation for the record. For the 2% sales and use tax for the general fund portion, we'll first take a look at the current revenues with this tax type as a time series just within the past few years back to fiscal year 2022. And we can see the seasonality with the peak months always in December with this tax type. And within fiscal year 2025 so far, July and August monthly average of the 2% sales tax revenue is $144 million. But the average in fiscal year 2024 was nearly $150 million. So it seems that fiscal year 2025 is starting off a bit stagnant, although we have a ways to go within this fiscal year with our highest earning months later on to come. With the key assumption in mind that CPI is coming back into a steady 2 to 3%, the stagnant sales tax revenue is not surprising for the first few months of this fiscal year. One of the most important indicators that I've used in my model for the sales tax is that, one of the most important indicators for sales tax that the department used for this forecast is the Nevada retail sales. And Moody's Analytics has forecasted growth over 3 and 4% for fiscal years 2025 through to 2027. With that considered, we have the sales and use tax 2% general fund forecast for taxation presented on this bar graph in the red columns. And considering the positive growth forecasted by Moody's for Nevada's retail sales, and with the assumption that Nevada's tourism maintains a steady growth, the department's forecast for the 2% sales tax is $1.84 billion in fiscal year 2025, and $1.93 billion in fiscal year 2026, and $2.01 billion in fiscal year 2027. And on the next slide, we have the chart showing the year-over-year growth. This works out to 2.8% growth in fiscal year 2025. So somewhat flat but steady. And then in fiscal year 2026 is forecasted to be 4.8% growth, and then 4.1% growth in fiscal year 2027. While the department does not anticipate to match growth rates seen in fiscal years 2021, 22, and 23, there's still anticipated steady growth nonetheless. And again, I'll pause here for any questions that the members have.
Thank you very much.
Thank you.
So now we'll go to the Budget Office forecast. Mr. Solorio.
Dr. Solorio for the record. So I'm going to be presenting the state 2% sales tax. So for this one, I also wanted to start with the analysis of the historical trend of this 2% sales tax. As we can see, it's been increasing on an upward trending slope with a dip during the pandemic months or the restriction months. Now, one of the things to keep in mind with this sales tax and use tax is that even during the pandemic, we saw some sort of neutralization effect with regards to the percent growth, and I'm going to show you that on the next slide. In this slide, we can see that the average percent growth, including the pandemic months, was of around 1.12% on average per month from July 2016 to October 24. if we exclude the pandemic months, we're going to have an average percent growth of 1.41%. Now, we see that there is not that major of a difference if we include the pandemic months or we exclude them. And the reason for this, I believe, is because during the pandemic, we had a supply issue, a supply disruption of goods. The few items that were sold in the economy were sold at a higher prices. So the low supply and the higher prices kind of help this sales tax to remain consistent. So that's why we see that type of effect in the graph. Now, before I present my forecast, it's important to keep in mind a few really important considerations. And this is something that my forecast it's taken into consideration. It's the amount of consumer credit that Nevadans have been collecting throughout the years, and that percentage we've seen that is been outpacing the average household income in the state of Nevada. So we take a look at the little PowerPoint. Sorry, I realized that I should have put the graphs separate. Right now, the graph that you're seeing on your PDF is the on your PDF is the comparison of federal rates and consumer credit, but the graph that you're seeing on the screen, that's the comparison between household income and consumer credit. The consumer credit here in the graph, I don't know if you cannot see the mouse, but the blue line is the consumer credit and the green line is the average household income. So as we see in percentage terms, we can see that the household income has not grown at the same rate that the consumer credit. The consumer credit is outperforming the household income. This means that the debt to ratio income that households are accumulating is increasing, all right? The debt is just higher than what they're producing in income. Now, if we factor in our federal funds rate, we can see that the federal funds rate, now we can see it on your presentation slides, is that the federal funds rate has an inverse relationship with consumer credit. The interest rate goes up, consumer credit goes down because it's more expensive to borrow money, okay? Now, we're foreseeing interest rate decreases in the upcoming years. That will have an effect on the consumer credit. So the consumer credit will increase simply because it's cheaper to borrow money. People are gonna go ahead and borrow money for large purchases like cars. But what I have built into my model is this debt to income ratio variable to prevent or to neutralize the effect of borrowing against people who are gonna prioritize paying debt. Because I do believe that some households, instead of getting a loan to buy that F-150 they always wanted, we're going to prioritize to repay their debt. So that's why I put it into the model, so we kind of neutralize the effect of low interest rates and people just going out and buying large purchases, okay? Now, in terms of dollar terms, this is my forecast along with the historical sales tax. As you can see, it's growing, but it's not gonna grow exponentially because of that neutralization effect that I have in place in my model. So some households are gonna be more financially minded with their financials, okay? Now, if we take a look at the percent change, once I add my forecast into it, the average growth rate of the sales tax is going to decrease around 0.34%. My forecasted average monthly percent growth from November 24 to June 2027 is going to be around 0.6% of average percent growth on the sales tax. In terms of speaking in physical terms, that translates to a fiscal year for 2025 revenue of $1.85 billion. For 2026, that's going to be $1.93 billion in revenue. And then for fiscal year 2027, that's going to be around $2.0 billion in revenue. Now, one of the things that I wanted to share is that my theory of people prioritizing debt against people who are going to do discretionary spending might have gone posted over the weekend. I went out car shopping with my cousin, and I was surprised at how packed the dealership was. There was even a wait list for a representative to talk to you. And asking the representative as a good economist, I was asking how long has this uptake of people it's been going for. He told me that they've seen really strong sales for the past month and a half. They've been selling on average 80 cars a weekend. And just by looking at the dealership floor, I was like, wow, I believe there were around 60 people in it. So thinking about my forecast, I was thinking, probably I underestimated people. So that's why I wanted to share that this probably going to be higher because people are just crazy to buy new things. As interest rates goes down, we're going to see this impetus of people going up, and probably these people are going to carry over the people who are going to be more financially responsible, just for what I've seen on that weekend trip. So that's all I have for today.
Thank you very much. Mr. Tower, when you're ready.
Thank you. Christian Tower, Fiscal Analysis Division for the record. I would like to begin with some context. The state 2% sales tax, the most important tax for the Nevada State General Fund, was a key driver for the expansion of revenues after the pandemic. Fueled by pent-up consumer demand coming out of the pandemic and increasing inflation, the state 2% sales tax overperformed the May 2021 Economic Forum forecast for the 2021 to 23 biennium in each year of the biennium significantly. However, during the 2023 to 25 biennium, sales tax revenues started to come in lower than expected by the Economic Forum's May 2023 forecast. In fiscal year 2023, revenues remained approximately $26 million, or 1.5% under the May 2023 Economic Forum forecast, and in fiscal year 2024 by more than $50 million, or 3.0%. As concerns the first 2 months of actuals in fiscal year 2025, sales tax revenues are so far approximately 10% under forecasted revenues. Another interesting development, throughout most of the 2023 biennium, state 2% sales tax revenues have been increasing year over year. In fiscal year 2023, sales tax revenue increased by 6.7% when compared to fiscal year 2022. And in fiscal year 2024, by 4.0% over fiscal year 2023. Since May 2024, however, sales tax revenues do not only fall behind the Economic Forum's May 2023 forecast, they also shrink when compared with the same month 1 year before. July and August revenues for fiscal year 2025 came in about 2.1% lower than July and August revenues in fiscal year 2024. The question is the same as in the previous presentation I gave, what should we read into these numbers? And in our view, these developments of year-over-year decreases are not only related to lower inflation rates and a general normalization of consumer demand after the pandemic. We believe it is also related to a real alignment of consumer spending. And that relates to what Mr. Nakamoto said, introducing our economic outlook before the percentage fee tax presentation. Wages continue to increase, consumers do spend money. But our interpretation of the situation is that their spending has moved increasingly into areas that are not covered by the sales tax, such as increased rental payments, increased insurance payments, and to food and beverage groceries shopping, which are exempt from the sales tax. For example, if we look at the 2 most important contributors to taxable sales by NAICS code, food service and drinking places, and motor vehicle and parts dealers, sales by food services and drinking places decreased by 3.6% year-to-date over fiscal year 2024's sales year-to-date. Sales by motor vehicle and parts dealers decreased by 12.9%. We think this is due to consumers eating less out and do more grocery shopping. Bigger investments in cars and auto parts are delayed due to the still high interest rate environment and increasing ongoing costs of living for rents, insurances, and other necessities. We do believe, however, that this realignment of consumer behavior will soon level out, with lowering interest rates, increasing wages, and re-emerging demand for new cars and auto parts. And I think what was just presented fits into that narrative, because I think we already see that happening in the car market. There were also overcapacities of American producers of cars, and usually what car producers do, they push them into the market through discounts and favorable car loans. And I think that's already happening. We just don't see it yet in the numbers because of the reporting lag. So that is to say, we believe that this will level out and we will re-embark on a growth path. Right? But overall, we see that growth path lower than in the previous years, due to overall, the cost of living pressures consumers feel here in Nevada. So in view of these considerations, we project an increase of 2% state sales tax revenues by 0.3% to $1,795 million in fiscal year 2025. For fiscal year 2026, we forecast that sales tax revenues will increase by 3.7% to $1,861 million. And for fiscal year 2027, we project that sales tax revenue increases by 4.7% to $1,948 million. And before I finish, I shall also mention that we will need to make a small revision to our sales tax forecast in December, as a result of ballot question 5 receiving the approval of voters in this Tuesday's elections. Passage of ballot question 5 exempts diaper products from the 2% sales tax from January 2025 onwards. We will calculate how much we will need to deduce from our forecast due to this new exemption. Just to give you a ballpark number, what we're talking about here, in calendar year 2024, the loss would have amounted to approximately $2.3 million. So it's not a big amount which we're going to take off our forecast, but we will make that revision taking into account the election results from this Tuesday. Thank you.
Thank you very much. I don't see any questions, so we'll move on to, oh, sorry.
Just a second. Now, before we have our December meeting, did you say we'll have another month of sales tax information available?
Christian Tau for the record. So we will probably know what the revenues are and we'll be able to, from there, work ourselves back to what the sales. But I don't think that the taxable sales reported, from which is the basis for our forecast. So we first forecast taxable sales, and then from there on, we forecast what the collections will be, including all the abatements and everything that is out there. And so I think we're not going to have numbers reported from the Department of Taxation for taxable sales until then, before we're going to be able to prepare all our forecasts, but we may have another data point for the actual collections.
The reason I asked the question is that I'm a little bit nervous about showing increases when all available data show decreases up to the point where we're making the forecast. Now, having said that, we've got another forecast in May, and by then I would assume that if we'll have a better feel for whether we've got a turnaround in that sales tax number.
Christian Tau for the record. I would say that I think the anecdotal story Mr. Solari was reporting, I think that is in line with what we're also seeing, that there will be a turnaround at one point, and we think it's going to be soon. But yes, it is true that the actual numbers look at the moment negative.
Michael Nakamoto with the Fiscal Analysis Division for the record, and just to add on to what Mr. Tower said, was because largely it was going to say, he said what I was going to say, but when I talked about timing, as I went through our economic overview, that was kind of the question that we have is, our assumption, at least for sales tax in FY25, is that a lot of what we're seeing right now in terms of slower sales, especially when it comes to motor vehicles and some of these things, are perhaps the result of higher interest rates. But now with the Open Market Committee having its action from this morning, as well as Ms. Mandel mentioning that it's anticipated that they will have further reductions going forward. At some point, we assume that this is going to spur a little additional spending, which will, and it's for, at least for fiscal, we don't have a lot of growth in FY25, and if you go and look at Table 9, you can see that the last 10 months, I believe, only have to grow by about 0.5% to get to our forecast. So it's not a lot of growth. But I think when we actually go, if you were to go into our packet and look at our forecast for the sales tax, we have it still a little weak in the first half of FY25. But then when we get to the beginning of the next calendar year, so the last half of FY25, is when we have it coming back a little bit. And so they kind of even each other out to get to slightly positive. So that's sort of the timing issue, is like we assume that the actions and things that are going on are going to have a positive effect on taxable sales. It's just the question of when that's going to occur.
Thank you both. So now we'll move on to the insurance premium tax.
Thank you. Erica Scott, economist with the Department of Taxation, for the record. With the insurance premium tax, similarly to prior tax types, I wanted to show the time series graphical view of this tax type. We can clearly see an upward trajectory with the rate increases over the last several years. And the tax revenue growth over the past 8 fiscal years are represented in this time series. In fiscal year 2024, this tax revenue brought in an average of $146 million a quarter to the state general fund. During the October Economic Forum meeting, we heard from Chief Deputy Insurance Commissioner Todd Rich, and he had communicated that there were upcoming approved insurance carrier rates, increasing their rates overall. And he mentioned that several insurance carriers had rate increases of 10 to 25% upcoming, although those would go into effect in fiscal year 2026 and 2027. So that has been factored into this forecast. But while the rate increases will take effect, ultimately consumer behavior will dictate what premiums are paid for the insurance to the insurance carriers. And consumers still have the option of shopping other carriers and adjusting coverages to offset the increased premium costs, and just shopping around on their rates for renewals. So these factors have all been considered into this forecast. The anticipated increases, but also consumer behavior with actual premiums that get paid. So an additional consideration to the forecast is that the totals shown are for just the general fund portion and before any tax credits are applied. So sometimes when we do these year-over-year comparisons, if the tax credits are not included in those prior year totals, it shows a larger growth than what is actually being forecasted for. So I'll get into that on the next slide. So the department's forecast for fiscal year 2025 is $647.18 million, then $690.18 $738.9 million in fiscal year 2026 and $737.1 million in fiscal year 2027. When comparing the annualized growth, like I said, these for fiscal year 2024, that figure is net tax credits that were taken in that fiscal year versus the forecasted fiscal year 2025 prior to any tax credits being taken. So roughly about 27 million of tax credits were taken against that fiscal year 2024 figure. So the forecasted growth is closer to around 5.9% from fiscal year 24 to fiscal year 25. This is the difficulty of presenting net revenues to pre-credit forecasts. So ultimately, that growth is 5.9% in fiscal year 2025, then 6.8% in fiscal year 2026, and 6.7% in fiscal year 2027. The department's forecast is for the later fiscal years to be more reflective of the upcoming premium rate increases and the consumer behavior in premium payments. And with that, I can open it up to any questions that you all may have.
And Madam Chair, before you ask any questions of Ms. Scott, I just want to note that the numbers that are showing up in her presentation do not match what is on Table 8. And this is because there is an additional portion of the insurance premium tax, and it's specifically on surplus lines insurance that is not collected and administered by the Department of Taxation. Rather, it's by the Insurance Division of the Department of Business and Industry. So the forecasts that you see in Table 8 are inclusive of that portion, the forecasted amounts from the Department of Business and Industry, and it's in the range of approximately $25 to $26 million per fiscal year. So that explains the difference between the presentation given by Ms. Scott and what you are seeing in Table 8. The agency forecast is inclusive of both portions. Thank you.
Thank you. For the record, Linda Rosenthal, I just have one question. You mentioned the approved carrier rate increases. You also mentioned, the consumer may balk at that a little bit and shop or reduce coverage. In the assumptions in your forecast, does it assume all of the rate increases flow through without the consumer actions, or?
They go in hand in hand. So I guess, can I clarify the question?
Yeah.
Sorry.
So maybe I'm not understanding, but so there are these rate increases that have been approved by the commission, right? So these carriers can charge higher insurance rates. I believe you said that's great, but then the consumer may also shop their insurance or reduce coverage to mitigate some of the impact of the higher rates. So what underlying rate assumption is in your forecast? Is it the 100% of the rate increases, or is there some mitigant for people taking actions against that?
There's a mitigant taken against that. Somewhere meeting in the middle, so to speak. So
Okay.
as insurance carriers do ask for rate increases, this would be more questions about the process with the insurance division, but my understanding is not every single carrier is asking for rate increases every time. So that's also factored into this forecast. If the rate increases are not warranted in future fiscal years, also that's also considered. But ultimately, consumer behavior is going to dictate what premiums are paid, and also, yes, that mitigant to the rate increases. But all those factors were considered.
Right. Perfect. Thank you.
Thank you.
Okay, we'll move on to fiscal division, or budget, sorry.
All right, and Dr. Solorio for the record, and I actually have a little schematic to show these consumer dynamics that's going to happen with the rate increases. So hopefully I can help Erica out with her case. Okay, so you guys can see what's going on, and she's totally right. Okay. Don't worry, it's fine. Perfect. So taking a look at the historical time series of the insurance premiums tax, this is something that we've seen. It's been on an exponential growth rather than on a flat trending slope. It's just a very exponential growth that is also pandemic bulletproof. If you can see in the graph of the rectangle where I have the pandemic restrictions, this is a line item that is bulletproof to it because it doesn't matter if you're not driving your car, you still need to pay your auto insurance. So that's something that is something that is reflected on the graph. So taking into consideration for my forecast, I do have the given insurance rate hikes that are going to be put in place starting on October. So according to the Nevada Division of Insurance, there's at least 6 insurance that are going to increase their rates to at least 10%. One of the numbers, all these numbers are publicly available, so you guys can go and find it online. Nevada ranks 4th in the nation of one of the highest auto insurance rates in the United States. It is calculated that we paid around $3,500 a year on auto insurance. That's almost 5% of yearly income goes to auto insurance. Now, one of the biggest corporations that are going to be increasing the rates, I have it here. Allstate is one of those corporations that are going to be increasing, actually effective on October 28th, 10% increase on their auto insurance. These guys are going to have the largest impact because 94% of people are going to face the 10.8 increase. Farmers Group, they're going to increase their rate insurance all the way to 24%, which is quite a large increase. Now, this little schematic that I have here, you probably will see it better on the screen because on the printout, it doesn't truly says what's going on. So I'm just going to give you a little explanation of what I have here. So on the top chart, I have my little demand supply curve for big insurance. On the bottom, I have my demand and supply curve for small to medium-sized insurance. So let's, just to give you some reference, these numbers are used, for example, for explanatory reasons. Okay, so let's say that the equilibrium price for insurance is right now $110 a month for auto insurance. So what's going to happen if a big insurance company goes ahead and increase 24% of their premium rate? So that's going to be an increase of $136.4. That's almost $26 in increase if you're taking into consideration a 24% increase. So what's going to happen when they increase their price? The demand for that given insurance price is going to go down, and that's going to produce people to migrate to the small to medium-sized market. So people are going to shop around. They're going to go and migrate to the small and medium-sized market. And then what's going to happen when you have people entering a market? That influx of people will put pressure on the small to medium-sized companies to increase costs, because the transaction costs are going to increase due to the fact that they need to hire more agents to handle all these claims. They need to do more paperwork. They need to put more software in place to handle all this demand. So the demand curve is going to naturally shift to the right, which is going to bring the price for the small to medium-sized insurance up. Okay, in this case, it's going to be somewhere higher than 110. The specific where that price point is going to be, it's kind of unknown. It's hard to tell, but it's going to increase for sure. Now, what's going to happen with the big size insurance company when they see that they're losing customers? They're going to go ahead and decrease prices to compete with the small and medium size companies. And what's going to, the effect of that is that people are going to migrate from the small to medium sizes when they see that the difference between the two is not that big, and they know that the bigger insurance companies have better rates, or not better rates, but they have better coverage, car road assistance and whatever, so they have better infrastructure, so people will tend to migrate. So what's going to happen here is that this dynamic is going to repeat itself, and the price is going to stabilize to an equilibrium point where there is not going to be any incentive for people to move from big insurance to small insurance. Now, where exactly is that price stabilization going to occur? We don't know, but it's definitely going to be higher than the beginning 110 premium that people were paying at the beginning, okay? Now, there is another possibility in this scenario when you increase auto insurance is that people can opt out from car insurance. Okay, that's a phenomenon that we've seen that is been increasing in this country. I was looking at some quick statistics, and apparently 14% of Americans are driving without auto insurance. That's around 33 million people without auto insurance. And if you increase the price, people can opt out from insurance, especially if you're taking into consideration that auto insurance is 5% of your yearly income. If you're living paycheck to paycheck, and then all of a sudden you receive a 20% increase on your auto insurance, you might consider to drop out from the auto insurance and just take your chances. So that's another thing that my model is taking into consideration to forecast revenue. Now, on this graph, I have two scenarios. The green line over here is the scenario where people welcome interest rates with open arms. They're not going to fight it. They're just going to take the 10% increase. The other one is that people are going to shop around and it's going to stabilize the rate. And for I factor in my model, it was in the middle. So I just took the 10% increase, cut it in half, call it 5% because of the market dynamics that is going to happen. So that's why that's what I put into my model. And I'm forecasting an average quarterly percent growth in insurance premiums to be around 1.8% from November 2024 to June 2027. So it's a moderately increase of the insurance premium tax growth. And then in fiscal year terms, just give me a second. That translates to $653.72 million for fiscal year 2025. For fiscal year 2026, it's around $679.35 million. And for fiscal year 2027, it's $702.38 million. Thank you.
Just a quick one, Brian Gordon for the record. So your forecast includes both components of insurance that we were talking about before, is that correct? Okay, thank you.
And just for Michael Crone for the record, so the shift that you had on the chart, whatever page this is, you're assuming all this movement migrating, to a smaller and to a large, that all happens in this next fiscal year, or is it over a period of time?
Yes, I'm forecasting that it's going to be a dynamic shift because most insurance companies, your premiums start on a 6-month kind of basis. So what I'm forecasting is that some people, when already are given their information that their insurance is going to increase, if the term of their policy is really close to termination, they might just, say, I don't want to continue with this insurance company, I'm going to move on. So I am forecasting that this is going to be a dynamic shift. So it's going to happen whenever you receive the insurance premium tax increase on your auto insurance. That's whenever it's going to happen.
Oh, sorry. So, but you're assuming it all happens in fiscal year 25.
Yes.
Or none of that impact. You're not assuming that happens again in 26 and 27. Is that right?
Yes, that's correct. That's correct. I'm assuming that everything is going to all that market dynamics is going to happen in 2025.
And then the other thing, you said people could exit the market completely, but isn't there another option where they could reduce their coverage as well and go back to, maybe just only a liability insurance or increase their deductibles? There's other factors. I'm just wondering if you considered any of those in your analysis.
Okay. Yes, I will consider. And one of the other things that I saw is that most people, usually when they get auto insurance, they do the minimum, the state legal minimum. So the decrease from the state legal minimum is not to have insurance. So that's why I'm like, okay, because it's illegal for them to drive with the state minimum. So I'm like, all right. Okay.
Very good. Thanks.
Thank you very much. Now we'll move to fiscal. Mr. Nakamoto.
Thank you, Madam Chair. For the record, Michael Nakamoto with the Fiscal Analysis Division. And in our forecast packet, the insurance premium tax begins on page 69. But I actually will have you refer to page 71, which is the table that is up on the screen now. And this is the historical collections for the insurance premium tax going back to FY 2011. And I think this table in and of itself tells a really interesting story because the only year during this period where insurance premium tax collections were negative was FY 2011, which was right at the bottom of the Great Recession. Otherwise, you can see that there was slight growth in FY 2012, but you could see that it just increased and increased. There are reasons why in certain fiscal years that it went up higher than others. FY 2015, of course, was right at the beginning of the provisions of the Affordable Care Act. And so as a result of that, there were increases in coverage as more people were able to obtain health insurance in an easier fashion. And so you can see that there's just been fairly stable growth in this. Again, with the exception perhaps of FY 2020, where the collections only went up by 3.7%. And it's something that I think we've mentioned, or at least I've mentioned in my previous presentations on this, is that when you go back to the pandemic, there were a lot of insurance companies that were not increasing their rates, or in fact even refunding premiums to people because they weren't driving, they weren't going anywhere because frankly they couldn't go anywhere. And so as a result, there was less demand for auto insurance, at least, which is only a portion of it, but I mean that can help to mitigate some of the collection growth here. But then you can see that it took back off again, and some of the things that we've have observed, at least for some of these property insurance categories, is that insurance companies who were not raising their rates during the pandemic suddenly found that as people were driving more, claims went up, and the cost of repairing automobiles went up, and therefore they ended up losing money because they were paying out more in claims than they were receiving back in premiums. And that has been one of the things, at least from my estimation, what has been driving these large premium increases, at least in the automobile and some of the other property categories that have been previously discussed. But I mean, again, that is not a huge part of the market. The plurality, it's around, I think, thinking back to the insurance division's presentation from last month, I believe it's about 38% of premiums are in the health insurance industry, which is also fairly stable in its growth. But the information that the insurance division was giving with respect to rates for at least plan year 2025 was, depending on the plan type, you were in like the 4, 5, 6% category. So it's fairly moderate. But when you have almost 40% of your category or of your insurance going up by that kind of rate, naturally you're going to expect some growth. And then whatever you have in the property and casualty and life and all of those other categories is only going to add to it as well. So one of the things that I will note is the 11.2% growth in FY24. One of the pieces of legislation that was passed in the 2023 session that I've talked about at previous Economic Forum meetings was Senate Bill 435. And that basically said that if the Department of Health and Human Services establishes a tax upon private health providers, that the proceeds from that are going to be used for Medicaid to basically provide services through managed care organizations for behavioral health services. And then as a result of that, then there would be increases in insurance premium taxes because the payments that are received by the managed care organizations are considered, their consideration for the insurance premium tax, and they're taxed at a rate of 3.5%, the way that any other payments to insurance companies are. So the information that I've received from the Medicaid analysts in our office said that the tax, that provider tax, began on January 1st of this year. So when you look at the actual collections, and remembering that we actually look at the quarterly collections for the tax, the premiums that are written, which make up about 95% of the tax, the surplus lines and the all other, which includes things like workers' comp, and that's a smaller amount. But you can see for the third and fourth quarters of FY24, there's significant growth. It's about or just over $20 million more in premium tax in those 2 quarters than the same 2 quarters in FY23. And based on the information that we have, probably about 40% of that is due to this provider tax. So the private and health providers, hospitals, and the like are paying this tax. The money is going to Medicaid to pay for behavioral services through behavioral health services through managed care organizations. Then the managed care organizations have to pay a portion of that back in insurance premium tax. So it's this cycle, although most of the money is actually federal. So I think we're net ahead on it. But if we assume that about $8 million a quarter of that was from this provider tax and the payments, then we're looking at actual growth of just over 8% in the tax. But we are led to believe right now that some of this growth is because of this provider tax having taken effect at the beginning of the year. So that having been said, I think FY25, keeping that in mind as I've thought about it, the first 2 quarters are stronger, obviously, because we will annualize against the provider tax at the 3rd quarter of FY25, which begins on January 1st of this coming year. So it's entirely possible, though, that the effect, because there's only growth of between $12 and $15 million, it might be a little low. So there could be some upside to this. But then when we're thinking about the premium increases, and it's been a discussion from the other forecasters. I think the way that fiscal is looking at it is that a lot of the effects that we're seeing in like the discussion of these more drastic premium increases are fairly limited to certain categories, so property and casualty being, and that's about 20% of the market, but I mean, with not as drastic increases in health insurance and the like, and just the belief that perhaps at some point these drastic increases in auto insurance and some of these other insurance categories, as we get past the pandemic, they might start to level out. We have a little bit less growth in FY 26 and 27, down in the 5.2, 5.4% range, which is probably a little bit below the long term if you're looking at the percentages going forward. But there has to be a point that you would assume that you can only push so much on the premiums. And it's entirely possible that I am incorrect on that, and that premiums will continue to increase as premiums have increased. But I think the way that we were thinking about this is we'll have a little bit more growth in FY25 because we're still annualizing against the effects of the provider tax. But then in 26 and 27, we've moved past that, and we'll moderate some of the growth in this. So we have that 6.5% growth in FY25 to about 689 million, and then to about 726.1 million in FY26, and then to 763.9 million in FY27. And with that, Madam Chair and members of the forum, I would be glad to answer any questions about this forecast. Thank you.
Brian Gordon for the record. Thank you for the overview. Just you mentioned the 20% of the overall premiums were sourced to property and casualty, and I don't have my notes from our prior meeting. What's the general distribution of the sources of the insurance premiums that are being paid that where this tax applies?
Thank you, Mr. Gordon.
I'm not trying to put you on the spot. I just didn't know if you knew in round numbers.
Thank you, Mr. Gordon. Michael Nakamoto for the record. I would have to go back and look at the presentation, but the tax applies uniformly. There's not a different rate for health insurance versus auto insurance versus life insurance. So we assume that the distribution of the rate is equal to the net premiums that are reported by the insurance division. So that assumption says basically 38% of the insurance written is health insurance. Therefore, we assume that 38% of the insurance premium tax derives from those premiums.
Understood. Thank you.
Thank you very much. Okay, next up is agenda item 7 and then subcategory E, modified business tax. So we have the 3 components here, non-financial, financial, and mining. So I think, just so that we're not going back and forth amongst presenters multiple times, we'll just have each presenter walk through each one of those components of the tax. We can maybe ask questions at the end or at the end of a section. Obviously, if you guys have a question, just feel free to indicate so.
Thank you. Erica Scott with Department of Taxation for the record. So for modified business tax, I have first a graphical representation of the quarterly general fund revenues. This is with all 3 modified business tax types in the totals here. So it's another color-coded chart for the highest and lowest revenue quarters from fiscal year 2022 through 2024. We can easily see the highest quarters. Second quarter second quarter of fiscal year 2023 was the highest on record. And consistently, the lowest revenue quarters is always Q1 of each fiscal year. It's also obvious in fiscal year 2024 where the rate reduction came into play. So the modified business tax rates were reduced in July of 2024. 2023 for fiscal year 2024. And this goes into play with the modified business tax revenues. So the reduction by comparison in fiscal year 2024 is due to the rate decrease, not necessarily any economic indicators. And despite that rate reduction, we can see quarters 3 and 4 of fiscal year 2024 were in the top 5 highest revenue quarters from this time series. And this is due to steady wage and job growth that Nevada has experienced within this past fiscal year of FY 2024. Next slide is the time series showing the modified business tax revenues from fiscal year 2017 through to fiscal year 2024. And with this view of the revenues, we can also clearly see the seasonality play out again. Lowest quarter of revenue is typically first quarter of the fiscal year. But overall, we still see a steady incline in this revenue source. Getting into the forecast, we've broken out the general business portion of the modified business tax revenues in the 2 preceding years in the blue bars, and then the red bars are the forecast for our agency. And again, we see that dip in fiscal year 2024. And again, not an indication of reduced economic activity, but the tax rate decrease. So since the department's key assumption is that Nevada's job growth continues on the upward trend and incomes, wages stay around 5% growth rate, we're forecasting growth in each fiscal year for this tax type. Also, once again, the forecasted figures displayed here are prior to any tax credits. What I have done in this graphical representation, though, is I've added back in the tax credits that were utilized so that we can actually do a apples to apples comparison with the growth, the year-over-year growth rate. So for fiscal year 2025, we are forecasting $847.94 million, then $893.75 million in fiscal year 2026, and $939.76 million in fiscal year 2027. This comes out to a 6.2% increase in fiscal year 2025, and for fiscal year 2026, 5.4% increase, and a 5.1% increase in fiscal year 2027. So moving on to the financial institutions forecast, Another factor that was added into this employment sector is the interest rates and the behavior that's been going on with where we see lowering of interest rates. We can clearly see that with financial institutions, we saw a general decrease in reporting of wages when those interest rates were on the rise due to those wages being tied to the financial sector. So with the reduction of interest rates for lending, my model is taking into effect the wage growth that would be that relationship with the lowering of interest rates and loosening that financial industry, expanding that financial industry with jobs and income. So in fiscal year 2025, for the financial institutions sector, we're forecasting 43.74 million, then 46.1 million in fiscal year 26, and 48.48 million in fiscal year 27. And again, this chart, we were able to add back in the actual credits taken against the financial institution modified business tax returns. So we would see with these forecasted figures a 6.9% increase in fiscal year 25, 5.4% in fiscal year 26, and 5.2% in fiscal year 27. This is reflective of the continued federal interest rate reductions anticipated in fiscal year 25 and followed by a steadying of interest rates in fiscal year 26 and 27. And excuse me, next we have the modified business tax mining portion, and we don't anticipate any large fluctuations in this industry. For this industry sector, I looked at industrial productions forecasted from Moody's, some data that was forecasted in this industry sector. It doesn't seem to have a big fluctuation in fiscal year 2025. But then some normalized growth within fiscal year 26 and 27. And that being considered, our forecast is 19.6 million in fiscal year 25, 20.55 million in fiscal year 26, and 21.61 million in fiscal year 2027. Again, all before tax credits are applied. So the year-over-year comparisons here, we are looking at a 0.1% increase into fiscal year 25, then 4.8% in fiscal year 26, and 5.2% in fiscal year 27. This is, again, reflective of an anticipated somewhat stagnant year in fiscal year 25, and then some expansion in fiscal years 26 and 27. And that is all I have for you on the modified business tax. Thank you.
Thank you very much. Now we'll move to budgets forecast.
Dr. Solorio for the record. So I'm going to be presenting the modified business tax in non-financial. So for this model, it was very straightforward. I kind of used the same assumptions as Erica was using with a strong economic growth, especially in the job market sector. My forecast for fiscal year 2025, it's $751.89 million. For fiscal year 26, it's $763.14 million. And for fiscal year 2027, it's $797.7 million. Now, one of the things to keep in mind is that these numbers might be a little bit shy, especially after the result of the election. I was looking at the markets this morning, and the markets reacted really in favor of the election. The Dow Jones went up for 4%, S&P 500 3%. And what the economists are saying is the reason why markets reacted so in favor of the election is because of the corporate tax cuts that everyone is anticipating. And once these corporate tax cuts start to rolling, we're going to see a lot of business activity in the market because companies are going to have money to expand their businesses, and therefore the job market is probably going to go with this tax credit. So these numbers might be a little shy, but it's too early to tell what's going to happen. Hopefully by the May meeting, we're going to have a better understanding of how the job market is going to look, okay? So now moving on to the modified business tax. I'm aware that I'm the only one who has this modified business tax going down. And the reason why I have this modified business tax going down, sorry, I forgot to move these slides, is because of some of the research reports that have come with regards to AI. According to Accenture Research Group, they found out that the banking industry is the industry that is the most vulnerable to job displacement by AI, meaning that if we take a look at the chart, we can see that 54% of jobs in a banking institution are at risk of being replaced by AI or being automated. Only 12% of the jobs are going to benefit from the introduction of AI, meaning that the job is going to get more efficient. 24% of those jobs are at low risk, and 10% of the jobs are safe from the introduction of AI. Now, 54% displacement by AI is quite a bit, and this is something that you can go ahead and see in a banking institution. If you walk into a bank branch, you're gonna see how empty the bank branch is, how many empty desks are in the bank branches, and we've seen the closures of bank branches going on around the entire nation because a lot of banks are moving to online services, and you can also see it in commercials when you're watching TV, how all these financial institutions are bragging about their AI capabilities, their AI advisors. So we will see some sort of job displacement by AI in the upcoming months. Now, on the following graph, I have a survey conducted by Citigroup in which they asked banks whether or not they already started with the introduction of AI. And what we can see is that 21% of the banks surveyed in this research study said that they have not yet started with the introduction of AI in their operations. 68% of them already started introducing AI, and only 11% of those banks surveyed by Citigroup are already in a deployment phase. A deployment phase meaning they already given some sort of products to their customers, okay? And then if we take a look at fintechs is already ahead on this battlefront of adoption of AI, and then insurance companies are also coming into the game with AI because, you know, the automation of very tedious tasks, it's way easier when you introduce an AI agent that can run through hundreds of policies and tell you whether or not you're going to get your insurance paid or not. So that's why we're seeing that introduction of AI in really monotone and automated jobs, okay? Now, on fiscal year translations, let me just show you in my graphs. So I have it going down with in mind that a lot of jobs are going to be being replaced by AI. So if you take a look at fiscal year 2025, I'm forecasting a $38.26 million. On revenue for fiscal year 2026, I have $36.92 million in revenue. And now this is the interesting part of my forecast is that as jobs get replaced by AI, we're going to have we're going to have jobs evolve because now banking institutions will need to hire a more sophisticated type of employees. They will need to hire someone with a software engineering degree, or they will need to hire someone with a finance and tech minor to work at a banking institution. So when we see that transition of labor, we're going to see that the gross salaries will increase. So that's why I'm having 2027 to have that reflects that transition of the job, that modification of it. And my forecast for fiscal year 2027 is $40.05 million for modified business tax financial. Now, moving on to mining. one of the things that we cannot talk about a modified business tax in mining without talking gold prices, because Nevada is historically a mining state. I have a degree in mining engineering from the Mackey School of Mines at UNR, so I'm really familiar with how mining works with commodity prices. So as we see the average gold price in terms of ounces is forecasted to increase in the upcoming fiscal years, 2025, 2026, and 2027. We see that the average gold prices is around 2,500 for 25, 2,600 for fiscal year 26, and 2,700 for fiscal year 27. Now, one of the reasons that I believe people are forecasting high gold prices in the coming years is because gold is one of those commodities that love chaos. Where there is chaos in the world, gold prices go up. That's something that is just a fact. And people are not forecasting any sort of peace treaties in the coming years with the Middle East war and Ukraine and Russia effect. Okay, so that's pretty much why I believe people are forecasting high increases. Now, when we take a look at the modified business tax, this is something really interesting that I have in my forecast. I have the forecast going up, but I don't have it going astronomically up with the gold price because of the engineering constraints that mining faces. Okay, mining is one of those industries that cannot capitalize that quickly on gold prices because of the engineering constraints that they face. They cannot just ramp up production in a mining site because it's not as easy as going into a dealership and buying a new truck. You need to order the whole truck to Caterpillar Komatsu, and that whole truck takes around 8 months to get built and get shipped to your mine site. And with also throughputs of processing facilities are built with a given amount of tons per day. You cannot just increase the amounts of tons you're going to be mining with regards to gold prices, because you need to expand the processing facility. So it's one of those industries that they do not capitalize that fast, but the capitalization is going to happen because I bet that Nevada gold mines are already expanding their operations with these gold prices coming in. But this expansion are going to take some time to be in effect so they can capitalize on the high gold prices. So with that in mind, my fiscal year for 2025 projection is $22.16 million. For fiscal year 26 is $22.10 million. And for fiscal year 2027 is $22.27 million. Thank you.
Thank you very much. Now we'll turn to fiscal. Ms. Owens.
Thank you, Madam Chair and members of the forum. My name is Haley Owens with the Fiscal Analysis Division, and I'll be presenting our modified business tax forecast for non-financial, financial, and mining. And I will be working from the Fiscal Analysis Division information packet that my colleagues have all been working from. I do want to, I just locked the screen instead of going full screen. I apologize. I thought I was doing the full screen. Apologies again, Haley Owens for the record. So our modified business tax forecast begins on page 77 of the Fiscal Analysis Division information packet. The first couple of pages summarize our forecast results and give a history of this tax. It's experienced a number of tax rate changes and changes to how taxable wages are calculated. I do want to make a note on the rate changes that you've seen and heard from the presenters already. We did have a rate change for all three components of the modified business tax that began with the commencement of fiscal year 2024. At that time, the rate for non-financial or general businesses was reduced from 1.378% of taxable wages in excess of the $50,000 each quarter to 1.17%. And the MBT rate for financial institutions and mining companies reduced from 1.853% to 1.554% of taxable wages. And I just want to note that those rate changes are permanent. And the way that that statute is written, there are no more rate changes allowable by current law. So the rate changes that we had in FY 2024 are going to be the same that we have for the whole forecast horizon. And without any kind of law change, we don't expect any more rate changes. All right, So going through the fiscal division information packet, I'm going to skip table 1 for now and go straight to page 80 with table 2A. This table shows wage and employment information for the non-financial sector. And kind of as you've been hearing from my colleagues throughout today, our general story and what we're seeing for the Nevada economy is that we expect to keep growing, but at a slower rate now that the initial post-COVID recovery has peaked and passed. The modified business tax is a payroll tax, so it's really a function of both employment and wages. So how we do our forecast is we have our employment expectations and our average annual wage expectations, and those combine into total wage forecast. We then apply the effective tax rate and get our forecast. So at the bottom of this table, you can see we expect job growth in the second column to kind of slow from 3.1% in FY24 to 2.3% in 25, 1.6% in 26, and 1.4% in 27. We have the average annual wage growth in the third column, kind of basically holding steady, that we don't have declining as much. We think a lot of the upward pressure on wages is easing, but we expect to see wage growth around 2.8, 2.6%. So moving to the next page, table 2B, columns A and B, they show the same total wage disbursement figures as the prior table by quarter on top, and then summarized into the fiscal year on the bottom in columns A and B, and then columns C and D translate this to total wages reported by taxpayers to the Department of Taxation. We keep the ratio of taxpayer reported wages to these, BEA equivalent wages at about 95%, which is right in line with the past 2 fiscal year actuals. Columns F through J deal with taxable wage adjustments due to deductions for employer-paid healthcare costs for health insurance or health benefit plans. We expect those trends to basically keep steady. Then we get to our actual and forecasted taxable wages in column I, and then our tax collections, which is our revenue forecast in column K. So for the modified business tax for the non-financial sector, we expect to receive $834.2 million in FY 2025, $869.4 million in FY 2026, and $905.8 million in FY 2027. And those are growth rates of 4.5% in FY 25 and then 4.2% in the following 2 years. Chart 1 shows what the last 3 years of our actual collections look like next to our 3 years of forecast. You can see the decline in FY24 due to that permanent rate change that took effect, and we're sort of growing from there. Chart 2, this is what collections look like on a quarterly basis with the past 3 fiscal years, the actuals in green and the forecast years in blue. All right, so with that, I can move to the financial sector with table 3A on page 85. And this table does, I have to note, does have a typo that affects the numbers that you're seeing for FY 2027. It does not affect our actual forecast. It's just when I put this table together, there's a formula error. So I'll read those numbers out when we get to them. So this is the same table that we had for the non-financial sector, showing our employment expectations and wage expectations. But now for the financial sector, we expect employment to grow at 1% per year in this sector, further slowing down from FY 24 following the strong growth that we saw in 22 and 23. And we expect average annual wages to grow at, in that third column, at 5.2% in FY 25, 4.1% in FY 26, and 4.1% in FY 27. That's where the table shows the 0.2%. That should be 4.1% in FY 27. And so similarly, the inflation-adjusted wages should be growing 1.6% in FY 27, not the negative 3.6% shown in the table. So getting to 3B, again here we have the detail on the quarterly wages, taxpayer wages, healthcare deductions, and finally the taxable wages. We expect to collect $43.3 million in MBT from financial institutions in FY 25, $45.4 million in FY 26, and $47.5 million in FY 27. This represents growth rates of 5.9, 4.8% and 4.5% per year. And growth rates are stronger at the beginning of our outlook versus the end, as we also expect a bit of a boon to the financial sector as interest rates begin coming down, might spur some more activity. Here again in chart 1 for the financial sector, we have the last 3 years of actuals and the 3 years of our forecast. And again, on a quarterly basis, what that looks like. All right, and finally with table 4A on page 89, this is our employment and wage forecast for the mining sector. We expect employment to more or less hold steady where it is. The percentage changes, I think, look a little larger than they actually are because employment in the sector is low. And we did see employment in the sector grow a little bit in the latter half of FY24. And so it's kind of, we have it in FY25, 26, 27, just slowly growing from that level. We also kind of, as Dr. Solorio was saying, expect the current composition of mines to generally hold steady, even in the face of these historically high gold prices. Extraction costs and exploration and development timelines they're constraining factors. You can't just get a new mine up overnight. So I actually was looking, and back in November of 2022, my colleague, Ms. Powers, told you all that we saw that mining employment wasn't fluctuating, that the industry had found efficiencies from mergers, and that the forecast assumes a somewhat steady state. And I think that's what we've been seeing and what we continue to expect to see. So moving on to how we get from our gross wage and employment forecast to the actual collections forecast, we expect to get $20.6 million from MBT mining in FY 2025, $21.1 million in 26, and $21.6 million in FY 27. And again, here's what it looks like on a fiscal year basis and on a quarterly basis. So now I can go back to table 1 on page 79, where we bring it all together. And you can see on the bottom, sort of the leftmost numbers are our total MBT collections. We expect MBT to grow about 4.6% in FY 2025, 4.2% in FY 2026, and 4.2% in FY 2027. And with that, I can answer any questions.
Very clear. Thank you very much. Okay, we're going to skip, because we have the state treasurer available to present to us, we're going to skip the order of the different revenues, and we're going to go to interest income. I believe Mr. Conine is joining us from Las Vegas.
And before the treasurer comes up, Madam Chair, this is Michael Nakamoto for the record. I just wanted to point you to page 97 of the Economic Forum packet. The information that Treasurer Conine and his staff have prepared with respect to the forecast begins there. There are about 4 pages of tables, and I will bring those up on the screen for everybody as well. So the treasurer can begin when he is ready, or when the chair is ready.
Madam Chair, this is Zach Conine. Would you like me to begin?
Yes, please.
Excellent. Well, thank you so much for having us here today. I am always, when we have these conversations, joined by our Deputy Treasurer of Investments, Mr. Stephen Hale, who is both smarter and better looking than I am. We will be on page 97 of the packet, as Mr. Nakamoto suggested, and I think this will be relatively quick since we talked about it last week. But thanks so much for giving us the opportunity to be here, and we are, of course, very excited to be one of the major revenue categories. My mom's excited too. Anywho, the first page you'll see are expectations as far as average daily fund balance goes. As a reminder, in the past, what we've done here is we take the average of the last 2 years for that quarter, because we have some seasonality in average daily fund balance, and then we increase it by 5%. Now, in conversations with GFO and with fiscal staff, we have not added the 5% this year, and there's a pretty specific reason for that, which is, though we haven't seen spending from the American ARPA dollars actually leaving the state from a cash balance perspective. We know that there is approximately $1.4 billion that will go out before the spend deadline of December 31st, 2026. And we wanted to reflect that. And it seemed the easiest way to do that, because obviously those dates and times for when those dollars are going out still are becoming relatively better known, right? But we don't know yet. We thought that was the right way to sort of be conservative when it comes to fund balance going forward, and being conservative when it comes to fund balance going forward obviously means that we're conservative about the interest rate environment impacts and what actual interest earnings will make for the portfolio. So that's what we've done to get to the average rate perspective, or the average dollars under management, excuse me. And I'll pass it over to Mr. Hale to talk a little bit about what we did on the interest rate side.
So as we, Stephen Hale, again, for the record, Deputy Treasurer of Investments. On page 98, these are the rates we are using for our projections going forward. As we mentioned 2 weeks ago at the other meeting, these rates come from forward contracts. They're interest rate futures contracts. We think they're a good proxy for trying to predict what interest rates will be, because these are actual contracted deliverable rates that people are currently using to hedge something. So money's being passed back and forth, or transactions are happening based on these. So we feel they're a good proxy. They're easy to find on Bloomberg. We've used this for years. We've had historically good luck, both with this and with the, as the treasurer mentioned, the 5% forecast for the size of assets under management. It's been pretty conservative historically, so we will continue to do that. As he mentioned, the one thing we did change was using 0% growth rate for this forecast. If you go back to page 97, you can see the total fund balances really hasn't changed much over the course of the next 3 years. It's going to finish about where our fund balance is today, about $9.4 billion. The key thing on the first page is actually the general fund, because that's the portion we pay interest out on. It's the 5 columns or so over. It's a slightly smaller number than the total fund balance. It's usually about 60 to 65% of the total fund balance. And again, moving forward back to the page, those are our interest rates. Page 99, you see some calculations for the size of the different segments of the portfolio. That's probably not critical. We've just done that again historically to keep those numbers from back to 2010. And finally, on page 100, the last page, you can see in the very last column, based on the numbers we use for our projected assets and for our projected interest, and the FY total column for the year, you see our projections for the year. So for fiscal year 25, it's $230.4 million. Fiscal year 26, it's $225.4 million. And for fiscal year 27, it's $224 million. And those are my last comments on that. Any questions?
Thank you very much. This is Linda Rosenthal for the record. Sorry, on page 97, the first page in your presentation,
Sure.
Can you explain to me, sorry, I missed how, I know you said the general fund is 60 to 65% of the fund balance, but that's the only invested portion, or how does this work? How am I getting from?
No, so
Go ahead.
sure, Stephen Hale for the record. So the total fund balance does represent all the assets that are invested. However, we don't pay out interest to all the state agencies on all of the, it's what we pay out in interest or earned interest, distributed interest is that usually fluctuates between 58 to 65 or 70% in any given quarter. And you see that in the very last column where it says percent of total. So our interest forecast, what we model for interest rates for the next several years, is based on the general fund portion of the stage. So we are going to pay 3.54% on 4.7 billion this quarter. And that's, again, those are both estimated numbers, but that's where that final estimated interest of 42 million comes from.
And Chair, this is Treasurer Conan. The rest of those dollars obviously still exist. They're just going to other places in the state that are not part of this general fund conversation.
Yeah, I understand now. Thank you. And then I understand the interest rate assumptions based on certain, treasury bill rates, whatever. I'm sure there's quite a portfolio, but typically are the funds invested in risk-free funds or?
Treasurer Conan, for the record, I think in our business, whenever we say risk-free, something bad happens, but I would say relatively low risk.
Are they in treasuries or?
Yes, ma'am. Treasuries, agencies, commercial notes.
Very high quality corporate commercial paper, bank commercial paper. It's all at the very high end of the quality 1P1, A1, P1 plus.
Got it. Thank you very much. Any other questions? Anybody? Well, welcome to the general fund family, or the major general fund family, and thank you for presenting to us today.
Treasurer Conan, for the record, is an absolute pleasure to be here, and we'll see you soon. Thanks so much.
Thank you.
And Madam Chair, if I can add one last comment, this is Michael Nakamoto for the record. When we meet in December, we are hoping to have the best information possible with respect to the year-to-date revenue forecasts. This is one because this is the first time as a major revenue. We're not 100% sure whether we're going to have the first quarter of interest posted. The timing is based on whenever the treasurer and his staff get the distributions done, which oftentimes does not happen until after the Economic Forum meeting in December. I can have conversations with the office to find out the timing, so we at least have an idea going forward, or as we get closer to the December meeting, whether we're going to have additional information for your consideration with respect to the year-to-date actual revenues. Thank you.
Thank you. And I guess at a minimum, again, back in May, when we meet again in May, we'll have much better information and be able to see how this forecast compared to actual results.
And Madam Chair, Michael Nakamoto for the record, that is absolutely correct. By the time we get to May 1st, we'll at least have the first 2 quarters, and then depending on the timing, possibly the third, but I think more likely it would be the first half of the fiscal year.
Great, thank you. Okay, next we'll turn to the real property transfer tax, and we'll start again with the agency. So Mrs. Scott, whenever you're ready.
Thank you, Erica Scott, Department of Taxation, for the record. For the real property transfer tax, I wanted to first display where we've been in order to discuss where we're headed. This time series on the next slide, I have a time series graph that looks back to fiscal year 2004 when real property transfer tax began distributing to the general fund. We can clearly see the housing crash and the Great Recession reflected in this series, declining from fiscal years 2006 to bottoming out in fiscal year 2012. From 2012 to 2019, the revenue was steadily increasing for real property transfer tax. However, when mortgage interest rates were at a historic low in 2020 through 2022, the number of property transfers soared, resulting in extreme gains in real property transfer tax. Fiscal year 2022 set the record of real property transfer tax to the general fund at $177.8 million, only second to fiscal year 2006 of $164.8 million. We can see that a drastic drop in revenue occurred in fiscal year 23 while mortgage interest rates began to rise and the real estate market slowed quite a bit. While this drastic dip in fiscal year 2023 may look similar to fiscal year 2007's decline, the pent-up housing demand, as we discussed earlier in the meeting, continued to show results in real estate transactions into fiscal years 2020 or fiscal year 2024, even with the higher costs of borrowing. Now into fiscal year 2025, we look to our indicators for reference on where we're headed. The department reviewed Moody's forecasted number of Nevada homes to be sold, the new home starts, average home prices, et cetera, and all indicators were on an upward trend within the next biennium, in addition to the forecasted lowering of mortgage interest rates. Taxation's forecast is for a steadying of this revenue and more stable growth in the coming years. So here we have the bar graph for the general fund portion of real property transfer tax for fiscal year 23 and 24 actual revenues. And then in the blue columns, and again, the red columns are the forecasted years for fiscal year 2025. The forecast is 118.23 million, and then 132.33 million in fiscal years 2026 and 138.3 million in fiscal year 2027. So you can see that we've forecasted a slight increase in FY25 with some movement and an uptick in the real estate market, but generally the higher growth years are forecasted for fiscal year 26 and fiscal year 27, accounting for the lowering of interest rates. And with that, next slide is showing the year-over-year change, which works out to 8.5% increase in fiscal year 25, a larger increase of 11.9% in fiscal year 2026, and as interest rates are coming down a bit more, and then stabilizing in fiscal year 2027 at a 4.5% growth rate. And with that, I am happy to answer any questions.
Thank you. Brian Gordon for the record. I'll ask the magical question. Do you happen to know the breakout between commercial, residential, and vacant transfers?
Erica Scott for the record. I do not have that breakout with me. I know our local government, our local government services division of taxation publishes reports. They would definitely be the better representatives to answer that on the spot. I'd have to go to our website and look.
Yeah, no, and I'm not looking for the number, I suppose. It does exist, though. I mean,
yes.
As you build, or the Department of Taxation builds their forecasts, is it done on a sort of a land use by land use basis, or is it done more in aggregate?
Erica Scott for the record. My forecast was done as an aggregate, and heavily tied to numbers of transactions and also heavily tied to the consumer real estate market, residential real estate market.
Got it. Okay. Thank you.
Thank you.
Thank you so much.
Thank you.
Doctor, you're up.
Dr. Solorio for the record. I'm glad this is the last one. I'm getting rooted in this chair already. Okay, so let's take a look at real property transfer tax. This real property transfer tax, it's one of those time series plots that tell quite a bit the story. And the story that it's telling is the housing market. And as Erica was mentioning, a little bit of a history lesson in here, we can see it reflected on the real property transfer tax. As we can see, in the early 2000s, we have the beginning of the housing bubble. You know, banks were giving out loans without doing the due diligence. That put a lot of people into the market and artificially started to inflate the prices of the houses. Then in 2006, we saw the housing prices peak. As we can see, our transfer tax also peaked as well at the same time that the housing market peaked. In 2007, we saw the major housing bubble burst that we've seen. We reached 79% foreclosures in 2007, which rippled to 2008, and a lot of major financial institutions started to have a face insolvency. Some of them declared bankruptcy, and some of them were bailed out by the federal government. That created the financial crisis of 2008 that lasted 1 year and a half or 2 years and a half. Economists debate on how long it lasted. But it created a financial crisis, and it's reflected on the real property transfer tax. Now, in 2013, the housing market started to recover, and or real property transfer tax also started to recover with the market. Now, when we reach 2020 years, we see that the pandemic sparked a housing boom due to the record low mortgage rates that we've seen, and people wanted to have a bigger house because they were stuck at houses, and they were like, okay, I need an extra room for an office, let me go and buy a new house. So they took advantage of the low mortgage rates, and the situation that we saw in 2020 is that we had a massive supply shortage. Okay, the construction industry also saw high increases in prices even prior to the 2020 pandemic due to tariffs wars that were in place, specifically in China steel. So China steel drove the housing market. So there was a huge supply issue. So we have high demand, low supply that inflated the housing market. Now on 2022, one of the things that I forgot to add on my table was that on June 2022, we reached peak inflation. The consumer price index on June 2022 was 9.1%. So that's when the Federal Reserve Bank decided to intervene. They intervened by increasing interest rates so they could cool down the economy. The effect that had on the housing market is that people kind of pushed back from entering the market because a 30-year mortgage loan was around 9%. It was really, really high. So that cooled down the market. And then on 2024, what we're seeing right now is that our real property transfer tax is started to go up because the housing market is started to heat up a little bit. Now, one of the things that we need to keep in mind with this housing market is historical mortgage rates. And this bar chart kind of illustrates what's going on here, and one of the assumptions that I've taken into consideration for my forecast is we take a look at 2020 and 2021, and that's when we reach the historical low mortgage rates, and this is on terms of a 30-year fixed mortgage rate. So we can see that on fiscal year 2020, the average was 3.53%. And then in fiscal year 2021, it was 2.9%, the average mortgage rate. Now, when we moved to 2022, that's when we saw the greatest variation in our 30-year mortgage rates, because that's when the Federal Reserve Bank started to increase the interest rate. So it went from being 3.5, the lowest, all the way to being 6.8. Now in 2023, that's when we have the most aggressive increase rates on the Federal Reserve. So that's when we saw the highest mortgage rates that we've seen in this country. So if you take a look at the max 30-year mortgage rate, it was around 7.2, if I'm just eyeballing correctly, and the average was around 7%. Now, one of the things you gotta keep in mind is that this average mortgage rate was considering that you have excellent credit. If you did not have excellent credit, this stuff was going to be like 12 or 13% on a mortgage rate without having excellent credit, okay? Now, taking a look at the forecasted mortgage rates that are gonna come up for 2025, 2026, and 2027, we've seen that they're not gonna decrease that much. That forecasted is being really conservative. And as Emily was mentioning, the senior economist for Moody's, if we go into a tariff war, that tariff war is gonna create an inflationary effect that might push the Fed to not decrease their interest rates because they will need to combat that inflation that is gonna be product of tariff increases. But it's too early to tell whether or not we're gonna have that tariff war. Hopefully we will not, because that will set back this inflation monetary policy that the Fed had put in place. Now, taking a look at the monthly average of the 30-year mortgage rates, we can see that 2020 and 2021 had the lowest monthly averages of them all. Then if we take a look at what the forecasted monthly average are gonna be, they're still pretty high, you know. This will create a hold-on effect on people who bought their houses prior to 2022. If we can take a look at the graph, we can say that prior to April 2022, the people who bought their houses, and they have zero incentive to sell what they bought on before 2022, because now the problem becomes of, before the problem was, you know what, I'm gonna sell my small house in California and I'm gonna go to Nevada and buy a big ranch for the same price. But now the thing here is that for the same price, you're gonna be exchanging a different interest rate. Probably your house that you bought that is small, you bought it for 2.5% interest rate, and now the big ranch that you're gonna go and buy in Nevada is gonna have a higher interest rate. So now it becomes exchanging a rate on a loan. And you don't need to have a PhD in economics to know that exchanging a 2.5% rate loan for a 5.7% rate loan is not a good idea, okay? So that's why we're gonna have some sort of a holdback from the people who already bought their houses or their residential properties. And the forecasted revenue that I have here is mainly driven by the fact that the few houses that are in the market are going to be sold at average high prices because we're still going to have some sort of people entering the market as the interest rates goes down, and we're seeing it in the marketplace. I was taking a look at some silos numbers, and they're forecasting higher average prices just because people are still going to buy, but the supply is not there. So the few houses that are going to be sold, they're going to be sold at average market price. So that's what my forecast is. It's mainly driven for, is just that small volume, because we don't have the volume to truly increase this real property transfer tax. So my numbers for fiscal year 2025, putting into consideration that supply chain kind of issue that we're talking about, it's for fiscal year 2025 is $120.43 million. For 2026 is $124.54 million, and for 2027 is $127.76 million. Thank you.
Thank you very much. Mr. Nakamoto?
Thank you, Madam Chair. Michael Nakamoto with the Fiscal Analysis Division, for the record. I actually was going to start with the chart on page 105, but basically the chart on page 105 looks pretty identical to the charts that Ms. Scott and Dr. Solorio have presented with respect to the history of the real property transfer tax, with the exception of we actually add we take the 55-cent collections from the consolidated tax distribution because this was primarily a local revenue source prior to the imposition of the state tax in 2003, and we translated those to $1.30 collections just to show a little more of that run-up going into the housing boom and then bust of the Great Recession. But it's basically telling the same story. And on this chart, we actually show our forecast and how we come out of that. But what I'm going to do is I'll go back to page 104, which is our actual forecast. And for Mr. Gordon's question that he had asked previously, we are looking at collections by county as reported into the state controller system and then eventually reported by the Department of Taxation. We do know that the statistics exist with respect to the residential, commercial, and vacant land and the transfers that are associated with that. But our assumption has always been we just look at it in the aggregate, and we're primarily focused on the residential real estate because I think that's driving the market a lot more. For some of these transfers, especially when you start looking at the larger transfers where it's through real estate investment trusts and other exempt entities that escape the tax. So we find probably a little more focus on the residential side as opposed to the commercial side. But that having been said, looking at the collection so far, this is the point where I always talk about how we really don't have the latest information, but we kind of do because we go into the controller system and see what has posted. So for the first quarter of FY25, so it's 2024 Q3, that number of 30,659,000 is our best estimate of what the forecast is going to be, knowing that we have actual collections from 15 of the 17 counties with respect to this tax. It is collected at the county level when the transfer of the title is filed with the county recorder, then they remit the tax to the state. So we actually can see how much it is by month or by quarter. So the only counties that we are missing right now are Esmeralda County and Story County, which Esmeralda County is not moving the needle. It's going to be in the neighborhood of about $5,000 probably. Story County is going to be a little bit more because there's increased activity, especially out at the Tahoe Reno Industrial Center. So there could be some transfers of commercial property there. But we figure it's going to be in the neighborhood of between about $100,000 and $200,000 for the quarter. So I mean, we're not talking about the levels in, say, Clark County, which was of this was approximately 22 million of the 30.6 million. So that's really the tax is driven primarily by Clark County, to a lesser extent Washoe County, and then the balance of the state makes up, probably between 10 and 15% of the collections. So in deriving these forecasts and knowing that we're up about 7.9% year to date, basically what we're looking at is, I think, the story that I told 2 years or a year and a half ago, back in May of 2023, is I didn't have a lot of confidence in the housing market or in real estate coming out of the pandemic. We knew that things were pretty stable, and then we hit the pandemic, and for any number of reasons, be it low interest rates, the desire for people to move to somewhere that was relatively more affordable, especially if they had the flexibility because they were working from home or they could work remotely, and it didn't matter, even if their job was in the Silicon Valley or in Southern California, they could move to Reno or Las Vegas and have no effect because they could still work and they were just working from home, or whatever the reason was. We saw this big run up, and then interest rates went up, and the ever-present supply constraints were there, and then all of a sudden we were trying to figure out where we were going to fall to, and I think my forecasts had it falling a little further than it actually came in. I think I actually, for FY24, I had this tax falling below $100 million back in the May forecast, and we were about $10 million above our forecast. But going forward, I think we still have some of those issues that are present. Supply constraints, especially on the new side, and I think land is it's always the question. People could talk about water all they want, but I think the big issue is more land and the amount of land that's released from the federal government and made available. Over the forecast horizon, we do see the construction increasing, but not at a really significant rate, especially when you compare it to like the early 2000s or later, but there is a fairly steady growth. And so that should free up some sales as well. But I think the constraints even on the existing markets, people being reluctant to let go of their existing houses, again, because interest rates are still a constraint. It's hard if you are in, like Dr. Solorio mentioned, it's hard if you're in a house and you're paying a 3 or 4% mortgage to move out of that house and find a and pay 6% even if you're downsizing your mortgage. I mean, it could be the same mortgage or even go up depending on the scale of how you're moving. So there's still not a lot of incentive for people to be moving out of their existing houses, but there is still supply, and there still is a bunch of people who may be moving from California or other states and simply paying cash. That is one of the realities, and one of the things that we've noticed, especially in the last 6 or 7 years, is because of the hyperinflated prices in California, especially in the big cities in California, the Silicon Valley, San Francisco, even into Los Angeles, that people have gotten enough equity that they're not worried about the interest rate. They're coming in and paying cash. And they, because simply they can afford to, because they built up the equity. So I think that continues to increase. I don't think there's any reason to see any downward pressure on prices, given all of these factors, because of the relatively limited supply, because there is construction, but it's not a significant amount of construction to drop prices. And so as a result, you can see our forecasts on this sheet, where we grow by 8.3% to about $118 million in FY25, and then we moderate that growth a little bit in FY26 and 27, 6.7% growth in FY26, and then 4.9% in FY27. And a lot of that is driven, we believe that prices are going to continue to increase and then maybe stabilize a little bit more as you get into FY26 and 27, especially as interest rates come down. That's one of the concerns. It's like, are interest rates going to fall to the point, they're not going to fall to the point of FY19, FY20, where it was below 3%. Dr. Solario's charts were in the neighborhood of between 5.5% and 6%, and I think that's probably probably a reasonable range. And it's one of the things that even we've been observing as of late, because the Fed had their recent rate reduction. But interest rates for 30-year mortgages didn't follow. In fact, for a very short period, interest rates for the 30-year fixed mortgage actually increased very slightly, and then they fell a little bit. So there's not a lot of, at least in the near term, we're not seeing a lot of sensitivity between those. But we assume, I believe, the same as everybody else, that those will stabilize out by maybe a percentage point. Again, not enough to drive significant activity, but enough maybe to drive a little bit. But again, it's probably more at the margin than anything. So with that, Madam Chair, I would be glad to answer any questions. Thank you.
I guess I'll just, Jennifer Lewis, I'll just make the comments that we've been watching. I watch the data pretty carefully on land, more so than housing. But what I'm seeing too is like there's a recent land auction 2 weeks ago, and land historically, like a year ago, is probably at $1 million an acre, and this reset it up to about $1.2 million. And so just doing the math and triangulating, by the time that gets put into production in a year and a half, 2 years, optimistically, there's no room for the price to go down maybe a little bit with the contractors, the labor, but there isn't really, just mathematically, no one's going to build anything if they're making less money, if it's not a fun project to do it for free. So it's fun, but it's not that fun. So I think there's really no evidence to me that anything with the house prices will go down. And I think the other observation too is I track kind of some of the commercial transactions, and periodically you'll get like an industrial park will go for $100 million, and so that can change kind of the flavor of it. And we have seen that a little bit, but I don't know exactly how to predict if that'll continue that trajectory like it has this year. But
Ms. Lewis, Michael Nakamoto for the record, and you're correct. It's given the trends with land, and it's not a new development, so that the land prices in Nevada and southern Nevada are increasing, but along the same lines with wages increasing, and then the cost of materials increasing at some rate. You're absolutely correct. There's not an incentive for new home builders to be building homes that are lower priced than they are now, and I think to that end it kind of carries the existing along with it, because in a sense it's is somebody going to knowing that the price of a new home is going to go up? I think a lot of sellers are looking at this and it's like, well, maybe I can get a little more for my existing home also. So they might not necessarily move at the same rate, obviously, because they've got different dynamics going on, one being purely market driven, but the other having more components going into it. But I think that's some of the things that we were looking at is Ms. Mandel during her presentation, and the Moody's baseline forecast, which is actually in our assumptions at the beginning of our packet. They actually have the Case-Shiller home price index falling throughout the horizon, and so I don't think the conditions right now are necessarily support that. Not that we're seeing sky-high growth, but I think there's still some room for growth, at least during the forecast period.
I just say my experience with this tax over a lot of years, because I used to forecast it when I was in local government, and there's so many variables and working against each other, and interest rates and people from California and the housing market, that at the end the estimate is really a guess. I shouldn't say that, but I think that's really what it is.
And Mr. Levitt and Michael Nakamoto for the record, and you're absolutely correct, is like we're trying to look at any number of factors relating to inputs, Commercial transactions, which I think have been noted, are fairly unpredictable, especially when you get into the significant transactions. That, I mean, we can go back and look at the history, because I talked about Story County, for example, where I have a reasonable estimate of about $200,000 for their collections. But if I go back and look at this same quarter in FY24, I believe it was $897,000. But then you go to the first quarter of FY22, and I believe it was $97,000. So is all it does, all that you need, and you can especially see it in these small counties, is you just need one big transaction of a commercial nature, and all of a sudden you're just like, okay, what happened here? It's like you don't notice it so much in the bigger counties. Obviously, in Clark and Washoe, you could have a larger transaction and it just kind of fits in there. But I mean, obviously, these larger transactions, they can occur. It's just trying to time when or where they might occur. So that's, we tend to look at some of the things that are a little more, I don't know if predictable is the right term, but at least the residential side is enough of a driver that I think for us it provides maybe not the best picture, but about as good of a picture as we can get.
Linda Rosenthal, for the record. I mean, I think everything you guys are saying is kind of evidence in the forecast, right? Because it sounds like all of you have pretty much the same assumptions, pretty much the same mindset of what's happening with the inputs, and the numbers aren't crazy off. But I mean, there can be a $8 to $10 million swing amongst your forecasts, even though you're all of the same mindset. So again, there's just some guesswork you have to do with this one tax in particular that make it a little tricky. Anything else on the real estate transfer tax? Okay.
I suppose one good thing about it, if we're off 30%, it's not such a huge revenue that it's, on a statewide revenue basis, it really changes the whole complexion of the thing. Not, if sales tax was exactly the same kind of a problem, then we'd really have a problem. But this one, given its size and everything, it's not such a bad thing.
And Mr. Levitt, Michael Nakamoto, for the record, you are correct about that, given the scope and magnitude of this compared to the sales tax, for example. You're correct. Missing this revenue forecast by 30% isn't going to necessarily kill the state. But as a forecaster, I would prefer to not have my forecast missed by 30%.
Okay, great. Then the last major revenue source to discuss today is the commerce tax. Mr. Nakamoto, are you speaking to this one? Thank you.
Thank you, Madam Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. For the record, the commerce tax tables for the consensus forecast between the Fiscal Analysis Division, the Budget Office, and the Department of Taxation can be found in the Economic Forums packet beginning on page 91, and there's a series of 4 tables or 4 pages, so there's 5 tables that I'm going to go through as part of this. And so this is the methodology that, since the commerce tax came into place, that the Economic Forum has used with respect to this consensus revenue forecast. And basically, I think the logic when we first started the forecasts for the commerce tax as a major revenue was that we simply didn't have enough information. It was a brand new tax put into place during the 2015 session, first collected in FY 2016. And so as a result, right now we're at 8 or 9 years of actual revenue. But as we've kind of gone through this process, we found actually the methodology and the forecasts we've come up with have been fairly reliable. That it's not a completely predictable tax, in terms of how the tax is paid, especially because of the timing of the tax. And so when it was put into place in the 2015 session, there was a desire to get revenue perhaps as quickly as possible. So it's an annual tax, but the tax is due 45 days after the end of the fiscal year. So that day, barring a weekend or a holiday, is August 14th. The last reported taxes from the Department of Taxation normally are toward the end of August, and we close the fiscal year, the entire state closes the fiscal year by the third Friday in September, which this last fiscal year was September 20th. So this gives the Department of Taxation about 35 days, give or take, to process all the returns, make sure everything is squared away, and get the money in the state general fund before the fiscal year closes. But what often happens as a result of this is if a taxpayer wants to pay late, they have the ability to file an extension to pay their taxes at a later time. But that often pushes the tax payment into the following fiscal year. So that's one of the things that we're really having to account for in terms of lining up when the taxable year for which the tax was due versus when the tax was actually paid, because you have a significant amount of tax in many instances that, for example, might have been due on August 14th, 2023 for FY23, but they filed an extension and it ended up paying it in late September or early October, so the revenue gets credited in FY24. And so the tables that we lay out are kind of trying to reconcile that and get all of the money back to the business activity period for which it was generated, and then trying to move it back for the accounting period for our forecasts. So Table 1, which is on page 91, is basically looking at the from between FY20 2020 and FY 2024, the commerce tax based on the fiscal year activity period. So it's the commerce tax that was due based on the activity that occurred in that fiscal year. And so you can see for FY 2020 through FY 2023 actual to date, we have numbers in there. And the reason why we have actual to date is because on a constant basis, we could have taxpayers paying for fiscal years in the past. And so in FY 2024, for example, we actually received money from commerce tax that was due in FY 2016. So these numbers are constantly changing because we have to take that money and put it back in the activity period. So we're constantly trying to track this. Fortunately, that number gets less and less over time. It was something like $25,000 or something that was paid in FY24 that actually belonged to FY 2016. But these are the things that we're trying to track here. And so the numbers for FY 2020 to FY 2023 are basically what the Department of Taxation has told us was paid based on that activity period. So then you get to FY 2024 and we list estimate. And basically what that is we know how much commerce tax was paid in FY 2024 based on the tax activity in FY 2024, but then we have to come up with an estimate of the 2024 tax activity tax that's paid in FY 2025 and going forward. And so basically what we're saying is it was about $299 million that was paid in FY 2024 based on the 2024 activity period. So really we're saying about another $30 to $33 million. It's about 11% is paid in subsequent fiscal years. And then you can see that in the various columns there are a number of estimates that are put forward. And so the first one that says commerce tax, Moody's forecast growth, that's looking at the Moody's Analytics forecast for Nevada gross state product, which is not a pure match, but it's a fairly reliable match. It gets fairly close in a lot of situations, either positive or negative, but it was a good starting point for us to look at. And so Moody's October forecast for Nevada gross state product was 5.5% in FY 2025, 5.6% in FY 26, and 5.4% in FY 2027. And so then after that, we put in some various alternative scenarios that were kind of a little bit lower or a little bit higher than that. And so so based on the conversation between GFO and the Department of Taxation and the Fiscal Analysis Division, the Commerce Tax consensus estimate, the right-hand column, that's the one that is the gray highlighted one, we went with the third scenario, so that the middle one, it's 6% in FY 2025, 5.5% in FY 26, and then 5.5% in FY 2027. So fairly close to the gross state product forecast, but a little higher in FY 2025. And so the consensus estimates that come out of this is our estimate of the taxable activity that is going to occur based on what happens in FY 25, 26, and 27. So then turning to Table 2 on page 92, this is now where we have to go and take all of those collections and put them in the right buckets in the right fiscal years. And so then what you can see is for all of those scenarios, we've got the FY20 through FY24 actuals, and this is the actual amount of revenue that we're reporting that was posted. It was collected by the Department of Taxation in those fiscal years. It was deposited in the controller's office. When we have our actual sheets and all of our tables, this is the number that shows up. So you can see in FY 2024, it was 343.1 million, or just short of that, or a growth of 13.5%. And one of the things that we observed while we were looking at the collections, because one of the other things that we then do is say, okay, of these collections in FY 2024, what fiscal year did they belong to? So was it 24, all 24, or most of it 24, or how much was FY 23 or previous fiscal years? Because again, there was FY 2016 money that falls into this. And so what we found is that normally it's in the neighborhood of about 11.5%, and I think that's the average over several fiscal years, 11.5%, give or take, of the revenue that's collected in any given fiscal year belonged to a previous fiscal year. In FY 2024, though, that number was very close to 14%. So a significant amount of the revenue that shows up as actual collections for FY 2024 wasn't based on FY 2024 activity. It was based on previous fiscal years. So people were simply paying late. And the bulk of that was from FY 2023. So it was probably instances of people asking for that extension on or before August 14th, and then not paying their tax until late September or early October or later after the fiscal year had closed. So that it's just that the timing of the tax and the things that are going on there. So for, what we then have to do is kind of looking forward, what do we think that mix is going to be of what's paid in the current fiscal year from that activity, plus what is paid from previous fiscal years. And we think that 14% is obviously too high, that's not necessarily going to repeat. So we actually brought that percentage down to about 11%. And then in FY 26 and 27, we reduced it just a little bit further. But then you can see in each of the scenarios what that does to the growth rates of the collections, because we don't have such an emphasis on the collections, especially in FY 25, from the previous fiscal years. So when you get to that consensus estimate, so it's that same 5.5 and 5.5 growth, the 6% growth in activity period, once you start accounting for these payments and the timing of the payments, it translates to 3.2% growth in collections. Simply put, because we are not collecting as much of these later payments in FY 25, or we don't anticipate that we are going to be in FY 25 compared to FY 24. And then as you get out to FY 26 and FY 27, you can see this start to even out as the percentage stabilizes. So there's 4.6% growth in FY 26, and then 5.5% growth in FY 27. And again, this is not so much driven by the economic activity so much as it is the timing of the collections, and that's really the explanation we have for the consensus forecast of why that growth rate is low, because just of the anomaly dealing with the collections from previous periods being so high from FY24 that we don't anticipate is going to repeat in FY26 and 27. So then the next table is Table 3, and this basically just is going through some select economic indicators for the Nevada economy. So you can see the commerce tax, the business activity collections, including that estimate of the $332.6 million of what we think is going to be generated in terms of taxable activity from FY24. The Nevada gross domestic product, which is that gross state product that I referred to previously, and then statistics on population, personal income, total employment, and then we take some of those metrics and kind of put them into what is the commerce tax per $1,000 of GDP. And I'm noticing, looking at this, that we have a formula error in that one. It should not be in the hundredths of a cent or the tenths of a cent. It actually should be about $1.20. And so we will fix that. That was something that I should have caught, and I think I did catch, but I think an old version of the tables got in here. But you can see from those kind of metrics, we're looking at fairly stable growth in the tax. Again, the 6, 5.5, and 5.5 in terms of the activity period, but we have a little bit less growth because of the issue with the late payments, and then correcting that a little bit. And then so lastly, Madam Chair and members of the forum, on page 95 is a set of 2 different tables, and this is basically with respect to the commerce tax credit against the MBT. And so when the commerce tax was put into place, one of the provisions that was agreed to is at the time, the rates for the modified business tax were increased as well. But to provide a little bit of equity or relief to businesses that happen to be particularly labor intensive, there was an agreement that up to 50% of a taxpayer's commerce tax liability could be taken as a credit against the modified business tax in the following fiscal year. And so these tables kind of lay out the commerce tax and the commerce tax credits and comes up with a forecast for it. So tables 1 and 2 lay out the commerce tax and the commerce tax credits based on the fiscal year business activity period. So it's for commerce tax, it's the commerce tax that was paid in that fiscal year for the fiscal year. And then after that, it's the commerce tax for that business activity year that was paid in future fiscal years. So it's kind of equivalent to when we look at Table 1 of the other set. And then we do the same thing for the commerce tax credit. So for each of the commerce tax credits by fiscal year, it's the commerce tax credits that were used in a fiscal year based on the commerce tax that was paid in the previous fiscal year. So it's lining that up. And then we also have in the next column the commerce tax credits for that MBT fiscal year that was paid in future fiscal years. And what can happen is you have late filers of the MBT, they can amend returns, but they still have this commerce tax credit they can use based on whatever, even if they pay it in FY 2024, for example, if they had a commerce tax credit that they earned based on what they paid in commerce tax in FY 20, they can still use it against their FY 2021 MBT, even though they might have been filing and paying that MBT in FY 2024. So that's really trying to account for that. And so then you see the percentage that's listed there. It's MBT commerce tax credits as a percentage of the commerce tax. I mentioned that the commerce tax credit can be up to 50% of the commerce tax that's paid. The reality, though, is not all 50% of the credit is taken. We found just over history that it started a little higher But then I think as the MBT rate has decreased over time, the percentage has gotten down to the point where it was at 19.5% in FY 2024. But then you can see going forward, our assumptions for FY 25, 26, and 27 are that it stays at about 20%. And so then for Table 2, this is again measuring the same statistics based on the accounting period. So it was not necessarily the business activity, but it's based on the tax paid for that fiscal year, irrespective of the business activity period. So and this is again analogous to Table 2 that we had gone through before. And so we have to do some gyrations and everything to get it translated here. But then we do the same thing for the commerce tax credits. So basically what we're looking at is how much commerce tax credit was used in a fiscal year based on for the current business activity period. And then we have to look at the commerce tax credits that are used in a fiscal year based on previous activity. And so you can see that percentage is still, again, fairly stable in that it's just under, we have it falling just under 20%, but then coming up to just over 20%. And so the forecasts that we have for the commerce tax credits are at the bottom line there for FY 25, 26, and 27. So approximately $67.6 million in FY 25. Approximately $70.4 million in FY 26, and approximately $74.3 million in FY 27, compared to the FY 2024 actual that's listed there of just short of $60.5 million. But it's one of those, as the commerce tax and the MBT are growing, that we're finding, or we think that they're going to grow fairly consistently together, so that percentage stays around or just under that 20% range. So I know that was a lot to go through, and this is the point where if or when you have questions, please feel free to ask them. Thank you.
I didn't hear any of that. Could you start over again? No, just kidding.
You know, they must have had a hard night before they designed this commerce tax. The complexity of it and the credits of it and the timing of it and everything. I've never seen one quite that bad. I should say that I see some of the local government ones, computations are maybe that bad, but as far as normal taxes, I haven't seen one.
Mr. Levitt, Michael Nakamoto for the record, and having been with LCB during the 2015 session and being not necessarily directly involved, but a little bit in the periphery when this was designed at the behest of Governor Sandoval at the time. And I think Mr. Gordon is nodding in agreement. This is a very elegant solution that was put together by those people who were working with the governor and his team at the time.
Great. So let's move on to agenda item 8, which is the review and approval of the preliminary forecasts of the minor general fund revenues and tax credits for FY 25, 26, and 27 that were approved by the Technical Advisory Committee on Future State Revenues at its October 30th, 2024 meeting.
Thank you, Madam Chair. For the record, Michael Nakamoto with the Fiscal Analysis Division. I apologize, I left all my notes for agenda item 8 over at the other table. I should have had them with me. But for agenda item 8, this is the summary of the non-major general fund revenues, or what we would call the minor revenues, that were considered and approved by the Technical Advisory Committee on future state revenues at its meeting held on October 30th, so last Wednesday. So to set the stage for this, I will just point out there are 3 tables in the Economic Forum packet. The first is Table 5, which begins on page 101. And so I had previously mentioned Table 4 as just kind of a summary of the major general fund revenues. Table 5 is the non-major version of Table 4. So we go through and lay out the FY24 actuals as well as the forecasts by forecasters. So again, the agency, the Fiscal Analysis Division, and the Budget Office for FY 2025, 26, and 27. And then you'll see numbers listed for the Technical Advisory Committee. Those are the numbers that were approved as part of the Technical Advisory Committee's forecast at their meeting last Wednesday. And so there are not all of the minor revenues listed there. There are 10 revenues that we consider to be the so-called major minor revenues, ranging from unclaimed property and Secretary of State commercial recordings and securities, some of the larger ones going down as small as the Athletic Commission fees, which are the basically is charged on the admission on unarmed combat, so boxing, mixed martial arts such as UFC and the like, which, depending on the fiscal year, is kind of a major minor revenue source. But right now, it's only in the neighborhood of about $6.5 million per year. But that's one of the tables that we have in there. Table 6, which begins on page 103, this is the entirety of the forecast that was approved by the Technical Advisory Committee at their meeting last Wednesday. This is what I'm going to focus on after I talk about Table 7, which is the next one on the list, which is on page 115, and this is kind of the summary of the forecast. So we, again, spell out some of the major minor revenues and then put together an all other, and then go through the tax credits, which I'll go through as part of the presentation on Table 6. But then it gives the bottom line, so you have a kind of an apples-to-apples comparison of what the forecasts look like for FY25, 26, and 27 for these non-major general fund revenues compared to the FY24 actuals. So I can have you go back to page 103, and I'll go through not all of the non-major general fund revenues, but I can go through at least some of the highlights of this, some of the larger ones. And so for context with respect to the process is beginning very shortly after the end of the fiscal year. Like I said, the fiscal year closes on September 20th, or it closed on September 20th. It's the third Friday in September. Very soon thereafter was, I believe, Wednesday of the following week, we sent out requests to the relevant agencies asking them for their forecasts for each of the revenues on the general fund revenue sheet for FY25, FY26, and FY27. That included sending, and so we sent requests to Mr. Lawton at the Gaming Control Board, Ms. Scott at the Department of Taxation, to the Treasurer's Office, because they've got some that are on the non-major list. And again, following the direction that was given to this body with respect to what is a major revenue and what is a minor or non-major revenue from the June meeting, because we had that on the agenda then. And then it is then incumbent upon Dr. Solorio at GFO, as well as our staff, to come up with our forecasts as well. And so the end result are the forecasts that you see back in the previous agenda item under Table 3, lists all of those forecasts that were submitted by each of the forecasters. And so then after we receive all of those, there is a meeting between our staff at Fiscal along with GFO, so Dr. Solorio, to come up with a consensus for presentation to the Technical Advisory Committee. And so it's looking at, okay, what are the reasonable forecasts? Can we go with an average of them? And we agree wherever we can agree on a forecast, and then present that to the Technical Advisory Committee, go through and talk about the decisions that were made, some of the assumptions that we're looking at, and then it's up to the members of the Technical Advisory Committee to then deliberate and approve forecasts for those non-major revenue sources as well as for tax credits, and I'll talk about the tax credits as well. So what you have in Table 6 is the consensus forecast that between GFO and the Fiscal Analysis Division that was approved at that meeting. So beginning on page 103, is the taxes. And so you can see some of the taxes that are listed. Obviously, the sales and use tax and the major revenues are blank because they're under the purview of this committee rather than the Technical Advisory Committee. The mining tax, the net proceeds of minerals, and the gold and silver gross revenue tax, those had no forecast because of previous legislative actions in the 2021 session that moved those revenues to the State Education Fund beginning in FY24. We leave them on the sheet just for posterity, but there are not forecasts to be considered for that. Those revenues go to the State Education Fund. Or shall I say there are not forecasts to be considered by this body. There will be forecasts done, but that is part of the forecast process for the State Education Fund. That's not part of this. So with respect to the gaming, the block of gaming taxes, you can, there's about 15 different fees that are listed there. The forecasts that were approved were those that were done by Mr. Lawton at the Gaming Control Board. Again, he has the expertise and has the communication, direct communication with the operators on a lot of these, and then they've got other things that are going on. Kind of in terms of the highlights or the significant changes from FY24 to FY25, and the first one is GL 3042, the gaming penalties, that you can see was approximately $10.9 million. That went down to $850,000 in FY25, and then down to $700,000 in FY26 and 27. The $10.9 million was a one-time fine that was levied very early in FY24 that was not anticipated. That is not going to repeat unless the offender decides that he wants to generate another fine for the state. We'd appreciate that, but I don't anticipate it happening. Based on the information that Mr. Lawton gave, though, there's a Northern Nevada operator who was anticipated to be issued a $250,000 fine by the Gaming Commission right around this time, which is kind of in the forecast for FY 2025, but again, not anticipated to repeat. So this is one of these that is kind of at the, it's not necessarily a stable or predictable revenue source, but I think the normal, absent any of these large $10 million fines or even the $250,000 ones, is kind of in this range, and so that's where we fall down to. And then the other one that's worth pointing out is GL 3046, the advanced license fees, which you can see was approximately $9.6 million in FY24, but then falls down to about $550,000 in throughout the forecast horizon. And so the advanced license fee is kind of what primes the gaming percentage fee. New licensees, whether they're opening a new casino or there's been a transfer of a license, they have to pay a fee equal to what 3 months of what their estimated gaming percentage fee is to kind of prime that tax. And so in previous fiscal years, this goes up when there are large casino openings. So in FY24, you have things like Fontainebleau and the large properties that are opening. Mr. Lawton's information says that there aren't any of these significant properties opening in the forecast horizon. So we're down to kind of the normal churn, which is relating to like transfers of licenses and things like that that would trigger the fee. And then, going down toward the bottom, GL 3073, the Transportation Connection Excise Tax. This is commonly referred to as the Uber-Lyft tax. It was passed in the 2015 session as part of the structure to regulate the network carriers such as Uber and Lyft. And put a 3% tax on the fares that are charged, but it also applies to other common carriers such as taxi cabs. And so one of the things that you'll notice on this is that it goes up fairly substantially in FY 2025 and then down in FY 2026 and up in FY 2027. And part of that, or the reason for that, is because the first $5 million of this tax that's collected in each biennium actually goes to the State Highway Fund. So when we're looking at this, we actually kind of have to put that in, do our forecasts, and then back it out. So the actual activity for the tax is higher in FY24 and FY26 than what shows here, but we are showing the general fund portion, and we have to back that $5 million out. So that is kind of what causes those big spikes and then the decrease, and then having it spike again between FY26 and FY27. With respect to the cigarette tax, this is imposed at a rate of $1.70. That goes to, actually it's $1.80 per pack. $1.70 per pack goes to the state general fund. The other 10 cents per pack goes to local governments through the consolidated tax distribution. Basically what we found is that as smoking becomes less popular, obviously the number of packs for which stamps are issued, because this is basically a stamp is purchased from the Department of Taxation and affixed to the pack, that number is going down, and there's no reason to believe that it's not going to continue going down over the forecast horizon. So is this a good time to stop for questions, Madam Chair, or would you like me to kind of go through the rest of the total taxes?
I'm not seeing any questions, so if
Okay.
you want to continue, that'd be great.
Okay. Thank you, Madam Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. I will have you skip page 104 and the first half of page 105, because this is where the modified business tax is, and this is, again, under the purview of the Economic Forum as opposed to the Technical Advisory Committee. And then at the top of page 106, 105, is the insurance premium tax as well. So in terms of what's on the rest of page 105, under other taxes, the business license fee is the annual fee that has to be paid by entities doing business in the state of Nevada, be it a corporation, an LLC, or what have you, as well as entities who may not be actually doing business in the state, but who have registered, filed their articles of incorporation, or registered as an LLC or whatever entity with the Secretary of State's office, and they're required to obtain that license as well. And so it's at a rate of $500 per year if you're a corporation, but it's $200 a year for any other entity. So the growth in this is basically it's a mix of activity of local businesses within the state who are being created or renewing, as well as businesses who may be not physically located here, but they're using Nevada to form their corporation or LLC or what have you. This has kind of had a long-term trend of because of the difference in the price between the corporation and the non-corporation, the number of corporations who are receiving licenses kind of goes down, but then the number of non-corporations who are getting licenses is going up, and the net is an increase, but it's not a huge increase, but it's to the tune of between $125 and $129 million per year throughout the biennium. And this is now, I believe, the largest of the non-major revenues, now that cigarette tax has kind of fallen below that. With respect to the liquor tax, you can see that there is steady growth in the tax through FY25, 26, and 27. I would note, though, that the 3% decrease in FY25 is as a result of one of the things that we noticed is that we were trying to figure out why there was such a drop-off, or actually what we determined is FY24, you can see, was just over $49 million, and that was a significant increase compared to FY23. So as we were looking at it, we found that there were not a lot of collections in June of 2023, but July of 2023 was unusually high. So we talked to the Department of Taxation and found one of the significant taxpayers, and these are your liquor wholesalers and the like, had actually filed their June 2023 return in July of 2023. So money that belonged to FY23 actually got put in FY24. So FY23 collections were low, FY24 collections were high, and then it drops off again in FY20 or in FY25 just to annualize to that. And so that there's not a significant change in the number of gallons of liquor that are being imported into the state. This is an accounting issue that accounts for that decrease. And I hope that made sense. So the next one below that, GL 3053, is the other tobacco tax. And you can see that there's a decrease from FY24 to FY25 and then throughout the forecast horizon. And there are a couple of things that we think are going on here. The first is Assembly Bill 232 from the last session, which I've mentioned at previous meetings. So the tax on other tobacco, it's anything that's not a cigarette, is taxed at 30% of its wholesale price. And so there was legislation passed in the last session that said that if it was a premium cigar, so if it's hand-rolled and all of that and doesn't have a filter, it's taxed at 30% of its wholesale value, but it's between 30 and 50 cents. The tax can't be lower than 30 cents, can't be higher than 50 cents. And so there, as we've gone through the analysis, there's been a significant revenue loss from this because there are a lot of cigars that are imported into the state. But the other thing that we have observed is the other tobacco tax since about 2019 has picked up e-cigarettes and vapor products, which was a significant boom to this tax in the first several fiscal years. But I think as time has passed, the idea that vaping was perhaps a safer alternative to cigarettes may be fading a little bit. And so I think people, whether they're substituting to other products such as cannabis or they're just quitting altogether, I think vaping may be falling out of favor a little bit. So that's, I think when we looked at this, that's kind of the logic we had for having this decrease, is just the demand for these products is going to decrease a little bit more. And then lastly, the branch bank excise tax, GL 3068. This is not a huge revenue source, but it's worth noting because Dr. Solorio had actually mentioned it during his kind of the driving factor in his MBT financial institution forecast. This is a tax that is $1,750 per bank branch per quarter, with an exemption for the first branch located in each county. So Dr. Solorio mentioned, and we wholeheartedly agree, is, and we look at the FDIC's website because you actually can go to the FDIC and say, who are what are the branches that are located in the state by bank? And they list it by county, and so we have just steadily watched this list decrease. Because again, I think especially the larger banks are realizing a lot of people are doing their banking online, over the phone. You can take a picture of a check and deposit it through the phone apps and things like that. So there's a lot less demand for people that actually physically walk into a bank and do their business. So branches are closing, and they've been pretty constantly closing for a while, but especially after the pandemic. I think that caused a real fundamental shift in the way that people are banking. And so as a result, this has been declining, and we anticipate it's going to continue to decline, especially with some of these larger banks, Bank of America and Wells Fargo, trying to figure out what is the sufficient amount of branches that they need. So at that point, Madam Chair, I'm going to skip tax credits for the time being, and I'll go through that at the end. But I'll see if there are any questions on anything on this page.
I think we're good. Thank you.
All right, thank you, Madam Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. So on the next page is licenses and fees and fines, and I'm only going to go through a handful that are on here. Namely under Secretary of State, commercial recordings is the big one here at just over $90 million. And this is kind of when I had talked about the business license fee and how it applied to the entities from outside the state who come here. Or they're actually doing business here, but they want to create a corporation or an LLC or a partnership. There are fees that attach to that, and a lot of it depends on like the value of the shares and things like that, but this is where the revenue is deposited. So the forecast you can see here, again, has fairly stable growth in this. There is always competition in this venue. Nevada, for the longest time, has always been favorable for entities to come and form a corporation or an LLC here because historically the laws for corporate protection and piercing the veil, so to speak, for any entity have been fairly favorable. But with rate increases in other states, Wyoming, Delaware, also having fairly favorable laws, it becomes a more competitive thing. So the growth is fairly moderate, low to moderate, but this is kind of in line with what it's been as of late with respect to this. And then lastly, on this.
Mr. Nakamoto, can I just interrupt real quick? I
Sure.
just want to make sure I understand that. So these are the, and I realized we were going to get down there, these are the commercial recordings. These are like foreign entities deciding to record here in the state of Nevada. The business licenses we sort of walked through earlier, those are simply the businesses that are recording here and doing business here?
Mr. Gordon, Michael Nakamoto, for the record, yes, you're correct. The commercial recordings, it could be a corporation or an LLC that's doing business here, but I think, I don't know if it's predominantly, but I think that you've got this bigger mix of entities who are not physically located in the state but decide that they want to form their corporation here. So let's say, for example, and they're not a Nevada corporation, but let's say Tesla, just as an example. Even though their headquarters were previously in California, but now that they've moved to Texas, they could very well have formed their corporation under Nevada laws and paid everything here and received the benefits of Nevada's corporate laws without actually having their headquarters or anything here. And so that's not an uncommon thing for businesses to do. And so it is generated over the years a not insubstantial amount of revenue for the state general fund. The business license fee is it's the corollary to that in that anybody who forms their corporation here, so if Tesla had done that, even if they didn't have a location here, they'd still have to get the state business license, but it also applies to your mom and pop liquor store, Walmart, any business who is on any street corner here also has to get a state business license. So it's, even if like it's a sole proprietorship, unless they meet certain thresholds, and it's a home-based business, or there are some other exemptions that go along with that. But I mean, ranging from your grocery stores to your Walmarts to all of these people who have a physical location and are selling things out of a storefront, they will have to get that business license as well. So they're kind of linked in a sense, but there's a little bit of difference between the two.
I see. They're both about $100 million, but one is the license to do business, one is just the commercial recordings that take place.
Correct.
Got it. Thank you. Sorry to interrupt.
That's quite all right. Again, Michael Nakamoto for the record. The Secretary of State Securities, GL 3050 or 3152, is the last of the kind of larger Secretary of State ones of the three that have been discussed. And this is anybody who acts as a broker like a stockbroker or securities dealer, or it's a firm that sells securities or offers that kind of service has to get a license. And this one it's been a fairly low but fairly stable increase in that revenue source. Just over $37 million per fiscal year. And then lastly, I would point out the last one under licenses is the athletic commission fees that we've discussed previously. The athletic commission for unarmed combat, so boxing, mixed martial arts, slap fighting, whatever is under their purview, they charge a fee of 8% of the admission price. So it's similar to the live entertainment tax, in that it's charged based on the admission price. The rate is slightly lower, and then the distribution is slightly lower as well. They're able to keep a quarter of that fee for their own budget, but then the remainder, the 3/4, goes to the state general fund. So the activity dealing with UFC and the like falls in this category here. And so the Athletic Commission had given us information saying that, FY 24 was fairly high because of 2 large UFC events. They had the UFC fight earlier this year at Sphere, which is going to generate a little bit of money, but basically the Athletic Commission was saying we don't think FY25 is going to be as strong, or at least based on the information that they're getting from UFC and some of these larger events. And so the forecast has it falling off and then coming back a little bit in that respect. So then under fees and fines, I'm really going to talk about one here, and that's the short-term car lease, GL 3066, because it's by far the largest in this category. And so this is the 10% fee that attaches when somebody rents a car in the state. It also includes a portion that applies to so-called peer-to-peer car leasing companies. So Turo is the best example of this. It's the easiest way for me to explain it, it's kind of like Airbnb for your car. So you go on these platforms, and instead of somebody can come to you and rent your car, your personal car, instead of going to Hertz or Avis or whatever of the car companies. And so the taxes on that are equivalent, but we roll them together because of confidentiality and disclosure issues. So you can see that there's a little bit of growth in this, not as much as you would see, for example, in the TNC, the Uber Lyft tax. I think what we're finding is people still rent cars, but you might have a little more comfort with visitors coming to Las Vegas who are deciding, yeah, I'm okay getting in the back of a taxi cab or an Uber or a Lyft, as opposed to renting a car, dealing with parking, dealing with traffic, which is terrible at the best of times on Las Vegas Boulevard and the like. And so we see it growing, but not by a significant amount compared to the TNC tax. So with that, Madam Chair, I can see if there are any questions on this particular page. Otherwise, I can move on to the last page.
I'm not seeing any questions. Please continue.
Thank you, Madam Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division for the record. I think I said that twice. So under use of money and property, predominantly this is repayments of general fund loans. And basically what happens from time to time, the legislature passes a bill that makes an appropriation of general fund revenue to an agency for a specific purpose, with the agreement that that agency is going to repay the state general fund over a set number of years. And it could be a fixed repayment, could be an accelerated repayment. But all of these forecasts here are based on the statutorily required repayments of revenue. The largest one being the $3 million per year from SB 450 of the last session, where $12 million was appropriated to the city of North Las Vegas relating to the Windsor Park neighborhood in the city. And that's received a lot of news coverage as of late, but even when it occurred. And so basically what happened is the residents of Windsor Park, which is right near the Las Vegas, or the North Las Vegas airport, pardon me, over the years have found that their homes have been sinking because so much groundwater was pumped out from underneath their houses. Basically everything sank. So the houses are in disrepair and not fixable, and so there was an effort in SB 450 to put money towards that. So there is federal money going towards it, as well as $12 million of general fund that was given to the housing division, with the end result of basically taking the residents of Windsor Park, moving them to a different area within the city of North Las Vegas, and basically constructing or building them a house that is roughly equivalent to what they had in the Windsor Park neighborhood. And so the terms of this this repayment is, even though the money comes from the state general fund to the housing division, the repayment comes from the city of North Las Vegas. They are required to pay back $250,000 per month for 4 years to get to the $12 million that comes out of their consolidated tax distribution, which is significantly higher than that, but they chose a low amount just to not harm the city of North Las Vegas. So that's where that comes from. And so the forecast for FY 25, 26, and once you get to the end of FY 27, it's the full $12 million and it fully repays. So other than that, treasurer's interest income, as you can see, is blank, again, based on the decision made by this committee to move it to a major. Otherwise, it would have been on here. So lastly, under other revenue, kind of the two highlights that are, or actually three, I think, that are worth pointing out is first GL 3047, the expired slot machine wagering vouchers. This is the Gaming Control Board, again, Mr. Lawton's forecast that we all agreed on. And so basically what happens is anytime in a non-restricted location, somebody cashes out of a slot machine and takes their Tito ticket, the ticket in, ticket out. In theory, you go to the nearest machine and you put it in and it spits out your cash. But apparently not everybody does this, and to the tune of about $18.3 million in FY25. And so the way that the law works, and it's worked this way since 2011, is that those tickets expire after 180 days. And so of the value of that ticket that has expired, 25% of that can be kept by the operator, but the other 75% goes to the state general fund. So this is 75% of the amount of vouchers that expire in a fiscal year that's listed here. And so either it is a lot of people who are leaving behind a few pennies, or there are some people that are taking home very large or larger tickets. I don't know the answer to this, how it breaks out, but it is a lot of money, and this has been growing, but it's one that the forecast falls a little bit, I think, because it's following slot win and some of these other things that we're looking at, and maybe a lot of people are deciding that it's worth it to stand in line and cash in their ticket after all. The court administrative assessments, GL 3114, it was at about $15.5 million in FY24. Historically, this has been lower. It's been around $1.5 million, and this is as a result of the law change in the 2023 session. This used to be anytime somebody went to court and was found guilty of a misdemeanor or certain other infractions, there's an assessment that they have to pay that's based on the amount of their fine. And so has been a distribution of this. Some of it goes to the local court, some of it has gone to other programs, but then $5 of that has gone to the state general fund. So the $5 assessment is in the neighborhood of $1.5, $2 million, and it fluctuates based on the activity. But in the 2023 session, there was a decision that instead of having some of these programs funded through this court assessment, and it was specifically things like the Criminal History Repository, the Supreme Court, other state-related justice agencies and functions, that the legislature decided they would just give them a general fund appropriation rather than have them rely on this fee, and then have the entirety of the fee that went to these agencies simply go to the state general fund. So that caused it to go from 1.5 million to about 15.5 million. And so this is kind of looking at in that range that we were in FY 2024. Again, this is a fairly new distribution for us in the state general fund, so we're kind of, until we get some better information, this is kind of what we're going with for now. And then lastly, unclaimed property, GL 3255 is the absolute last thing that is listed. This is administered by the Treasurer's Office, and this is where anybody who abandons a bank account or a safe deposit box or an investment account, or even things like gift certificates, anything, and there's a certain list of things that after a certain period of time, if the owner hasn't come back for it, then it's turned over to the state. And then the state, if it's like shares of stock in a certificate, they'll sell those shares, and basically they're holding the money for whoever owns it. So as all of you are probably aware, you can go to the treasurer's office, look up your name, and see if the state happens to be holding anything for you. And so basically what we have to look at is how much money is coming in, because we can look at how much money is coming in and then the number of checks that the treasurer is writing for the money going out, because the money stays a perpetual liability upon the state and the state general fund. But until that happens, the money goes into the state general fund. And so the end result of this is we always end up taking in more money than it gets paid out. And you can see that was at around 70.1 or about $71 million in FY24, which is probably the highest that it's been in my recollection. Just so much money came in. And the normal amount went out, but there was a lot of money that was coming in. And so I think the forecasts for FY25, 26, and 27 are looking at least in terms of fiscal, I went into the controller system and was kind of looking at the activity and found that the money coming in was perhaps a little bit less. So at least for us, our forecast went down a little bit, and I think the treasurer's office was in the same place. But there was a lot of money that came in toward the end of the month. So when we get to the December meeting, in terms of these forecasts that are under consideration here, this is probably the one that might have the most movement, just because we were fairly low on the money coming in. But as we've observed since we were looking at it in middle or toward the end of October, in the last couple of weeks, there's been more money coming in. So we have to assume that there probably won't be a corresponding amount going out, so it'll probably raise the amount that's maintained by the general fund for that. So with that, Madam Chair, I can answer any questions on any of these before I move on to tax credits.
Seems clear. Thank you.
All right. Thank you again, Madam Chair. Michael Nakamoto with the Fiscal Analysis Division, for the record. So there are 8 tax credit programs that are listed here. And again, these, for those of you who have been around long enough, we go through this as part of the Technical Advisory Committee's forecasts as well. And these are the programs where, through various legislative actions, there is a credit that can be earned for various activities that can be used against one or more taxes. And these originally started, I believe, back in the 2013 session and have kind of morphed into the list that we have here. So the first one is the film transferable tax credits, and this was originally put into place back in the 2013 session and has had a few revisions since then. But under the current program, up to $10 million in transferable tax credits can be issued to film productions for the activity that they do in Nevada, whether it's a TV show, a movie, anything that's filmed. And so we have a list of things like BattleBots, for example, has their arena down just off the strip that you can go and watch robots fight each other. And they televise it and they show it on TV, and so they earn credits as a result. But there are other things that are happening as well. And so this is administered by the Nevada Film Office over at the Office of Economic Development. And so ultimately the credits that are earned by these productions, they can be transferred, and then whoever ultimately uses the credit can use it against the modified business tax, the insurance premium tax, or the gaming percentage fee. Under the current law, up to $10 million of credits can be issued, and then anything that's not issued can be used in a subsequent fiscal year. But what we have found over time is that not the entire $10 million doesn't ever get issued and used. The activity in terms of these credits just isn't supporting that right now. But we talked to Kim Spurgeon, the director of the film office, and these are the numbers based on, they're looking at the productions they know that are coming up, the people who have applied for the credits, the people who have actually are filming, and then they go through audits and receive credits and go through this entire process. So based on what they know, at least for FY24 and 25, they came up with that about $7.3 million in credits in FY25, and then falling off a little bit in FY 2026. But then in FY 27, they expect that number to come back to about $6 million per year. And you can see that's kind of in line with where were in FY 2024, just over $6 million in credits that were used. On the next one is the economic development transferable tax credits. And these were what we affectionately referred to once upon a time as the Tesla and Faraday credits. So Tesla went during the special session in 2014 that allowed them to receive incentives for the construction and operation of the Gigafactory out in Story County, received a number of transferable tax credits. And then 2 years later, in a separate special session, the legislature came back and said that the car manufacturer Faraday Future could have a similar deal with less amount of tax credits for a factory that they were proposing to build out at Apex just outside of North Las Vegas. And that never materialized. But the law was written generally so that anybody who met the requirements could come in and receive up to $7.6 million per year in transferable tax credits up until the end of FY 2025. So back in late 2022, Redwood Materials, the battery recycling company that's actually based here in Carson City, came to GoEd and said, we'd like to build a facility out at Trick near Tesla and Panasonic and kind of make this, they'll be recycling the batteries and providing lithium to Panasonic and Tesla so they can build batteries and kind of do it that way. And so what they ended up doing is they were applying for transferable tax credits as well because they still had the availability under the so-called Faraday law to get a limited amount of credits until those provisions expired at the end of this fiscal year. And so based on the information that they submitted and based on the statutory requirement that the Interim Finance Committee actually approved the issuance of the credits, they were approved for $2,137,500 in transferable tax credits that we reflected on the economic forum sheets back in May of 2023, that they would take a portion of it in FY 24, 25, and 26. So we reached out to the Office of Economic Development because they didn't actually use any of the credits in FY 24. They had not been issued. Their timing was off in the credits being issued. But based on the information that we received from the Office of Economic Development, the entirety of those credits are anticipated to be issued and used in this fiscal year, FY 2025. The next one is the Catalyst Account Transferable Tax Credits. And so this is a separate economic development incentive program administered by GoEd. And basically, they can issue up to $5 million per fiscal year of transferable tax credits, again, against the MBT, the insurance premium tax, and the gaming percentage fee to small businesses, kind of as an incentive for them to come here. It's a program that GoEd has indicated that they have not been using for several years. And they said that they did not anticipate issuing any credits in this upcoming biennium, and that is why the forecasts for that are zero. The Nevada New Markets Job Act tax credits, this refers to a program that originally started during the 2013 session. Basically, the Department of Business and Industry is allowed to receive investments from insurance companies and each, originally it was $200 million of investments, and they could turn around and that money could be basically invested with entities who would then provide loans to businesses, primarily in low-income census distress tracts, to spur investment and activity in areas that perhaps need it more than others. And so in exchange for the investment that is made by these insurance companies, they are entitled to a 58% credit against the insurance premium tax that can be taken over a period of 5 years. And so the 58%, it works out to $116 million of total credits. And then based on the percentages, roughly between $22 and $24 million of those credits get used per fiscal year. So the original program was put into place, as I noted, in the 2015 session. The credits ran out the 2013 session. The first credits were used in calendar year 2015. And then the credits eventually ran out because there were only 5 years worth of credits. But the legislature reauthorized the program in FY 2019 with the first credits for the second incarnation of the program being allowed to be taken in FY 21. And so what you see for the actual for FY 24 and then the forecast for FY 25 and 26 is kind of from the second incarnation of this program, the remainder of the credits that are outstanding being used. But then what you see in FY 27 is the number goes back up again because during the last session, the legislature approved legislation to reauthorize the program again. With investments beginning at the beginning of this fiscal year, and then the first credits being issued at the beginning of FY 27. And just based on the timing of the credits and how they can be issued, we anticipate the number. There is a little bit of a difference in the amount of credits that can be issued. It goes from 24 million to about 25 million per fiscal year. But based on the timing of how the credits are being issued, we see that number being slightly higher in FY 27. But this is, again, as a result of the reauthorization of the program. So this is kind of the third batch of credits that starts in that fiscal year. And so again, because this is dealing with insurance companies and they're the ones making the investments and receiving the credit back, they can use it against their own insurance premium tax liability. It's not a transferable credit. The college savings plan tax credit is administered by the state treasurer's office, and this allows an employer who makes a matching contribution to a college savings or a 529 plan on behalf of their employees. They can receive a credit of up to 50% of the amount of that matching contribution against their modified business tax, up to a certain amount per year. And you can see that the forecasts are very low. Historically, there has not been a lot of participation in this program. And so this is information given to us by the treasurer's office that there's going to continue to not be a lot of activity in this. I skipped education choice inadvertently. I apologize. I'll go back to that. The education choice scholarship tax credit program basically allows a business to make a contribution to a scholarship organization who then turns around and gives scholarships to children in grades K through 12 to go to the school of their choice. So this is a program that was originally put into place in, I believe, the 2015 session with an escalator of the amount of credits that could be issued. But then in subsequent years, that amount was frozen, and the amount of credits that can be issued under this tax credit program right now is set at $6,655,000 per fiscal year. And so you can see that the FY24 actuals and the FY25 forecast are above that amount. And so what we have found, because we obtain information from the Department of Taxation regarding when these credits are issued, how they're used, when they're used, because they can be issued in a fiscal year, but they have 4 years to use that credit. Not all of the credit gets used at one time. They might spread it over multiple fiscal years. And so at any given point, even though there's the authorization for that $6.6 million per fiscal year, there's actually more credits that are available. So based on the information that we got from the Department of Taxation right now, there's about $2.9 million of previous fiscal year credits that are outstanding. And so what we're trying to work through is some of those credits were issued in FY 2019 and FY 2020, and they're very close to expiring. So we were trying to work through, okay, of that 2.9 million, how much do we think is going to expire without being used? And so the end result of all of that once we figured out, okay, well, when do we think those are going to expire, and then of those that haven't expired, when do we think they're going to be used, we came up with a forecast here of about 8.6 million in FY 2025, 7.2 million in FY 26, largely exhausting what is available and then getting down to the $6,655,000 that's statutorily allowed for FY 2027. Then under college savings plan, the affordable housing transferable tax credits, this was a program that was put into place, I believe, in the 2019 session, and basically it allows the housing division at the Department of Business and Industry to issue transferable tax credits as part of the financing for affordable housing projects. Basically, what the finding was there are for an affordable housing project, the way it's always been explained to me is there's a number of different financing sources, both public and private, that come into this. And there's also a federal tax credit program that is part of the financing as well. But there was also a need for this kind of last piece to kind of put it all together. The housing division, I believe, refers to it as a lasagna. So you've got all these layers of financing, and so they were looking at this as kind of the last effort to spur more construction of affordable housing. And so when it was put into place, it was a maximum of $40 million a year, or $40 million of tax credits over the life of the program, with no more than $10 million of tax credits that could be used per fiscal year. So it was put into place right before the pandemic. The pandemic hit and kind of put a stop to a lot of affordable housing construction projects, just because the pandemic was good like that. But then after the pandemic, with the over $2 billion of federal ARPA money that was received by the state, there was a decision to take about $500 million of that and put it towards affordable housing. So, which also further limited the need to actually use these tax credits, because there was $500 million in federal money that needed to be used for this purpose until the end of FY 2026. The end of calendar year 2026. So as of right now, $6 million of these credits have been used. It was $3 million, as you can see, in FY 2024, $3 million in FY 2023. So the forecasts that you have in front of you are from the housing division at B&I, based on the projects that they have in the pipeline, the people that they know that they're going to be issuing these to, and especially as that federal money is starting to be used. They're going to be a little more reliant on these tax credits. So these are their forecasts based on what they have coming, what they see coming, and then the knowledge that they can only issue $10 million of these credits per fiscal year. And then finally, the last tax credit program is the baseball stadium transferable tax credits that were approved pursuant to Senate Bill 1 of the 35th special session. And so that is the project that is seeking to put a baseball stadium at the southeast corner of Tropicana and Las Vegas Boulevard. And so part of that included the issuance of a total of $180 million in transferable tax credits over a span of 5 fiscal years, based on certain goals and metrics that have to be met relating to the construction of the project. And so, in fact, at the last meeting, in October, I stopped Mr. Hill and basically was asking him, okay, the anticipation was the construction would begin sometime next year. The first credits would be issued sometime in FY 2026, or at least that was kind of the timeline that was presented during the special session last June. And so I basically was like, is this still the case? And this was, there's been a lot of recent coverage about the financing and things that are going on, and this was shortly before that. But he indicated that, yes, things were moving forward as scheduled. So at this point, we're comfortable leaving the $36 million per year of those tax credits on the sheets for FY 26 and 27. And so just as a general reminder, all of these tax credits, again, can be used against one or more of revenue sources. And when basically the Economic Forum is going to approve its forecasts, as well as the forecast for these tax credits, basically the tax credits that are listed here reduce revenue, or as I have been referring to it, they're negative revenue. They reduce the amount of revenue that is available to the governor for building the executive budget, and then in May for the legislature to spend with respect to the legislatively approved budget. So I will, before I kind of give the summary of what this all really means, I can see if there are any questions about the tax credits.
I don't see any questions. Since we went through this pretty detailed review of what they all are and why the forecasts are what they are, unless the forecasts change materially, can we skip that review at the December 2nd meeting?
Yes, Madam Chair, Michael Nakamoto for the record. Basically, what I will do is when we come up, we'll have this agenda item on the December meeting, and you will be asked to consider and review the revised Technical Advisory Committee forecast. They will be meeting again on November 21st to consider any possible revisions. And then, so when we go through that, I think my intention for that is I'll go through really what changed. And there's probably, given the timing and everything, there may not be a lot of changes, but yes, to the extent, the only thing that I would probably cover on the tax credits is what changed, as opposed to going through the more detailed summary on
That'd be
those.
great. Thank you.
All right. So lastly, Madam Chair and members of the forum, Michael Nakamoto for the record, Table 7 on page 115, I did refer to it previously, and this is kind of the summary of what the Technical Advisory Committee forecast is for FY25, 26, and 27, and especially in comparison to the FY24 actuals. So the total of those non-major revenue sources in FY24 before tax credits was approximately $806.9 million. And then you can see that it drops to about $774.8 million in FY25. And so largely what's driving that is the about $20 million reduction in the gaming taxes and fees of $10 million of the fine, about $9 million of the advanced license fee. And then beyond that, you have the reduction in the cigarette tax of approximately $8 million that's driving that. So that's kind of the reduction from 24 to 25. And then in FY26, you can see that it falls again to $773.6 million. And the big reason for that is that $5 million of the Transportation Network Connection Tax that did go to the State General Fund in FY25, but won't go to the State General Fund in FY26 because it goes to the Highway Fund. And then in FY27, the number increases to 783.8, almost $783.9 million. So there's not a lot of growth in these, the non-majors as you go through. There's a little bit more movement in the tax credits. The total tax credits that were actually taken and used in FY24 was approximately $38.3 million. The forecast for FY25 goes up to approximately just short of $51 million, and that's partially the Redwood Materials transferable tax credits, as well as an anticipated increase in the use of the affordable housing tax credits that are primarily driving that. In FY26, the amount goes to approximately $72.3 million, and the big movements on that are about the $8 million reduction in the new markets tax credits from $24 to $16 million, which actually adds revenue. But then you have the $36 million in baseball stadium credits in FY26 that were not there in FY25. And then in FY27, you can see that it goes up to just short of $83.2 million. And again, this is the Nevada New Markets credits, Jobs Act credits, and the start of the third round of those credits that kind of increases that. So then the bottom line there is the total amount after tax credits, which was about $768.6 million in FY24, that decreases to $723.8 million. So it's about $44.9 million decrease in net revenue to the State General Fund. It's a decrease of about 5.8%. And then it falls again to about $701.3 million in FY26, which is a decrease of 22.4 million, thereabouts, about 3.1%. And then it's at $700.7 million in FY27, which is a decrease of about $620,000, or about 0.1%. So, Madam Chair, I believe it's been the past practice, same with the majors, that the Economic Forum does not approve the non-major forecasts, but that is, again, at your discretion as a body to do that or not. But I am available for any questions or comments at this point. Thank you.
Yeah, I think we would follow the same path we're taking with the majors and approve the minors after there's an update and at the December 2nd meeting.
All right, thank you, Madam Chair.
So then that concludes Agenda Item 8. Agenda Item 9 is instructions to the Technical Advisory Committee on the future state revenues concerning the general fund revenue forecast.
Thank you, Madam Chair. Again, Michael Nakamoto with the Fiscal Analysis Division for the record. Agenda Item 9, now that you've heard all of the forecasts for the major revenues and you've seen information about the forecast for the non-major revenues, this is, again, your time to decide whether you want to move any of the non-majors to a major or move any of the majors to a non-major revenue for the upcoming meeting on November 21st. And this is completely at your discretion as to how you would like to handle this. This is the point where you would deliberate, and if you would like to make a motion about moving anything, it would be the appropriate time. Thank you.
Just one item of consideration, I guess, for the MBT, the mining and the financial, they're so small. They're the same size or smaller than a lot of the minor revenues. Not to move them to a minor, because I know it's nice to keep MBT together as a forecast. But if it's possible, maybe we consider either having the tax still forecast that for us or asking to do the forecasters to do a consensus forecast like we do for the commerce tax. It was one thing that came to mind. What are our options in terms of who would provide that forecast?
Madam Chair, Michael Nakamoto for the record. If we were to do it as a consensus forecast, and certainly you're right to do it just to hear one forecast that's kind of the joint forecast, what we would probably do is we may handle it similarly to what we do for the non-major revenues for the Technical Advisory Committee and have everybody submit their forecasts, and then we all sit down and determine what we think would be the consensus, which was kind of the initial thought that I would have with respect to if you were going to handle it as a consensus forecast. It would be similarly, if you did decide to move them to a non-major, that would be the way that we would do it. We would handle it the exact same way that we handle all of the other non-major revenues, is everybody would submit a forecast, then we would kind of come to a determination on where we think the consensus should be. But again, whether that is handled at the Technical Advisory Committee meeting or that we present it as a consensus forecast similar to what we do, for example, with the commerce tax, that is at your discretion.
I don't know that I see a benefit or detriment either way, I guess. Which is most administratively easy for you, for the staff?
Madam Chair, I think if we, in terms of administration, it may be easier to leave it as a major, but then we could present it as a consensus forecast similar to what we do because it requires less changing tables and things like that. It would just change the procedure a little bit on how we do it and probably change the information in the table, but that's something that we can work through as the forecasters for the information that we would present to this body at the December meeting.
Okay, great, thank you. Yeah, could someone make a motion?
I make a motion that we combine all the MBT categories into one consensus forecast, keep it as a major for future meetings.
So sorry, one clarification. I think the non-financial is a very large number. I'd actually like to hear the individual forecast. It's just the financial and mining portions of the MBT.
So put those two together, you
Yeah.
recommend? Oh, okay, I thought you were, okay. I'm
Yeah.
fine with that modification. So I'll change my motion to MBT being two categories, one being the non-financial, and then combining the financial and mining into one category, a consensus.
Sorry,
I get
Michael,
that
can
right?
I
Is
just
that what you're
clarify
saying?
one more time?
Sorry.
Just so we get the motion right. So we'll leave the MBT as a major revenue source as one category, but the mining and financial portions of it will be done by consensus forecast, and the non-financial, we will have presentations from each of the agencies.
Yeah, okay.
So he makes that motion. Can we do it that way?
Yeah, can we do?
Do I
what
hear a
she said?
second?
Yeah, what she said.
Second.
All in favor?
Aye.
All opposed? No. Okay.
We have the direction that you're requesting, Madam Chair, and we'll have a conversation between GFO, the Department of Taxation, and our office on how to best facilitate that. But yes, for the December meeting, we will come forward, and there will be individual forecasts for the non-financial portion of the MBT. And then for the financial and mining, it will be a consensus that is agreed to before the meeting.
Thank you. I think that concludes agenda item 9. So agenda item 10 is scheduling the future economic forum meetings. So we, go ahead, Mr. Nakamoto. I'll let you
Thank you, Madam Chair. Michael Nakamoto for the record. This one is actually fairly easy. The next economic forum meeting is scheduled for this room on Monday, December 2nd at 9 a.m., at which point the forum will be considering and approving major and non-major revenue sources. This is also an appropriate time for me to ask all of you if you could please keep your calendars free for May 1st. That is the next statutory deadline for the forum to produce a forecast, and it is on a Thursday this year, so I'm hoping with a much advance notice as possible that you can keep that date free, but if you can't, then I can work with the chair to determine a date that is acceptable, but again, we would ask for you, if you're, to the extent that you are available on May 1st. That's the date ultimately. That's at least staff's preference, but it may not be yours, but we can work with all of you on that. Thank you, Madam Chair.
Thank you. Okay, the next agenda item is public comment. So we will start in Carson City. Is there anybody in the room that would like to give public comment? Okay, not seeing anybody. I'll turn to Las Vegas. Anybody in Las Vegas that'd like to give a public comment? Okay, also not seeing anybody, so now I'll ask BPS to inform us if there's anybody on the line that would like to give public comment.
Thank you, Chair. The line is open and working, but we have no callers at this time.
Thank you very much. With that, we'll adjourn the November 7th, 2024 meeting of the Nevada Economic Forum. Thank you very much.